Than analysts had expected in Q1. So already Deutsche Telekom weaker on Tradegate, so that is one to watch as well. On top of those three, you've got Accor. We talked about it, saying that Canadian holidays are on the rise because travellers are shunning the US. They've got a stake in Canada, so we keep an eye on the hotels. And of course, we've had Saab beating on results, but called down, interestingly. So let's see how the defence sector performs this morning, Guy. The semiconductor ex-dividend, but let's look at what happens at the open.
There's a few XDs out there that we need to work into our story. OK, it's time for the opening trade. Here is what we are looking at this Friday morning. We're expecting a positive picture to emerge. Some markets, though, maybe more than others. So the IBEX is already strong this morning, up by 0.9%. So Spain doing well. The FTSE 100 acting certainly as something of a laggard this morning. Look at what is happening there, only up 0.1%. We'll break down the various component parts in just a moment. The CAC is expected to open strongly this morning. The DAX, maybe a little less so. So maybe we'll get an early move from the DAX this morning, as we saw yesterday. But there are a lot of single stocks that we need to fold in, but it still feels very macro-y, the market this morning. You've still got, obviously, a story around what is happening with tariffs. We're still trying to work out what the central bank story looks like. But as anticipated, you've got a CAC 40 in Paris that is opening up 0.9%. Lizzie, give me the sectors.
Well, we can break it down, and you've got all but two sectors in positive territory this morning, guys. So travel and leisure leading the gains. That's up 1.4%. Industrial goods and services up 1.1%, not far behind. The only two that are negative are, the bottom of the basket is utilities. That's down 0.2%. And if we dive into some of those single stock stories that we were talking about, just starting on defence, because we had Saab, as I say, beating but called down. And in fact, it's down 4.6% this morning. And some of that sentiment spreading to the rest of the defence sector. So you've got Thales down 1.5%, Indra Sistemas down 0.9% as well, Rheinmetall in the green. And then coming back to hotels, Accor up 3.5%, WPP, one that Joe had flagged, 1.25% up this morning. So, we were expecting relief across Europe, and indeed we are seeing it on most sectors and most indexes this morning.
It's interesting, Safran is up quite nicely, doing very well. So that is a company that continues to do well, obviously makes jet engines. That is a big aftermarket story as well that's been driving that over the last few quarters. We do have some ex-dividends, but it's interesting to see Novo weakening up again. Defensive stocks, it's really interesting to see what's happening within the defensive space at the moment. I was talking to Emily Field from Barclays about this yesterday, their pharma analyst, not seeing the pharma sector delivering on its normal defensive qualities. She thinks it will come back, but it's not playing that game just at the moment. Airbus is up quite strongly as well. That's interesting, despite what we're seeing out of the US in terms of the tariff narrative, plus also what we're seeing in terms of the consumer picture being generated by Southwest. Though Southwest is a Boeing company, so maybe a different narrative there.
Let's weave all of this together. We've got Beata Manfi, who is Head of European Equity Strategy at Citi, with us round the table this morning. Good morning, Beata. Good to have you.
Morning.
It's Friday. We've had a choppy week again. All these tariff announcements, but I want to say earnings estimates have been relatively stable. Do you feel like the market's underestimating the risk of further earnings downgrades down the line? Are we too optimistic this Friday?
It depends what's your definition of stable, right? Earnings have been coming down, but they have not been coming off the cliff. For Europe, for example, consensus has had 8% at the start of the year. Now they are at 4 to 5%. This is where we've always been with our top-down numbers. Now, what has been falling over the cliff are earnings revisions, so consensus revisions to earnings, upgrades versus downgrades. What we are noticing in Europe, but also in the US, it's broad-based, right? There's nowhere to hide from these downgrades. We are seeing around minus 60% reading for array. This type of reading doesn't happen outside of recessions. So it's only been historically worse, but not much worse, around these current levels during, well, you can guess it, GFC, TMT bubble burst, and of course during the initial phase of the pandemic. That's it.
So what's the bigger issue? What's the bigger impact in this uncertainty? Is it supply chain issues or is it the potential demand slowdown?
A bit of both, right? A bit of both, and the uncertainty. This is why the analysts at the start of the year, actually in Europe, have started to upgrade their numbers because we've been seeing positivity from within Europe. We thought the tariffs would be around 10%, not wherever they will be, right? Perhaps we come down there. So analysts and companies have started to guide down pretty fast. This is also why this reporting season is seeing more bids than previously in Europe, because the numbers beforehand have come down so much. So what that means going forward for actual earnings, your initial question, is that this level of array earnings revision indices is with 100% hit ratio. If you looked at these levels in the past, 100% hit ratio, actual earnings 12 months out were lower. So that's a given. Earnings will be lower, right? The downgrades are coming through. However, historically, it tends to also be a contrarian buy indicator. So it's so bad for the market, but especially, I know we don't want to hear that, cyclicality versus defensiveness. Now, the time horizon you need to have is 6 to 12 months, right? Over the next 3 months, the performance is flat to down. And every cycle is different, of course.
Do you think, have we priced in a recession, though, to equities?
No.
Okay.
But are we going to get a recession in equities and in global economy? That's still uncertain, right? Yeah. Do you see really terrible data coming through recently? No, it still could come through, right? They are not great, they are bad. But, you know, I was quite surprised with the PMIs and IFO yesterday that it's been stable, right? And even above expectations.
What's your degree of certainty, though? Because at the moment, companies aren't telling me anything because they're trying not to. The data, the hard data hasn't come through yet. We're flying blind here, aren't we?
Absolutely. Very low level of uncertainty. This is where you're getting these downgrades, right? However, what you've mentioned before I started, right? There is a sense of stabilizing news flow, of marginal improvements, right? So because this data hasn't come through, hasn't deteriorated yet, if we negotiate quickly enough, perhaps we avoid a recession.
Right. Perhaps.
Perhaps, yeah. So to your question on have the markets priced in recession, definitely not. What the markets have priced in, a European market at least, on the day of the 90-day pause, before the pause was announced, European markets have priced in flat EPS, slowdown, not recession. That's a start. Japan has priced in the contraction.
But what we do know is that you've got a stronger euro, and that has happened rapidly. And you've got some people talking about $1.20. I think our next guest sees $1.21, 22, somewhere in the next year. How much does that shave off earnings growth down the line in Europe?
Of course. So a rule of thumb is around 2 to 3 for every 10%. But you see, I was getting the same argument when dollar was going up, right? That it's bad for Europe. There'll be pockets of the market that will benefit from it, and pockets that will be losers.
But what's
the
pain point?
As long as the GDP doesn't collapse, this is sustainable, and this is perhaps you move from dollar earners that has been the trade last year, moving to more domestic-oriented stocks, right?
What's a defensive in this space? Because everybody always answers, and I think you're probably going to as well, you're going to tell me pharma. problem is that the pharma's not acting as defensive right now because there's so many other things you need to fold in terms of what's happening with regulation in the States, who's going to staff that, what's happening with the tariff story around pharma, we don't know yet. There's a lot of dollar earners, there's a lot of euro earners in that space. The pharma sector is not being a defensive sector. No. When does it become will it become a defensive sector again?
Guys, there is a price for everything. And we've looked at our recent note at the most beaten up sectors, right? So within defensive that have done quite well, pharma is the most beaten up. So our positioning right now, so by the way, I've upgraded pharma too early in February, right? Yep. But the model, our allocation model loves it now because it was so beaten up, right? So earnings don't look so bad, while the valuations came down a lot. Another defensive sector that I like, we have an overweight, is personal care, and we are also overweight. I'm not sure whether it's defensive or not. It's definitely domestic. It's a real estate. But because these earnings revisions are at these recessionary levels, we also argue that it's time to start dipping a toe into beaten up cyclicality. Not full on, because these hit ratios and forward performance in the near term, as I've mentioned, are flat to down. But if you buy now and hold 3 to 6 to 12 months time, the cyclicals outperform substantially.
It's a long way away.
Well, so, but it starts working now. So what we've upgraded overnight, very brave call, I have to say, autos to overweight. Yeah. And so this is the beaten up cyclical value, our preferred one. There are many more, right? But we are just choosing one for now. And within beaten up cyclical growth, it's tech as an overweight among these defensives that I've mentioned, right?
Okay, Beata, nice to see you. Brave calls. We like brave calls. Beata Manthe, Head of European Equity Strategy, joining us from Citi. A few ex-divs in the Big Six this morning, the Core Six. Let's show you what is happening there. We are watching very carefully what we are seeing. Tech generally is having a good day. So ASML, the fact that it's XD and up is maybe something that's worth paying attention to. LVMH is also bouncing quite nicely. Some of the defensives, maybe a little less so. So there's Novo Nordisk at the left-hand side of your screen. Let's talk about what's happening in the telecom space. News from the United States moving European markets. Joe.
So there is a significant move, as you say, Guy, coming through from the US into Deutsche Telekom today. That stock down around 3.7%. One of the heaviest weights today on the telecoms index. T-Mobile in the US reporting that drop down in subscriber numbers, not as strong as expected. The internet business looking okay, but Deutsche Telekom owning more than half of that company, so therefore feeding through into that stock today. Then another stock moving lower was Saab over in defence. See where that one's moving. We're down 3.5% on SAAB at the moment. Now, the orders at the defence company actually disappointing at the top end because, of course, the expectations have risen so much for defence orders. So potentially just a little bit of a disappointment there. As we say at the bottom there, the operating profit actually looking pretty strong on that one. Then Michelin warning of people already buying cheaper tyres ahead of those tariffs coming in. Pretty interesting on the tariffs front for them, but actually the pricing at the company seems to be pretty strong according to analysts. The mix of higher priced products actually supporting the stock at the moment, so that one doing pretty well. Then we're in hotels, a bit of a mixed one out of that one. The demand growth looking okay, but I did see some lines on the revenue per average room potentially not actually as good as expected, but therefore we are seeing a decent move in that one, probably more than I expected, to be fair. That one up 5% in the French market this morning. And then a couple of bits of M&A. We have got Mobico, which is formerly known as National Express. I probably preferred the name National Express, to be fair, but that one is down at 10% today, selling its North America bus business, but a bit of disappointment on that one. Looks like the valuation a little bit light on that stock, so we're seeing that one down 10%, a pretty big move in the UK. And then finally on Merck doing a big deal in the US for SpringWorks, which does rare disease therapies. A lot of that is in oncology and cancer. And we are seeing a little bit of a move in that one, but worth watching SpringWorks because that one was up more than 10% in the US post-market, set to rise in the pre-market in the US. But Merck rising a little bit in Germany following that deal news this morning.
All right, Joe Easton from our equities team, we thank you. You've got a few more sectors creeping into the red this morning, so it's now about 3/4 of them at this point, but the Stoxx 600 is still up 0.4%. We're going to switch focus to FX next. We're going to be speaking to Kirsten Kundby-Nielsen, who joins us from Danske Bank. That's next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. We're 16 minutes into today's session, and it's green across the screen. The Stoxx 600 higher 0.2%. Break it down by sector, and you've got just over half in positive territory. Travel and leisure leading the gains, and it's the CAC 40 in Paris that's the outperforming index this morning, up 0.7%. But it's a risk-on mood in general on both sides of the Atlantic this morning. Elsewhere in the world, we're watching China. The Chinese Foreign Ministry holding its daily briefing in Beijing, and a spokesman saying that they're not having negotiations with the US when it comes to tariffs, and the US should not mislead the public when it comes to these tariff talks. So very much a different line from we're hearing from Donald Trump.
Yeah, negotiations. So talks and negotiations, two different things. America says we're having talks. We're having a conversation. You and I are talking, but are we negotiating? I don't know. I don't know where the line on that one is and what the definition looks like. So maybe both could be true simultaneously. I don't know, but I think maybe I'm kind of reaching here. But the Americans are saying we are talking to them. The Chinese are saying we're not negotiating. Are those two different things? don't know. It's interesting that there's also a line saying as well that the Chinese are not familiar with reports on China tariff exemption. So that was a story that we had overnight. The Chinese are maybe pouring a little bit of cold water on that narrative as well, that they are maybe reducing on some goods the 125% tariff that has been imposed as an import duty into China. And we're talking about certain chemicals and other things that the Chinese economy needs.
Yeah, because, of course, that would be really a demonstration of the significance of their trading relationship. But China saying they're not backing down. They don't even want to negotiate is kind of what they're saying.
Yeah.
They don't even want to entertain US trade policy.
And there was a line out of the Politburo earlier on as well, which is saying that China vows to fully prepare emergency plans for an external shock. Like the external shock being, of course, well, I'm assuming the external shock is the tariff.
That's the euphemism that everybody is
Well,
using.
no, I'm hoping... Well, no, it could be something else. You could have other external shocks as well. So it depends how far the next phase goes. But let's assume that let's hope that it's just that, which is... It's not worse than that. But setting up new financing and policy tools coming through. So there's a lot happening with that Chinese story this morning, and it does seem as if we are getting a slightly different narrative coming through from both sides. The US markets, though, reacted very positively to A, the Fed talk, and B, the fact that maybe conversations are improving around tariffs. Does that get rolled back a little bit today? The FX market has been obviously part of that story as well, and we have seen the euro pulling back against the dollar. We've been 115 this week, been north of 115 this week, a 3-year high. We've faded that now. We're at 113. Traders, though, are showing confidence in the common currency's long-term upside. Let's take a listen to what they've been telling us.
The standout performer over the first week, say, after the reciprocal tariff announcement, was the performance of the euro. It was standout. It was doing a really good impression of a safe haven currency. And that perhaps has really gone a little bit too far.
I mean, the starting point here was of significant dollar overvaluation. So even with the move that we've seen on our metrics, on most long-term real effective averages, the euro is still undervalued, the dollar is still overvalued.
Both the euro and sterling have been strong versus the dollar, and a lot of companies in the index are dollar earners. Energy prices down, currencies up. That's not a great mix when it comes to European earnings.
Strength of the euro matters. Some of our guests speaking about it. Joining us now to add another voice, Kirsten Kumbie-Nielsen, analyst at Danske Bank. Good morning. You've got, I think, a 121 target for euro dollar. How do we get there? What is it that is necessary to get us to that kind of level?
Yeah, so we expect the move in Eurodollar to 122 in a 12-month horizon. I think this largely reflects also some of the moves that we've already have seen. In terms of that, Europe is in many ways becoming a viable option for investors. We're really seeing some positive dynamics developing on the structural growth outlook. Some of these more expansionary fiscal policy measures, not only in Germany, but also more broadly, actually, within the euro area. So that is definitely a part of it, a more positive euro area story. On the other hand, the policy uncertainty, these tariffs, everything related really to this Trump administration, just by also tariffs being an implicit fiscal policy tightening, this really being a stagflationary shock to the U.S. economy. I think that's what's going to be driving the move higher to euro dollar the next year ahead.
Just separate that out for me. In terms of the bigger effect, is this dollar weakness or euro strength?
I think it's a bit of both, to be honest. We saw the broad-based euro strengthening at the beginning of March, where we got this positive news in terms of the German government increasing defense spending, really for the first time breaking with this debt break in many ways, also increasing infrastructure spending. But this, I think, the development is just highlighted also from that everything is really going more south in the US. So it becomes a more viable alternative. And then there's, of course, the entire energy story. We've seen energy prices moving lower. This favors Europe over the US, from Europe being a net energy importer and the US being a net energy exporter. So I think it's a bit of both, and that's why we've seen this pretty sharp reaction also in Eurodollar.
Kirsten, I had to read this twice when I saw it in your notes. You see the risks as to the upside for Eurodollar potentially higher than $1.22. What could actually push us above that level over the next 12 months?
I think it could be if we see further escalation in the trade war from the U.S. side, at least. We've really seen the U.S. starting to pull back a bit here the last week. It's been a good week in that sense. So I think if we get further escalation, not any progress on trade talks, I think this entire story, now it's died down a bit, but the entire uncertainty in terms of U.S. institutions, so everything related to the U.S. Central Bank, for example, I think that's something that could really drive this. And then I think the biggest risk is definitely a U.S. recession that would drive the cross, I think, significantly higher than 122.
So given the strength of your view, when you have the Bank of England Governor Andrew Bailey saying that questions about the dollar's status as a reserve currency are overdone, is he wrong? Should I not be asking about this anymore?
I think it's a bit too soon to tell. I understand Governor Bailey's comment in that sense. I think what we're really seeing in terms of the dollar's status as reserve currency, it's definitely being dented. This policy uncertainty in many ways is really is hitting the dollar, but also I think just remembering, and also what we saw in the introductory segment, that of course something is the speed of depreciation that we're seeing from the dollar, both in the trade-weighted part, but also in euro dollar. But one thing is the level. I mean, 113, 115, it's not unheard of levels in any way in an historical context. So I think it's too soon to say, but it's definitely being dented.
In terms of euro sterling, can you just kind of walk me through where you see that pair going? Because that within Europe, obviously factoring out the dollar, let's take the dollar out for a moment. What happens within Europe in terms of the dynamic? Euro sterling, what happens with the Scandi currencies? The euro is at the center of all of this, but just kind of give me the various pairs around Europe and how they're going to perform in a stronger euro environment.
Yeah, so recently we actually also turned around our euro sterling forecast, so we now expect euro sterling to move higher. We've seen some positive dynamics in terms of expansionary fiscal policy in the UK, but what we really see for sterling FX is that it performs poorly in an environment where credit spreads are widening. We're seeing a lot of uncertainty, volatility is high, and this increased focus again on fiscal policy in the UK. I think that's something that can drive euro sterling higher from here on out. For the Scandis, interesting story. It's been really remarkable developments in NOK. For the Norwegian kroner, we saw a significant weakening here during this Liberation Day. These different days, it's rarely an environment for, especially the NOK, performs very well. Increased global uncertainty, lower energy prices, equities moving lower. It rarely constitutes an environment that is positive for the Scandis. So these small cyclical sensitive currencies we also expect to underperform in this environment against the euro. So weaker Swedish krona, Norwegian krona, and sterling against the euro for the next year.
Just briefly, Swiss franc, yen, other alternatives to the dollar, how do you feel about them?
I feel good about them. I think price action has also been reflecting this. We've been bullish on the Swiss franc and the yen for a long time now. Of course, anything here in the risk-off environment favors a move higher in these currencies. When we look at the fundamentals, it looks good in Switzerland. We're nearing the lower bound for the policy rate. I think in Switzerland, so the rate differentials are also set to narrow. In Japan, different story. Bank of Japan still part of its hiking cycle. Inflation is still more in the higher end of the range. So I think it offers some interesting opportunities. So we're more bullish on those currencies. I only think that this trade war scenario, this world now that we live in where trade war is really part of risk sentiment, it only further underlines these forecasts.
Kirsten, great to talk to you. We thank you for joining us. Kirsten Klintby Nielsen, analyst at Danske Bank. Always good to speak to you. Well, we are looking at euro dollar, currently weaker by 0.25% at a 113 handle, but that on the other side of the dollar strength, because we are risk on all of this relief around the dovish Fed. There's earnings as well out of California and the tariff talk, which continues. But next up, we're going to focus on defence. UK-EU defence cooperation in focus as pressure builds around a Ukraine peace deal. We'll be speaking to Elizabeth Shaw from the Atlantic Council. So this is Bloomberg.
discussed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Friday morning. Short week, doesn't feel like it, but we're 30 minutes into today's trading session, and broadly we are higher, but maybe not as high as we thought we would have been maybe earlier on. So, yes, we are seeing gains being posted. Not exactly blowout numbers, though, you see on the screen in front of you. There's a bunch of single stocks out there that are worth focusing on. In fact, there's a whole load. Let me just focus in on the defense sector and see what is happening in that space this morning. Saab is out with numbers. The stock actually has now come back a little bit, which is interesting. The line that I think is fascinating, though, Lizzie, out of what we're hearing from Saab, makes the Gripen fighter jet, makes a whole range of other kits as well. The quote from the CEO is the urge to speed up the upgrade of Europeans' defence to shorten lead times is definitely a trend. Europe wants to rearm and do it fast, but does it have the infrastructure and the manufacturing base to be able to do that?
Is Europe known for doing things quickly?
Eventually, yes, but not initially. And I think that's the problem. But I remember listening to the BAE CEO talking about the fact you can double production from kind of, that's easy, but going beyond that starts to become problematic. And that's where you need to really invest in upgrading the infrastructure around the defence space. But Saab's certainly talking about the fact the European governments want it, and they want it quickly.
Well, indeed they do, and it's going to be on the lips today of the UK Prime Minister Keir Starmer and the European Commission President Ursula von der Leyen. They're meeting here in London to attempt to align on security, defence and migration as well, ahead of that summit that's happening next month on May the 19th. Now, the prize is UK participation in the EU's new €150 billion weapons fund. They've also reaffirmed their support for Ukraine as both leaders are looking to navigate US pressure to reach a peace deal. So let's talk about it all. We've got Elizabeth Braw, who is Senior Fellow at the Atlantic Council. Elizabeth, good to have you with us. Are these companies like Saab going to get that money fast, like they want to? There's this sense of urgency from the CEO this morning.
There is a massive sense of urgency, not just from defence manufacturers, but from European governments. They have decided they want to invest more in defence, and they've allocated the money. But defence is complicated, as we all know, and so the question is how quickly defence manufacturers can produce the weaponry we need, and what is needed for them to be able to produce it that quickly. And that starts with supply chains and workers. Do we have enough workers, for example?
Yeah, so are these companies ready? Which countries are front of the queue? Who do you see as profiting most from this money?
So what we have seen is an EU decision to allocate a substantial amount of money that EU member states can access for defence investment. And so the 27 EU member states are clearly ahead of the UK there, because they have allocated a significant sum of money, and they also have their own defence manufacturers. Several EU member states have significant defence manufacturing sectors. Germany, Italy, France and Sweden in particular, and so they are looking pretty good. Now the UK wants to be part of that, and that's part of having left the EU. It now has to conduct separate negotiations to be able to join at least partially.
Isn't it logical, though, to bring in the UK? The UK is going to be at the core of the European defence story going forward. Would it be counterintuitive not to have the UK within this rearmament programme if we are going to have commonality of kit, commonality of procurement? If the UK is going to sit within and be a leader within the defence story going forward, isn't it just logical to marry these two up?
It is. The question is just how to do it, because the EU would not want to give the UK the same advantages as EU member states.
But it's going to rely on the UK for defence. It's going to rely on the UK for the nuclear umbrella. It's going to rely on the UK for the northern. It seems as if we've got two different buckets of a conversation happening. We can't allow the UK in because it's not a member of the EU, but we desperately need the UK to be part of our defence setup. So isn't one slightly short-sighted not to think about the other?
Well, I think, Guy, what has changed is that since Brexit is that the world has become a lot more dangerous, and things have to happen very quickly in the defence area, as it were. And so defence has two sides, right? The armed forces and then defence manufacturing. And on the armed forces side, it's clear the UK is a leader in Europe and within NATO, within other setups within the European continent, such as the Joint Expeditionary Force, and also within the Coalition of the Willing. So on the military side, the UK's role is completely clear. Then on the defence manufacturing side, when it comes time to allocating money and who should be able to borrow and use funds, then it's less clear because it has to do with Brexit. And I think the reason, or the very fact that these conversations are happening between Ursula von der Leyen and Keir Starmer is the realization that we have to be flexible, we have to be faster than we would ordinarily have been in UK-EU negotiations.
Well, I want to come back to the boots on the ground coalition of the willing point, but on the nuclear point, let me give the counter-argument here.
Yep.
When you've got an ascendant far right in lots of different countries across Europe, do we actually want to be trusting each other when some of these governments in one election cycle maybe could have their finger on the nuclear button?
So what we have in Europe are two nuclear countries, so France and the UK, and since, well, times immemorial, for as long as nuclear weapons have been around, the United States has obviously had them and has extended its nuclear umbrella to the rest of Europe, so that other European countries wouldn't have to develop nuclear weapons that would be detrimental to the security of the world. So what happens now that we are not really sure how the US is going to position itself, and that's why this question of a European nuclear umbrella has come up. Should the UK extend its nuclear weapons as an umbrella? It would be difficult because it's very linked to the Americans. Should France do it? And it is extraordinary that this conversation is happening when we do have an existing nuclear umbrella, the American one.
And on that coalition of the willing point, the Times of London I saw yesterday was reporting that the UK could scrap the plans to put boots on the ground in Ukraine because it's too dangerous. We saw those airstrikes on Kyiv. How damaging is that? We're going to see Macron and Starmer talking, France wants a more muscular approach here. How damaging is that potential rift within the coalition of the willing if one partner is unwilling?
That is a huge challenge, and So what we have with the coalition of the willing is massive signaling towards Russia, towards Ukraine, towards the United States, that there are countries here who are willing to help Ukraine. But with all messaging, what matters is really how the other side perceives it. So if we now have hesitation within the coalition of the willing, then Russia is going to say, well, it's not going to be as powerful as it looked, so we may not be as concerned about it or as fearful of it or whatever the initial Russian reaction was. And that is really troubling, because the signal that I think would be desirable to send to Russia would be unified strength, no hesitation.
Does the Trump peace plan work? Will it work? Can you see it working?
It's...
Pause there.
Well, it might work from his perspective, because he says it's a peace plan, and if
from a European perspective, do you think it is something that is viable?
It is not viable from a Ukrainian perspective, and the Ukrainian perspective is also by extension the European perspective, because we here in Europe are the countries that have to live with whatever comes next in Ukraine. And we should remember that if Ukraine is forced to give up territory, and that begins with Crimea, which is not within Zelensky's gift to give up, that would have to be approved in a referendum. But even if Ukraine were to somehow agree to this deal, what it would, the US proposed deal, what that would do is send a signal to any other country in the world that you can take what you want from your neighbor, and then it will be yours, because it's just easier to enforce a peace on that country than it is to defend the invaded nation.
Yeah, but there's the territory point and the question of whether Ukraine accepts it. But there's also the point that, you know, the US is going to demand Russia accept Ukraine's right to have its own army, its own defense industry. We've reported that that's what is going to be put to Putin by US envoy Steve Witkoff when they meet, and Axios reporting they're going to meet today. Do you see Putin accepting that?
Well, the difficulty with Putin is, and Russia generally, is that they may sign a deal or a treaty or whatever it may be that's put in front of them, but we don't have any reassurance that they will abide with whatever they put their signature under. And that's essentially the original sin when it comes to the Ukraine war, that Russia agreed not to attack Ukraine back in the 90s, and then it did anyway. So how can we trust that that's not going to happen again?
Nice to see you. Thanks for stopping by to update us. Really interesting. We'll watch what happens in this conversation. May or may not be happening today. We'll see. Elizabeth Braw, Atlantic Council Senior Fellow. Thank you very much indeed. Coming up, European stocks have held up well against their US peers so far this year. Does this trend continue? We're going to debate that next. This is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back. What are we, 43, nearly 44 minutes into the session. I just want to check my year-to-date numbers in terms of kind of what equity performance we have seen. So the S&P is on a, if you currency adjust it into euros, it's down 15% year-to-date, okay? If you adjust it into euros. The Euro Stoxx 50 is up by 4.79%. So everybody's got quite excited about European equities, and they have definitely outperformed. But how much longer can we expect this to happen? Our strategy is becoming a little bit more realistic maybe in their assessments of where we go from here. So we've been talking to a few people, a few strategists out there, trying to figure out what we are going to be seeing going forward from here. And it appears that some of them are starting to cut back their outlooks for European stocks due to the volatility that we're seeing, the trade tension that obviously is a big focus. Euro's benchmark index, 2% higher this year compared with the S&P's 9% drop. I would currency adjust all of that because actually I think the FX story is becoming interesting as well. The person that's done all this, amongst others, is one of our senior reporters, Michael Masika, who joins us around the table this morning. So we got very excited about European equities, and now we're becoming a little bit less. Why?
Well, the reason is, guys, European equities are really geared to global growth. What we're seeing at the moment is global growth is being cut, it's been downgraded, mostly because of US tariffs, because of the uncertainty that we are having between the trade war between US and China and what's going to happen to European exports. I mean, at the end of the day, it's a continent that is an exporting continent. Yep. Like the Stoxx 600 makes probably like 60% of its revenues outside the Eurozone. So, you know, global trade is very, very important.
So there's an acceptance that the outlook is gloomy, but something that we've debated all week is, are we past peak uncertainty? Even if we're not past, well, we may be past peak tariff, but is the uncertainty day by day creeping down?
Well, there is a bit of that, and that's why we're seeing some rebounds. I mean, we're seeing rebound in Europe, we're seeing rebound in the US. You know, so we might have made, you know, we might have passed the peak. Now, having said that, are we going to reclaim the highs very quickly? It doesn't look like it, and that's not what strategists are seeing at the moment. It's going to be gradual. There's going to be a lot of volatility this year because trade negotiations are going on. We have no idea what's going to happen. The Fed is a bit stuck in between, like how much inflationary those tariffs are going to be, how much the growth is going to be downgraded, and what can they do to mitigate that.
Are European stocks, though, this is in some ways a relative trade. The US market got way ahead in terms of everything, valuations, US exceptionalism. Yeah. Despite the fact that we may be a little less optimistic on what's happening in Europe, are we, relative to the States, still optimistic and there is a closing of maybe some of the extreme gap that had opened up?
I do think so, and that's what the market is also playing. Because the more uncertainty, the more difficulties there is in the US regarding the monetary policy, regarding the trade policy, the fiscal policy, because at the moment, you know, everything is in favor of Europe. We're having a fiscal package that is coming. The rates are like 2 percentage points lower in the US, in Europe compared to the US. Earnings are kind of holding. It's all in favor of Europe and all in favor of diversifying portfolios outside US assets and into international assets like European assets or emerging market assets. That's what's going on at the moment, and that's still going on. It's still the trade that we're seeing, and it's still what a lot of asset allocators are doing.
Michael, stay with us. I just want to bring in Bloomberg's Valerie Teitel. Val, do we buy the recent equity market optimism?
Look, I think that's a key question. You have to have an opinion about what drove this week's rally in order to have a call on what's going forward. And there's a key statistic I want to bring up that I thought really interesting, brought to light to me by our markets guru, Dan Curtis. When we think about the S&P this week, we've had 3 consecutive days of over 1.5 percentage point gains. And if you look back on history, that is not something we typically see during a bear market. That's something we typically see at the beginning of a bull run. Last time this happened was after the dot-com bust. And this is something that, if you look back on history, is a good fundamental structure for continued gains in the equity market. Now, I know that's a bit technical to be talking about something like that, but the strength of the equity market this week has been real, especially when it comes to the day-to-day price action.
Are we just, though, swinging from kind of one unknown to another unknown? We don't know what's happening with earnings yet. We don't know what's happening with the tariff story. We got very excited about the fact that apparently the US is talking to China. China's saying, no, we're not talking to the United States. Are we still in this point where the market doesn't know yet, so it's swinging wildly from side to side? This is just volatility, and it's not actually signaling anything. It's a lot of sound and fury, but doesn't tell us about the fundamental view that we have a degree of certainty to move forward from here. We just don't know at this point.
Yeah, well, okay, with all the volatility that's happened, I think it's important for any investor to have a call on whether this sell America trade does come back. If, for instance, we get a bad labor market print, or if in the next 3 weeks we really start to see hard data deteriorate, does the sell America theme really come back? Because I think maybe that would be more of a bull case for European equities, or to stay invested in assets outside of the U.S. If the sell America theme comes back when we have U.S. equities falling, treasury prices falling, and the dollar prices and the dollar falling, all at once. If we think that's going to come back, that is a good case to want to be, in other global assets.
Is it hard? It feels like it's hard to knock American optimism at the moment. This buy the dip mentality is still there.
Val smiles.
Yeah, ever the optimists in the US.
But that's what it feels like at the moment.
Yeah.
That doesn't feel like it has been. That hasn't changed.
Well, at least in the short term, let's say we get some, deals done with U.S. allies in terms of Trump. We could have a stretch of a few weeks where we are feeling a bit more positive before we start to get the hard labor market deterioration, which I think is something that even the Fed members have been pointing to of late.
Okay. Let's talk about what happens next week. Charlie's here to tell us about that. What do we got next week? Because the corporate earnings story next week is going to be fascinating.
We have got a bonanza of earnings across industries. So we've got European banks coming forward. Yep. The big issue we're going to be focusing on is trading, right? That volatility from the first quarter. How did that translate into European banks? It's interesting, though, because we got a little bit of a preview this week with BNP. And actually, they missed. They had a record on trading, which, good for them. But their expenses were higher than expected. And I think that might be a theme we start to see as analysts start unpacking a lot of these earnings. How much expense control do these firms have, not just in banking, but across sectors? Because we're hitting a period of uncertainty. You got to have that expense control. We've got autos coming. We've got Mercedes slated to report. We've got VW. The tariff question is going to be huge there. And we've also got energy, right? We've got Total later in the week and then Shell. So oil price questions there and dividends.
Michael, the earnings season, what is it telling us about what is happening here in this buy Europe story? Are European earnings looking like they're going to hold up better than US earnings?
They've been downgraded the same way as the US are being downgraded, maybe a bit less. The problem is the guidance. I mean, those earnings are fine. They're still holding up. This still might be like a good earnings season. That's what everyone is expecting. The problem is, how can you give a guidance when you have no idea how you're going to get hit?
Well, some of them are giving us multiple scenarios.
Exactly. So you give scenarios. It's the same with the strategies. I mean, you take our survey for this month. Yeah. A lot of strategists have said, okay, so we cut our targets because we have to, because there's too much uncertainty, and so we don't know. But at the end of the day, it's all going to be in a range. Like if we get a deal, if things are getting better in terms of trade negotiations, then you know what? the market is going to keep going up. But if we have nothing, it's going to stay there, it's going to be in range, or if it deteriorates, we might go like way lower than where we are, and we don't have a bottom. So it's kind of we're still in there. You know, everyone thought we're going to have like Liberation Day and we're going to clear the uncertainty, and then you know it's going to be good from here because we will know where we're going. We have no idea where we're going. And so it's the same for companies. Their guidance are really shaky at the moment. It's really shaky because of the FX. It's very shaky because of the tariffs. Shaky about growth. It's complicated.
I thought markets, Val, hated uncertainty. If companies don't know what's happening, how do markets know what's happening?
I mean, we do, but look, I feel like companies are, we're in this uncertain phase, yes, but are they letting go of employees? No, not yet.
We don't know.
And
we'll find out next week.
Keeps the consumer still spending, right? You know, if you're less worried about your job.
Southwest Airlines is saying we're in a recession. American Airlines is saying, if you want to know what's happening in the U.S. economy, ask an airline.
Yeah, we need to wait. I guess the market is waiting to hear for layoffs. We're not hearing those yet.
But the whole point of being optimistic about what Wallace said, surely, was that he was worried that the job market disruption will come at some point down the line and they will react to it. It hasn't happened yet, but it will happen down the line. You can't have both sides of that.
Well, the market will love that because the Fed will cut. So
exactly. And I think that's what he was saying, right? You know, we're going to look past this tariff-induced inflation if the labor market weakens, and that's a bullish argument from Waller that we've not heard from Powell, and that was the more excitement, you know, after he said
that. But that means you buy euro, isn't it? Because the ECB is cutting more aggressively. Isn't that a support for the European equity story?
It is a support for the European equity story, and
despite the fact the euro is going up.
I mean, exactly. I mean, you've seen it over the past month. The euro is strong. European equities are stronger. European assets are doing fine. That doesn't mean that, you know, everything is rosy. We still hear companies saying we're in recession in Germany. That recession is very possible in Germany as well if we get a cut in global growth. But you know, it's all relative trade, yes. And you want to be diversified, so you want to be in Europe, and everyone was in the US before. So it's kind of there's an adjustment there that needs to be made.
But I mean, I wonder how much that euro strength point is coming up in the earnings we've seen so far, Charlie.
Well, this is becoming something of a headache for a lot of these European companies, right? Because you think Europe, but they earn a lot abroad. Michael, as you were saying, when they return, say, those dollar earnings back to the U.S., that currency conversion is not great for them. So it'll be fascinating to see if they talk about that kind of FX headache that they're having with dollar weakness.
Let's park the markets. We're done, okay? I feel it's been a short week, 4 days, but nevertheless
it's been very long.
It's felt like a very long week, and it feels like we may be in for a few more of those. I think we need a weekend to meditate and figure out what is happening. There is a lot going on this weekend, though. In terms of maybe the main event, it is, of course, going to be what is happening in Vatican City. The Pope's funeral is going to be happening this weekend, which is a gathering as well of global leaders, which is something that it is worth bearing in mind. You're looking at live shots of St. Peter's Basilica in the Vatican City. That will be the centre of attention. Here in London, though, we are running marathons.
Yeah, do you know what? I'm going to tell you, I live somewhere along the route. There is nothing more depressing than watching 50,000 people run past your front door, all proving that they are fitter than you.
Yeah, marathons are too far, in my view. But
I agree.
Anyway, I'm sure Val would run them. You must have run them.
Oh, no thanks. No, thank you. Too much pain in the knees.
Yeah, precisely. Exactly. And certainly a few days afterwards, you'd be hobbling around. Masika, I suspect, could probably run a marathon. Certainly faster than me.
Do you know what? Let me tell you, Alex Morales, our colleague, is running it. So if you want to sponsor someone, there you go.
Football's going to be interesting. I think Liverpool are 1 point away from winning the Premiership, so that's going to be worth watching out for as well. So there's some great sport coming up. But I suspect that the events are going to be dominated, actually, by what happens in Vatican City this weekend. And you've got Donald Trump's coming. Zelensky's coming. There's all kinds of people there. So actually, in some ways, while we pay our respects to the Pope, then actually I think this is going to be a fascinating event to watch.
The last time a Pope died, it was the height of the Iraq War.
Yeah.
You had Blair there, Bush there, all these world leaders. This is an important diplomatic moment as well.
Absolutely. Okay, that wraps things up. We are done for the week. We'll see you next week. Guys, thank you very much indeed. Fantastic way to finish the week. The Pulse is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
China readies emergency measures to protect its economy from the trade war. At the same time, Bloomberg learns that Beijing may suspend tariffs on certain imports from the U.S. Now, markets set to end the week on a high, boosted by comments from 2 Fed officials indicating that U.S. interest rates could be cut. Plus, Alphabet earnings come in better than expected, boosted by Google ad revenue and an investment in SpaceX. Now, first thing is first, we have a lot to get through on the program today, but markets, again, I guess they're on tenterhooks on what happens with trade. And European stocks, but also Wall Street futures, did pair some of the gains. So a lot of them are still up, but a little bit less than they were half an hour ago. And this is because China has been downplaying in the last 20 minutes or so progress in its trade dispute with the U.S. So markets saw tentative recovery, risk appetite. But again, if you look at European futures, that's being dampened a little bit. And that's also thanks to the White House's conciliatory tone towards China. That put assets up. Let's go to the European markets map. But then a little bit of pressure on the downside. Watch out for gold. We have a wonderful commodities analyst to give you everything you need to know on gold. Dollar also strengthening, yen and Swiss franc retreating again. Investors demanding for non-U.S. haven assets seem to be waning a touch. If you look at the CAC 40, it's gaining some 0.6%, and the FTSE look 0.2% higher. A couple of other things we need to watch out for, mainly because of earnings either today or next week. Alphabet pre-market 5.2% higher, and then Intel will also have our Charlie Wells with a full roundup of some of the main news, including Intel. If we look at pre-market, Intel is down 5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg understands that China is considering suspending its 125% tariffs on some U.S. imports as the economic costs of the trade war weigh heavily on certain industries. Now, goods being considered for potential exemption include medical equipment and some industrial chemicals. Meanwhile, Beijing is vowing to fully prepare emergency plans to ward against increasing external shocks. Joining us now, Brendan Murray, who coordinates our global trade coverage. So, Brendan, there seems to be a conciliatory tone from the White House, but actually China being much more tentative.
Yeah, exactly. I think this is a small but initial sign that China is feeling some of the economic pain. It's listening to its importers, and it sounds like it's about to offer some sort of conciliatory move to the Trump administration that would ease tensions even just a little bit. We have heard China for several weeks now pretty much ignore the U.S. Until yesterday when they said, we will sit down with you, but you have to remove all these this very high unilateral tariff, something that the Trump administration would be unlikely to do in the short term. So they're still at an impasse apparently, but it seems like the progress is moving in the direction of de-escalation.
Brendan, what's the next step of this? Again, if you look at de-escalation, is there a price conference that we should be watching out for? We also understand that China could do a lot more on the economy.
Yeah, I think it's the ball is in Trump's court now. As he said last week, it's in China's court. China has come back and said, here are the conditions that we will that we have for negotiation. So we'll see if President Trump is willing to put his money where his mouth is when he says he'd like these talks to happen, and that's going to take, as China has demanded, a lowering of these tariffs. The economic shock from those are going to hit both Asia and the U.S. In very short order.
Brendan, what do we know about China exempting some U.S. goods from again, tariffs as costs rise? Do we know exactly what they're planning to do on what sectors or what companies?
Well, there's some key products used in Chinese manufacturing, in the manufacturing of plastics. There are and some other more heavy machinery equipment that China's companies need to maintain their production. So there's a long list of potential exemptions that's circulating, but whether those actually get carried out, we'll have to wait and see. But at the moment, it's just a proposal.
Brendan, there's a lot of talk about the White House, if not, regretting the tariffs, actually having second thoughts on how they went about it. Is this something that you're hearing, or is it something that's pushed by the opposition?
Yeah, it's the White House almost 4 weeks ago sort of came out with this reciprocal tariff plan that surprised the markets and economists for how severe it was. This was going to cause a decoupling of the U.S. and Chinese economies, and it was going to hit allies as well. And I think that there's some recognition that decoupling, and Treasury Secretary Bessent has said so, that decoupling is not the goal, as something less than that is, and that the U.S. will need its allies in this struggle to rebalance the U.S. economy against the Chinese economy. So it sounds like there's some deals being negotiated or talks underway to get deals on the table. That things are moving in a more dovish direction when it comes to tariffs. That the Trump administration has essentially realized that it may do more economic harm to the U.S. economy than good.
Brendan, thank you so much. Brendan Murray there with everything, of course, that we need to know on trade. Now, divisions have emerged between the U.S. and its allies at a flagship international summit on energy security. Speakers, of course, outlined a vision to include renewable fuels in the shift to a sustainable energy future, but Washington's representative repeated the Trump administration's opposition to restricting energy sources in the pursuit of net zero emissions. Well, I'm delighted now to be joined by Leila Ben Ali, Morocco's Minister of Energy Transition and Sustainable Development, who was at the event, who was, of course, co-hosted by the IEA and the UK government that I also helped to chair. So thank you so much, Minister, for joining us. First of all, what's the scale of investment that you see for renewable energy in Morocco going forward?
Well, thanks, Francine, for the invitation. In Morocco, we're still pushing ahead with our energy investments, including the renewable energy. It's a key pillar of our energy strategies, and we are seeing that today you have more than 70% of global trade that's GDP dependent, compared to less than 5% in the 70s. So the whole issue around energy security is being redefined. For us, our energy strategy since 2009 has been stable and the same. Renewable energy, key pillar of our strategy, more than 52% of our target that we will reach in 2026, much earlier than 2030. That's roughly plus 15 gigawatts of renewables that we will add, roughly $12 billion of investment between now and 2030, 80% of it in renewables. Second key pillar is energy efficiency, and third key pillar is regional integration. Whenever stubbornly pushing for energy integration and cooperation when there's someone on the other side.
And Minister, at the same time, does it actually go with plans to phase out coal?
Yes, absolutely. No, absolutely. Because the thing is, Morocco is a net fossil fuel importer. And if it means, if all the, I would say, the trade tariffs that is happening today, it means something. It means that if Morocco has to be the last man standing, investing in renewables, pushing away from fossil fuels, well, then it's music to my ears, because it means that we are showcasing that we are the lowest cost energy supplier, renewable energy, that we are the most connected to the Europe, Africa, and Atlantic basin. We provide the lowest cost delivered energy supply, including to the UK. And also, we are a land of reconciliation where we can have investments in research and development in clean tech.
Minister, can you just update us also on the latest planned LNG import terminal?
All right. I mean, that's also a key part of our strategy, regional integration again. It's roughly $6 billion of capex that we are injecting in gas infrastructure, making it future-proof so that it can actually also make sure that we provide hydrogen, that we can transport hydrogen. Again, Morocco as the lowest cost hydrogen supplier, including to Europe. There's nothing that can beat pipelines when it comes to transporting molecules. And the purpose is to link it to $25 billion of capex to be invested in the what used to be called the Nigeria-Morocco gas pipeline, now the African Atlantic gas pipeline, to get to Africa the molecules it deserves for its development.
So do you already have a specific timeline, actually, on when the terminal will be built, will be starting and finished, but also where the supplies will come from?
Yes, we are pushing ahead for the first entry point for LNG in Morocco in the Nador terminal. So we are really hoping that we will get a first molecule around between 26, 27. The key is already ready and all that. Second key point of entry will be on the Atlantic coast in Morocco, and we're hoping to link all this to Dakhla, which is a major region for us with the great combination of great solar and wind capacity factors and potential emerging region for heavy, hard-to-abate industries as well.
And Minister, I mean, this is a huge project, something that I know is very close also to what the country wants to do. I mean, the LNG terminal, is it regasification and also a storage, for example, for floating storage? Is that part of it, or how big will the complex be?
So for now, it's the first entry point will be an FSRU or an FSU, so floating, definitely. A second entry point might be, and potentially will be, a large regasification on land terminal. But the whole point, what I would want to insist on is this is very much preparing for flexibility in the future. We want to continue to have an agile and flexible strategy. So that's why we are pushing for a first entry point in Nador, close to Europe, and making sure that we have access to the international LNG market that provides a lot of optionality. And to answer your second question, where the supplies will come from, well, that's another flexibility that the LNG market has provided compared to pipeline gas. It means you can get access to the international and LNG market.
So are there discussions ongoing now on when the supplies would come from, or is that for a later date? Because again,
we already have contracts already in place, because if you remember, back in October 2021, we were all gathered in Glasgow. This was like 4 months before the Russia-Ukraine war. I was the only one on stage saying, well, if you want us to invest in renewables, we need gas for intermittency. And at the time, we already started discussing, and we made sure that we had at least a 10-year contract, and making sure that we reverse the pipeline with Spain that we already have. We are the only African country interconnected with Europe, logistically, culturally, but also gas-wise and electricity-wise and bidirectionally. So we made sure to reverse that gas pipeline to have access to the international LNG market back in 2022. So we already have contracts in place.
Minister, when you look at the energy transition plans for Morocco, are they been upended or moved around because of what we're seeing with tariffs and this new geopolitical order?
No, absolutely not. I mean, for us, this has been the case. We have 30 years of experience in attracting the international private finance. We have 30 years of experience in international energy, environmental, and climate negotiations and diplomacy. So for us, it's very important that we stay the course. And if at the end of the day, with all the trade turbulence that is happening today, Morocco emerges as the last man standing, investing in the same energy strategy that it has since 2009 when it was launched by His Majesty, then so be it. It's music to my ears. My job will be done and mission accomplished.
Yes, but you need actually support from the region as well. So it's better if everybody works together, I guess, towards a unified transition.
That's where regional cooperation is a key part of our strategy, and that's why we make sure that with our partners, be it in Africa, Europe, the Atlantic Basin, and Asia, we try as much as possible to have win-win partnerships and a new generation of partnerships. If I take the example of China, that's a best case study where you have more than 70% of clean tech value chains being either localized or having secured equity assets in various parts of the world. So making sure that Morocco, that has more than 60 FTAs with the various countries in the world, can concentrate some of that, I think, is key in the international cooperation.
Minister, I know you have to go back to Lancaster House, where there's this, Future of Energy Security Summit that's being held by the IEA and the UK. What's your biggest hope in terms of actually achieving something concrete together?
Well, a few things. I mean, I think the first key, Morocco has always been an advocate of multilateralism and an advocate of international cooperation. But when we look at the history of, for example, we have more than 250 multilateral environment agreements and COPs. The key point here is to ensure that those multilateral and bilateral agreements are take into account business opportunities, take into account the fact that we need to build synergies between those environmental agreements and climate agreements, and ensure that our energy strategies go hand in hand. So what I would want to see is a real redefinition of energy security, taking into account not only securing the molecules and electrons, that's a 70s mantra, but now moving to the 21st century and making sure that we secure assets and value chains and productive and consuming assets.
Thank you so much for all of your great insights, Leila Ben Ali there, Morocco's Minister of Energy Transition and Sustainable Development. Now coming up, global stocks on track for the best winning streak in more than 2 months as trade tensions cool. We'll discuss all of this with Maria Moniki from M&G Investments and Morgan Stanley's Amy Gower. We'll also talk gold. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest Here's newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Earnings season is here. European earnings kick into high gear.
Beginning to gather a little bit of momentum.
Bloomberg is first to break the numbers.
Netflix, Hermes,
SAP as well.
ASML reporting a big miss.
With the smartest insights.
Is it possible for the earnings story to dominate?
Look at the resiliency behind the numbers.
Earnings may even flip into negative territory.
The volatility of earnings really matters now.
It's like a marathon of earnings.
Continuing coverage on Bloomberg. Context changes everything.
Global stocks on track for the best winning streak in more than 2 months. It comes as trade tensions cool and after Fed officials indicated that they'd be open to cutting rates earlier than anticipated.
Wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward if the big tariffs in particular come back on. If I see a significant drop in the labor market, then the employment side of the mandate I think is important that we step in. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Well, joining us now, Maria Monique, a fund manager at M&G Investments, Amy Gower, metals and mining commodity strategist at Morgan Stanley. So thank you both for joining us. Amy, we're absolutely obsessed with gold. I mean, it's not me, it's like, China, central banks that are purchasing. How do you explain really the rally and what's motivating this pace of gold buying?
Yeah, well, the pace of gold rally has certainly picked up recently. So it took us about 6 months to get from $2,500 to $3,000 an ounce. And then we've done $3,000 to $3,500 in about 5 weeks. And actually, if you look at the volatility, we even did a move that big in about 8 days. So we're moving very, very quickly. I think the key thing that's driving this at the moment has really been that safe haven demand. So yes, the central banks are buying, but they have been buying already for 3 years. That pace hasn't really changed. The new money that's coming in is from the ETFs. And this has been one of the fastest quarters on record in terms of ETF inflows. And that's really that safe haven demand. That's what's kicked it higher recently.
Yeah, and at the same time, Maria, I mean, there's a lot of questions on how treasuries have been behaving and also how you price in that risk premium for U.S. assets, full stop.
Completely. I think the last 4 weeks have been quite exceptional in terms of the behavior that we've seen in U.S. Treasuries, because the very first week around the 2nd of April announcement, we have seen some diversification properties across Treasuries, but that has quickly reversed the week after that, where we see the strong sell-off across all bonds, really. It wasn't just specific to U.S. Treasuries. We've seen gilts as well selling off. We've seen bonds selling off. But after that, bonds, for example, have acted again as a diversifier. They have retraced those losses. They have gone back to lower yields, whilst U.S. Treasuries, especially in the long end of the curve, have kind of remained to higher yields. So they haven't really fully, I guess, responded to that need of diversification for multi-asset portfolios in this phase. But I would also say that what we're observing on risk assets and on equities as well, it's potentially not a full risk off, which will be the situation where you will see potentially developed market bonds act like that safety. In fact, if we look a little bit through a longer time frame, a lot of the sell-offs we've seen in equity markets, and especially after the more recent rebound, we're not really miles away from where we were in the middle of last year. Because at the end of last year, beginning of this year, end of last year in the US and beginning of this year in Europe and China, we had a very strong push up in prices. So it's very difficult to exactly assess how much risk is really priced in today in markets.
Yeah, I think the markets don't know themselves because they're trying to figure out some of the unpredictability of whether you have tariffs or not. I mean, when you look at Chinese demand for gold, it's still pretty strong, but is there a point where high prices actually start seriously hurting demand?
Yeah, absolutely. I mean, one of the things that's been quite encouraging through this rally is if we do look at that Shanghai gold premium, the premium over the London price, it has kept rising even as gold has risen. So that has suggested that that demand is good. We saw, exchange withdrawals picking up again in March. So all signs so far healthy, but that's really been the investment demand, whereas we are probably seeing a bit of weakness on the jewelry side. And so jewelry is a very, very big category. On a global basis, it's about 40% of gold demand. It's nearly 2 times as big as those central banks. So And India and China are your key areas. So I think especially the speed of the move is important. That's where, if it's suddenly moved up very quickly, that's where a consumer's going to go, oh, wait a second, do I want to do my purchase now? So I think we are already seeing that, and I think that will continue.
But is it tracking Fed expectations?
The gold price?
Gold price.
I would say not so much at the moment. Gold seems to be disconnecting from macro factors. So for the first, until Liberation Day, essentially gold was moving inversely with real yields. It's now moving in tandem with real yields, which is usually when we see it's either physical demand or safe haven demand. That's when we see the situation. That's what we're seeing at the moment. And I think the dollar is also being quite a tailwind. Normally, gold and the dollar would rally at times of safe havens simultaneously, but maybe gold is even getting some of those safe haven flows that might have historically gone to the dollar.
And Maria, again, everything seems to be moving on expectations of the Fed, and that's moving quite quickly on growth expectations, right? And it feels like these tariffs, we don't know what happens, but at the moment that would hit GDP more abruptly than inflation.
Yeah, this is certainly what we can read both from market reaction as well as some of the latest forecasts that have come out. For example, from IMF, we have seen a reduction on expectation for U.S. growth quite significantly for 2025. And yes, I think the market has reacted with a worry around growth more than around inflation. And that is probably correct, because these type of tariffs are more likely to act as a sort of tax. But it's important to highlight that there are a lot of direct consequences to the tax, but there are also a lot of indirect consequences. And what happened in the 2nd of April was a little bit like playing pool and having a break move where, you hit the balls and then kind of see where they land. But it's a long-term game. We know that historically to negotiate a trade deal, even just between two countries, have taken years. And now we're talking about multiple countries, and we're expecting 90 days. I think, we should be ready for more volatility in the market and for this trend to continue for a longer period of time until we get to a resolution. But obviously, markets will try and find, the answer today or tomorrow, and then we'll move with that. So I think that would also potentially offer opportunities for investors from a tactical standpoint.
I mean, it's interesting. Market psychology and actually what investors are thinking right now is extremely interesting when you look at certain points. So the way they behave, for example, in gold, I mean, are they willing to give up yield in gold just to have that haven?
I think at the moment, yes. But I have to say, it doesn't feel like this is a big sort of investor inflow, particularly into sort of gold futures. So if we look at the COMEX positioning, it's actually been coming off. And we're back where we were about May last year. So it's really been those ETF flows, which is a mixture of investors and then also perhaps that retail side as well. So I think eventually that yield question will start to come into play again, and that's I think the key thing we need to watch. We've seen 3 days now of ETF outflows. I am tracking that very closely because that's really what's got us here, and that's what we need to continue for us to see gold keep rising.
Do you see a change in behavior, actually, of how much is demanded to take certain, for example, when you look at treasuries or just actually the bond move in general? We have a great piece on bond vigilantes, but does investor behavior on some of this, fixed income change for the longer term?
I think we have seen investors being more reluctant to engage with developed market bonds, in particular treasuries, because volatility has been ongoing for a long period of time. I mean, we have navigated all the way through higher interest rates, and the higher for longer phase was also disappointing for some investors. So I think some investors are losing faith on these assets in order to be able to diversify. But we know that when that happens, it might be actually the right time to actually be engaged, because that's when they start working, and they do work when risk off is at its highest, peak uncertainty, and we potentially are not yet at that peak uncertainty level. I think also the other thing that's been very interesting to note is that that increase in yields in the middle of April has been across the board. So yes, there was an element of U.S. treasuries, but has brought other assets with it, so gilts and bonds. So that has been a good opportunity, I think, for investors to add to, for example, bonds exposure, which could be a good diversification for portfolios.
Thank you both for joining us, Maria Monique and Amy Gower. Coming up, we talk a lot more actually about banks, but also we focus on tech and Alphabet. This is Bloomberg.
in case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London, and these are your top stories. China readies emergency measures to protect its economy from the trade war. At the same time, Bloomberg has learned that Beijing may suspend tariffs on certain imports from U.S. Markets set to end the week on a high, lifted by comments from two Fed officials indicating that U.S. interest rates could be cut. Plus, Alphabet earnings come in better than expected, boosted by Google ad revenue and an investment in SpaceX. Now, in the last couple of minutes, we had some breaking news out of the U.S. Well, actually, it's a Bloomberg scoop saying that a U.S.-India trade agreement is under discussion. And we understand that the U.S. is seeking an India trade deal on 19 categories. That would include greater market access from farm goods, e-commerce, data storage, and critical mineral. Again, it would be a first step towards a deal that may then help India evade higher tariffs on its goods. Now, if there is something concrete or if there is some kind of agreement, this, I'm sure, would be welcome relief, not only from both countries, but from a lot of negotiators around the world that also have to deal with the U.S. and the Trump administration in trying to figure out what the next phase for their tariffs is. Now, in terms of reference for a bilateral deal, again, this is a Bloomberg scoop, which was finalized by both sides this week. It could also include trade in goods as services. Again, these people that we've been speaking to have asked for the moment not to be identified, as the discussions are private and ongoing. Now let's move on to tech and Alphabet earnings and the rest of today's tech news. Now Bloomberg's Charlie Wells joins us. Charlie, first of all, let's start with Alphabet. Pre-market, it's gaining 5%. I mean, they didn't have bad results, but they have a little bit of investment coming their way.
That's exactly right, Francine. So these are results that were better than expected, and they came on the back of strong search advertising revenue. Now, this is important momentum that Google needs as it seeks to justify its investment in artificial intelligence, which it has certainly been doing quite significantly. We also, on that AI front, saw strong consumer demand in Google Cloud, which is also a step in the right direction as they try to justify why they're making these big investments, which have come under question recently. So this was a strong report, and we're seeing a strong response in the market.
Charlie, how much detail did we get on Intel's strategy in the earnings call as well?
Francine, it was almost a story of a very different tech company facing very different challenges. Now, they posted a forecast for the current quarter that was worse than expected. Analysts also had been hoping for more of a specific strategy from Lip-Bu Tan, the new CEO of Intel who took over just last month. He talked about the need to slash jobs, to cut through management, and to bring employees back to the office, but he didn't give the sort of detail details that analysts had really been expecting and hoping for regarding competition, regarding external threats, and AI, in which Intel has ceded ground to the likes of NVIDIA.
Charlie, Bloomberg has also learned that Apple aims to import most of the iPhones it sells in the U.S. from India. What do we know?
So what we know is that if Apple were to do this, this would be a strategic pivot out of China and towards India, of course, on the back of these trade tensions, but also geopolitical risk. But this would be a very difficult goal to meet. Apple would need to roughly double the amount of iPhones that it produces in India in order to make this happen. So a strategic pivot, but something that seems increasingly important for this company as those trade tensions ratchet up.
Charlie, thank you so much. Charlie Wells there with the very latest on some of the tech earnings. Now turning to banking, which will be under the spotlight next week as the bulk of the big European banks report. First quarter earnings could meet or exceed expectations. Analysts warn of looming downward revisions for many lenders. Now joining us now, Anke Reigen, co-head of global financial research at RBC Capital Markets, and Paul Davies from Bloomberg Opinion, who covers banking and finance. Thank you both for joining us. Paul, I mean, earnings are important because they give some indication of of how much pain they're feeling from tariffs, how much pain they're feeling from, possible loans going sour or just investors not doing M&A and capex. What's the level of stress amongst financial institutions and banks because of the tariffs in the last 60 days?
Well, I mean, what we're going to get when banks report next week is a lot of is commentary on the first quarter, which is before most of the madness really happened, right? So the numbers are still going to be quite good, especially on the trading side. In terms of the impact on actual credit demand or cost of credit or credit risk and that sort of thing, it will be much more important to hear what the outlook is from these executives about how conditions have developed since the 2nd of April and how they see things developing really over the second quarter and into the rest of the year.
Yeah, and I mean, this kind of goes to the point that, BNP Paribas joined, Wall Street banks in frankly doing really well on equities, but investors are disappointed because they worry about, trade war worries and some unpredictability from the U.S. Is there any European bank that will be a blowout?
Well, I mean, I guess as Paul said, as Q1 is a bit of a history now, and we were looking for the outlook statements. And frankly, I'm quite relieved finally we get some tangible, I mean, the past is always following headlines, and now we get some tangible commentary from banks about their outlook. And I mean, to the point, I think it will be very different by bank, the outlook statement. It depends on your interest income gearing. It depends on investment banking. There'll be lots of questions about loan losses. I think it's more like a check-in point in what the banks are currently seeing rather than an adjustment in numbers. And I think the banks that are more geared like a steeper curve have the investment banking. They're probably somewhat better positioned, but clearly it's an area of uncertainty, and we're looking for data points.
Which lenders, Anke, have the worst business mix for the current situation?
Well, I suppose if you don't have diversification with investment banking, you wouldn't get the trading part. You'll probably be looking for a geographic mix as obviously a function of as well if you think tariffs in Asia, US slowdown, so geographic mix plays a role. But clearly, I think in the rate gearing, we're looking for banks that have a gearing to a steeper curve rather than short rates. I mean, in terms of asset quality, I think it's too early days. Q1 will not show any signs, and it's more about forward expectations. And I think it might be a small uptick, but not meaningful. And a lot of banks still have buffers. So it will be very much dependent by bank and how the outlook develops, quite frankly.
But if you're a big investment bank, you're probably wishing you had more of an equities exposure or trading exposure at the moment.
Yeah, absolutely. And, Deutsche Bank obviously got rid of their equities trading division a few years ago. Everybody else is showing fantastic numbers on equities. I think the US were up, on average, kind of nearly 30% or something. BNP yesterday, huge growth in equities trading, and they've been making great strides there in recent years. So that's going to be great for UBS. It's going to be great for Barclays. It's going to be great for SocGen. The FIC side, the fixed income and currency side has been just kind of generally quieter or not showing so much growth compared to last year. So, yeah, I mean, for Deutsche Bank will be the one whose trading business might not be quite so glowing as the rest.
But are you worse off if you're a U.S. bank, Paul, than you're, let's say, an Italian bank, because there was much more premium attached to the good that a Trump administration could do to them in terms of deregulation and things like that?
Yeah, absolutely. I mean, I think, the US stocks have fallen a lot on the realization that life is going to be much rockier there. European banks have been outperforming spectacularly or doing very well for a couple of years already. I mean, I think some of the really interesting things will be what banks see in terms of reinvestment in Europe and kind of gearing to doing more lending within Europe. BNP was very positive about this yesterday. And the other thing I've been asking people about is trade finance, which is obviously the thing you expect to come most under pressure in a trade war, obviously. But in fact, it's been really quite healthy. And again, BNP yesterday, when they reported, were talking about how trade financing has been higher volumes than they would have expected, and it's not because trade isn't getting hit, it's because people are diversifying the sources of where they're getting supplies from and where they're trying to sell to.
And are you expecting provisioning from European banks, or is it a little bit too early? Do we need to just wait and see?
I mean, so far we've seen some banks, or a few number of banks, booking some procyclical provisions, but I think it's going to be very much bank dependent on how conservative they want to be. I mean, a number of banks also still have some remaining buffers, so they might decide not to do so. I think it's probably more maybe Q2 once there's more visibility, but for now, I mean, we have seen larger cases on the corporate side already last year, so that might remain a theme, but very little in terms of procyclical provisions.
So some say, probably the most optimistic of this world, say that a trade war is good for Europe on two fronts, that it forces a capital markets union or Europe to get its act together, but you could also see pension funds and others shying away from big U.S. institutions to move into actually investing with European institutions. I mean, could that happen?
Yeah, I mean, it's following up from a point Paul made as well on BNP yesterday. I mean, clearly there is the investment part that's been coming into Europe where you could see some GDP upgrades. You see the capital markets union, more securitization, SRTs, investments, pension reform. I think the key is it's a big concept at the moment. Right. So, and the implementation is key, and it probably won't be coming in very quickly, but there seems to be a pulling together, which in the long term could be positive, and that against the backdrop of a steep curve, which we really haven't had in Europe for a long time, could be supportive once that fog has lifted on where we are going.
Do you think, Paul, that U.S. big banks and Wall Street will lose business because of the trade war?
That's it's a really interesting question. I mean, I've been asking lots of European bankers this, and they've been optimistic about the idea that they might win more, and I think, perhaps almost on a sort of a patriotic basis from European CEOs looking to do business with local partners rather than American partners. I mean, I guess the longer the trade war goes on, the more there is a threat that Europe might start thinking about, services tariffs against US businesses. I mean, it seems to be, distant for now, but that's where the US has a trade surplus. So, if the US is really going to come after Europe, why shouldn't Europe go after the US in that way?
I mean, I know there's something that Paul is working on almost on a daily basis, which is what will happen to UBS and how will they regulate it and what kind of capital demands will Switzerland put on it. Where do you see that landing? Because UBS also came back fighting.
Yeah, I mean, it's a bit like they're doing really well on the things they can control. So it's it's really quite sad that there's this large overhang about the too big to fail rule, the quality of capital debate. I think where it's land, it's very difficult to say, but clearly there are a lot of stakeholders involved. So I hope a balance between all involved parties will be found, and there's a solution of a phase-in. I think at this stage we're in a position, it's most important to know actually what will come in, and then reset and move forward rather than having this uncertainty that's already a year above the UBS stock. Where it lands, it's unclear, but clarity is really important for the company to move on.
And Paul, let's finish off with Italy, which is like a test case for a lot of reasons. So we have Generali. You wrote a great opinion piece on Generali Unicredit and the fact that whatever the government decides for these two big companies will be a test for also its future. But it's complicated because you have shareholders, you have shareholder agreements on both sides. Actually, it feels messy.
Yeah, and we were just talking about the optimism of banking, capital markets union, and so on in Europe to kind of draw together and make Europe stronger. This is what's going on in Italy is dragging all of these financial firms back into being bogged down in a much kind of like more old-fashioned, very nationally focused, very nationalistically interested, power struggle within finance. And after yesterday, where Unicredit They had this intervention from the government on their BPM deal. Then they've decided to vote kind of in line with the government's allies over the Generali board. And now the discounts for both, UniCredit's bid for BPM and Montepaschi's bid for Mediobanca have widened since then. It's people just don't see this as a good set of outcomes, I don't think.
Yeah, so we'll be following it very closely. Thank you both for joining us. Anke Reingen there, the co-head of Global Financials Research at RBC Capital Markets, and our very own Paul Davies from Bloomberg Opinion. Now, Canadians vote in an early general election on Monday. It was called by Mark Carney after he was elected leader of the Liberal Party last month. Here's what to expect.
Prime Minister Mark Carney, former governor of the Bank of Canada and the Bank of England, leads the Liberal Party into the election after taking office last month.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners.
Carney's rival is Pierre Poilievre, the leader of the Conservative Party. A few months ago, Poilievre was riding high. Polls showed him heading for a landslide victory, potentially securing a two-thirds majority in the House of Commons. But things have changed. Since Carney entered the race, the political landscape in Canada has shifted. Poilievre's lead has evaporated, and both the New Democratic Party and Bloc Québécois have lost ground. If the Liberals don't win a majority, however, they'd need support from the NDP or Bloc Québécois. Complicating matters, U.S. President Donald Trump's aggressive trade policies, particularly new tariffs on Canada, are dominating discourse about the election. On top of that, Trump's suggestions Canada could become the 51st state in the U.S. have drawn more attention than domestic issues, and those comments have changed the political climate. Both Carney and Poilievre have taken a strong stance against Trump's provocative rhetoric and policies.
The president is betraying America's closest friend and attacking our economy, proving once again that Canada must end its era of over-dependence and weakness.
For Canadians, this election is a referendum on their economic future. The outcome could determine how the country addresses these challenges and how it positions itself on the world stage.
And of course, we'll have full coverage of the Canadian election next week. Coming up, the Trump administration pushes for a peace deal in Ukraine. We'll have the details of the latest U.S. proposal to end the war. Tomorrow, also, world leaders will gather at the Vatican for Pope Francis's funeral. Tens of thousands of people continue to pay their last respects to the Pope at St. Peter's Basilica. These are live pictures.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, we'll talk more about markets shortly with Simon Kennedy, our senior executive editor for macro markets. But first to geopolitics. And Bloomberg understands that the U.S. is set to demand that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Now, the move would push back on Moscow's insistence that Ukraine largely demilitarize as a condition to end the war. President Trump is optimistic a ceasefire can be achieved, despite Russia's continued strikes on Kyiv. Now, he said yesterday that he's using, quote, a lot of pressure on both sides.
Putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us that?
We're putting a lot of pressure on Russia, and Russia knows that, and some people that are close to it know, or he wouldn't be talking.
Now, for more, let's bring in Rosalind Matheson, Bloomberg's EMEA news director. It's confusing to me how close actually Donald Trump and Vladimir Putin are, and whether he is putting pressure or he's not putting pressure. Ross, how do you see the situation?
Well, he's clearly a bit frustrated. And again, he was quite critical of Russia for the latest airstrikes that were done yesterday across quite a large amount of territory in Ukraine. He's frustrated because there's not been a ton of progress towards a deal, and he very clearly wants to get one. So he is not just leaning on Ukraine, he's also leaning on Russia here. And we know from our reporting he's also got some lines there as well with Russia. It's not just Ukraine. He's saying, well, Ukraine should have the right to have its own military in all of this. But it's interesting to see him talking about, again, defense industry and the Zaporizhzhia power plant. And those are also important for the US because it's quite clear that Donald Trump wants to have access to Ukraine in the aftermath of this conflict. And he particularly wants to have access to Ukraine's economy in the aftermath of this conflict. And so you can see there is some self-serving parts of that also for the US, but there is that sense of frustration creeping in. We know that the special US envoy, Steve Witkoff, has apparently just landed in Moscow, and he'll probably meet with Vladimir Putin. He tends to meet with Vladimir Putin when he's there. Maybe we'll get something out of that. But you can see we're getting towards May, and at this point, there's no formal deal.
Ross, I mean, tomorrow, and we've been looking at live pictures from St. Peter's Basilica for the funeral of Pope Francis, which will happen tomorrow. I mean, this is also a world event because you have many world leaders showing up, including President Zelensky and President Trump. Do we know if they will meet?
Well, we don't know. And we do know that Donald Trump, is only there for a very brief amount of time. I mean, he's going to fly in probably and fly out again shortly afterward. You can expect he's not going to spend a lot of time on the ground. So does he even have a window to meet the Ukrainian President Zelensky? We know that Zelensky would like to meet with him, but so would a lot of other leaders who'll probably be there, obviously for the Pope's funeral, but also with the opportunity to spend a little bit of time with Donald Trump on a bunch of issues, including trade as well. So is there a window for an early morning meeting with Zelensky? Possibly, but we don't know that for sure. We do know it's one thing the Ukrainian president would no doubt like to happen.
Okay, let's also shift the focus to the IMF spring meetings in Washington. Banking leaders and policymakers downplaying the prospect of a looming financial crisis, despite warnings that the U.S.-led trade war threatens global stability. So let's also bring in Simon Kennedy, our senior executive editor for macro markets. I mean, Simon, no one's, again, slept in 3 weeks because of all the market volatility. Like, where are we on first of all, the bond vigilantes, on, how the Treasury move maybe focused the minds of the White House?
Yes, so I think we've seen a little bit of stability in the last few days, certainly since that reversal from the president, the introducing of the 90 days. But there's still some great skepticism within the bond market about whether how honest a broker the president is on a whole range of issues. Just in the last few days, we had a flare up about Jay Powell and his future, and then that was somewhat clarified. But you've got a combination of a trade war, you've probably got tax cuts coming, you're not sure what shape they will take, you don't know what the trade war plus the tax cuts mean for inflation, mean for the economy. Throw in some lingering doubt about the independence of the central bank, and if you're a bond market trader, you're probably asking for a little bit more on the yield to invest, and that's what we're seeing, this kind of lingering, lasting perhaps lift to bond yields.
Yeah, I mean, does the president reverse course? His popularity, I think I saw some recent polls, was also going down. Do we know that the president cares about that and therefore changes also prospects for the economy, or is that wishful thinking?
Well, he says he doesn't care, and he says he doesn't really care about where the market is either, although it's quite clear he's been watching at least the bond market of late and paying attention to that. And it seems that he does care what companies say, because big US automakers are going into the White House one by one to say to him, what you're doing is going to damage our companies and damage our ability to hire people, and that will affect the US economy. So it's clear he is listening to some of that. But equally, you can see, as Simon was saying, the volatility in his decision making, and it's very difficult as a result to know what's going to stick from day to day, or even, frankly, hour to hour. And so making investment decisions, working out how to interact with the US if you're another country, the leader of the country, becomes very, very difficult. But you do know, at least in all of this, the one thing that is clear is if you can get in Donald Trump's ear in the right way, in the right minute, you do have a chance of getting him to change his mind.
Yeah, I mean, there's been huge moves actually on the back of all this uncertainty in gold, as you say, treasuries. I mean, some of the other havens like yen and even Swiss franc. I mean, we've seen, I don't know how you describe, the shift. Is it a dramatic shift out of U.S. assets and then it's kind of like coming back, tentatively, or are we going to keep on seeing these big shifts?
Well, yeah, the question is this lasting? Does everyone get through this? Traders at Goldman Sachs call it headline roulette, But if you look at how the stocks have performed, if you look at how the dollar performed, if you look at how treasuries have performed this 100 days just next week, there's definitely a question about both U.S. exceptionalism and some skepticism towards the administration's kind of grip on markets. And yeah, so once the money leaves, it's harder to come back in. There is an absence, though, of other safe havens. Debt markets aren't as liquid as they are elsewhere, as they are in the US. Currencies aren't as powerful. You look at China, that's a currency managed by the authorities. The euro still doesn't have that depth of debt market beneath it. So the safe haven status is definitely in question. Whether it's truly over is perhaps disputable.
Even for treasuries?
Even for treasuries. They traded recently like a risky asset. And lots of people, Larry Summers pointing out that they're trading like emerging markets. Usually treasuries, whatever the issue, if you look at after 9/11, you look at the financial crisis, treasuries went up at times of risk, even if that risk was based in the US. In this occasion, you have risk coming from the US and treasuries selling off.
I mean, is there any, and I've heard this, from some, I guess, insiders, also that the tone at the IMF was a bit more subdued because they don't want to antagonize the president. So actually, they're a lot more worried about growth prospects for their economies, but the ministers don't want to blame it on Donald Trump for fear of retaliation.
Well, it was a pretty subdued tone, but also you did see comments still endorsing the US. You saw quite a few officials saying, to Simon's point, the dollar will remain the reserve currency no matter what. And we do see the need to have exposure to the US. So trying to, in a way, talk up the US economy, at the same time, but expressing concern about the longer term outlook. It's very difficult to forecast. You can see it in the earnings reports that are now coming out from companies. There's no visibility about what might be the impact on their earnings, and therefore also on economies and growth and inflation, not just in the US, but in Europe and elsewhere, not just the rest of this year, but into next year.
Thank you both for joining us, Rosalind Matheson and Simon Kennedy. Now, we'll also leave you with some live pictures from the Vatican. World leaders flying in Rome tomorrow ahead of the Pope Francis's funeral.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief on this Friday morning. Let's set your agenda. Mixed signals. Beijing overnight once again denies any ongoing trade talks. Trump says the two sides are speaking. Rate cut hopes. FOMC members Hammack and Waller revive the odds of policy easing. And it's a tale of two tech earnings. Alphabet rises on a sales beat, while Intel suffers after a disappointing forecast. The multi-day rally continues. The S&P yesterday posting its third consecutive gain. We try to make it four this morning, which, by the way, is something this market hasn't done since January. Hope is a hard thing to kill, with Trump saying the U.S. is indeed talking to China. Despite China's denial, again, a foreign ministry spokesperson saying yet again overnight the U.S. shouldn't lead the public on talks. But hope, again, still alive in these markets. The NASDAQ outperforms with those solid earnings from Alphabet. We are back, by the way, back to levels we were on April 3rd, the morning after the Liberation Day announcement. The Fed speakers helping out this bond market. Waller, Hammack, both speaking to the media yesterday. Waller speaking to Mike McKee, saying that if there's a drop in the labor market, we will indeed step in. It's a rally on the long end, 2s, 10s, 30s. They will move lower by at least 1 basis points, your 2-year yield. Little change this morning. Those are the overall markets. Let's look at some stocks underneath the surface. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Alphabet looking really strong in the pre-market trading, boosted by its traditional Google search business, really the strong part of the company, and also the cloud business looking strong as well. A bit of an order uptake at the company. So the stock up around 5.5% at the moment. But Intel going the other way. Weakness once again at the chip maker and maker of hardware. Of course, now the company is announcing job cuts as well, something Bloomberg broke an exclusive on just a few days ago. There's a stock down almost 6%. Then over in footwear, Skechers removing its guidance. The trade war getting even worse, hitting shoe companies now. Skechers declining around 6% in the pre-market. And we are expecting to see a little bit of a move lower, read across in the likes of Foot Locker, potentially Nike as well. Footwear weaker, hit by the trade war. And keep an eye out for the before the bell opening wrap on the terminal. which sums up all of these this morning.
Joe, thank you so much. Excellent work as always. Bloomberg's Joe Easton. By the way, companies have been so negative on their earnings call. A stat from Bank of America finding that the negative proportion of earnings comments is the worst since 2009. Now, just in a few moments coming up on the show, we're going to be speaking to Derek Halpenny of MUFG. Later in the hour, Katrina Dudley of Franklin Templeton will be joining us. I mentioned those Fed speakers. They've been reviving hopes of a potential rate cut in June. Here's what Governor Waller said to Bloomberg yesterday.
It wouldn't surprise me that you might start seeing more layoffs, tick up in the unemployment rate going forward. If I see a significant drop in the labor market, then the employment side of the mandate, I think, is important that we step in.
And Cleveland Fed President Beth Hammack echoing her colleague, saying that if the Fed has, quote, clear and convincing data by June, then I think you'll see the committee move if we know which way is the right way to move at that point in time. Derek Halpenny of MUFG weighing in on the Fed's dilemma, writing, quote, the Fed will be in a terrible bind heading into the June FOMC. If the FOMC meeting was today, they would not cut. I'm pleased to say that Derek joins us now. He's the head of research at MUFG. Derek, yes, there were some trade headlines, but the market also excited about the hopium of a Fed cut. How excited can we be when, one, a Fed cutting doesn't bring cheap manufacturing to the U.S., and two, who knows what the world will look like in June?
Yeah, exactly, and that's why I said what I said in terms of the level of uncertainty today. I think would make it very difficult for the Fed to cut rates. Look, I think the Fed obviously have a bit more flexibility than, say, the ECB because they have a dual mandate, and Governor Waller himself mentioned the labour market. So I think the payrolls report next week and then the payrolls report at the beginning of June will obviously be crucial. And if we do have very weak reports, yes, I think they'll definitely be in a position to cut rates. But if the labour market holds up, and the Beige Book this week certainly indicated labour market resilience is continuing, despite the uncertainty. Early days, of course, in terms of what the Beige Book could capture post-reciprocal tariffs, but nonetheless, that will be key. But certainly from an inflation perspective, and given the potential for the 90-day suspension of the reciprocal tariffs, which is due to expire in early July, if we're going into the FOMC meeting in June, we haven't had much labour market weakness. We've had some evidence of inflation picking up, and we have the threat of more uncertainty going forward, then I think, the Fed would be in a very difficult position and could certainly stay on the sidelines. But I do think they'll cut. It's just a question how quickly they'll be able to come and start cutting.
Does it make sense then, Derek, given everything you've just said, that we have seen risk come back to levels of around Liberation Day, that yields, while still higher, they've stabilized quite a bit? Does that calming of markets make sense, or is it overdone?
It's probably overdone. I think maybe the most important comment this week was from Scott Bessent, who reportedly said that the situation today, in terms of the tariffs that China and the US have implemented, is basically unsustainable because effectively we have a trade embargo between the two largest economies in the world. And that makes sense. This is unsustainable. But how we get away from that, of course, is difficult to see over the very short term. But I think what the markets are assuming is the unsustainability of these levels means that we will get a pullback. But a pullback to the levels that were reported earlier this week, 50 to 60%, 100% on goods that are still strategically important to the US, that's a pullback to what was the worst case scenarios that were being predicted before the 2nd of April. So sure, the dollar can recover a little bit, but the bigger picture is, I think we're in a long-term downtrend for the US dollar.
Derek, just on that point you're making about what the Treasury Secretary said, these are things that are usually confined the corners of economic textbooks, and we're almost in an environment where we're seeing that theory play out. When you think about the long-term trajectory of both American assets and the economy, how do you think about what happens to global assets when we go from an unbalanced U.S. economy to something that looks more balanced? What does that world even look like, Derek?
Yeah, well, if we get to a more balanced trade position in the US, that means there would be essentially more balance in relation to capital flows as well. And of course, the whole theme around US exceptionalism has been this huge inflow of capital into the United States. But I think it's important, in terms of our dollar bearish view, it's important not to just only focus on the developments in terms of the US and what Trump is doing. There are very, very significant developments that have taken place abroad more recently that I think is going to change the dynamic for the US dollar. Because if you go back to 2014, 2015, 2013 to 2015, we had negative rates introduced and the largest ever monetary stimulus from the BOJ. We had negative interest rates introduced by the ECB. We had Brexit in 2016. And effectively we had, I think it was around $12 trillion worth of fixed income globally that was trading negative. That's all gone. And that is a very significant change to the international financial market climate that I think points to a reversal of what was a very substantial appreciation of the US dollar over the period since then, 37% on a real effective exchange rate basis. And I think we're now at the start of a reversal of that.
Derek, I just want to make one point clear on your dollar bearish call, because there's a difference between global investors diversifying outside of the U.S., which we know has been a large part of the story of 2025, and a challenge to the dollar as its reserve currency. Which are you leaning more towards in your structure of where the dollar goes?
Well, yeah, like my view on a long-term downturn is not necessarily that there's going to be this kind of big capital flight from the US and a crisis. Of course, with Trump, that's always very feasible. But I think, you know, if you consider there's $18.5 trillion of US equities held by foreign investors, if you assume on average, assuming everything else is unchanged, on average of just a 5% reduction in US holdings, that's between $900 billion and $1 trillion of outflows from the US into foreign markets, which I think, given current circumstances, is a very reasonable assumption to make. And then on fixed income, investors who were going to the US because of negative rates in their own countries, you get some shift back to domestic markets in Europe and certainly in Japan. And again, that's a shift in capital that would weigh on the US dollar as well. So even relatively small amounts of shifts back into foreign markets, and it really helps to reinforce that reversal of dollar appreciation.
Derek, so fascinating. I'm sure it's been a really busy week for you. Thank you for ending it here with us. That's Derek Halpenny of MUFG. Let's get you some other top stories that are trending on the terminal this morning. China is bracing for external shocks on trade uncertainty. The country's Politburo pledged to set up new monetary tools and policy financing instruments to boost tech, consumption, and trade. The government, though, signaled it's in no rush to aggressively expand economic stimulus. The U.S. will demand that Russia accept Ukraine's right to develop its own army and defense industry as part of a peace agreement. Bloomberg sources reveal that U.S. Special Envoy Steve Witkoff will travel to Russia to raise the issue with Russian President Vladimir Putin. The development marks a pushback on Russia's insistence that Ukraine demilitarize as part of a peace deal.
I have my own deadline. And we want it to be fast. And the Prime Minister is helping us. He wants it to be fast, too. And I think everybody in this, at this time in NATO, they want to see this thing happen. So we have a deadline, and after that, we're going to have a very much different attitude. But I think that has a very good chance of getting done.
The Trump administration will make it easier to deploy self-driving cars on U.S. roads and loosen crash requirements. That, according to a report from the FT. Transportation Secretary Sean Duffy said the move to slash red tape is to enable the U.S. to be more competitive with China. Coming up, Washington says we're talking. Beijing says not so. We're going to discuss the continued confusion and possible tariff exemptions on U.S. goods. All of that coming up next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China. And so I think you have, Jeff, as usual, I think you have your reporting wrong.
President Trump seeming to confirm talks on trade after Beijing denied the claims. Sources now saying China is also considering suspending its 125% tariff on some U.S. goods. But overnight, just a couple hours ago, the country's foreign ministry spokesman responding, doubling down, saying, quote, China and the U.S. are not having any consultation or negotiations on tariffs, and the U.S. should not be misleading the public. At the briefing, he also mentioned that he was unfamiliar with reports of tariffs exemptions on U.S. goods. Joining us, trying to make sense of it all, is Bloomberg's Brendan Murray. Brendan, can you make sense of it?
Yeah, it's a lot of conflicting signals coming out of Washington and Beijing right now. I think the bottom line is that the tone seems to be one of de-escalation, and if they're not having official talks, there is very likely some low-level back-channeling that's going on that will set the table for talks. So the temperature in the trade war between the U.S. and China has come down a few degrees, it feels like, but there's still the big issue of 145% tariffs on Chinese imports and similar tariffs on U.S. exports to China. So the economic fallout of that is still playing out. So it just depends on who's going to blink first here. President Trump has indicated that he's willing to think about bringing some of those tariffs down. China is saying, look, we're not going to any negotiating table with you unless you eliminate all those tariffs. So still at an impasse, but moving in the right direction, it seems.
Brendan, I got to say, I think a lot of people will be reminded of August 2019 when President Trump said that he had had a phone call with China to try to assuage markets, which White House aides later admitted that he had made up that call, or it didn't really go down that way, and it was an attempt to try to make markets better. Also, sort of on the side of China denying things, we had this report that China is considering carving out exemptions on tariffs on some U.S. goods. What might that look like? And again, what has China said about it?
Yeah, it sounds like a conciliatory move from China, but based on the U.S.'s exemption of Chinese products a week or two ago. So it's just another indication of how slowly China is moving in this back and forth with Washington. Its time is on its side, and the leverage is not as great as Donald Trump would have initially thought. It would appear by the way the Chinese Chinese officials are playing a bit of hardball on their own side in terms of giving Trump what he wants, and that's a deal. And when we're still nowhere near the start of any negotiations for a deal that even Treasury Secretary Scott Bessent said will take 2 to 3 years. So there is going to be no deal until talks get underway, and we're not there yet.
Brendan, my math might be a little bit off, but I think we have about 76 days until the deadline of the 90-day tariff pause. Has there been progress anywhere else outside of China?
Yeah, exactly. That new date on the calendar is around July 9th, and there have been countries in Asia, Korea, Japan, and India have indicated that they are close to signing some sort of memorandum of understanding that will set the table for talks. There have been some others. The UK is also looking to sit down at the table with the US to try to negotiate their way out of these reciprocal tariffs. So, but these are not negotiations for trade deals. These are the outline of an agenda for talks for a trade deal. There's a distinction there that's important in that Donald Trump wants to sign deals very quickly, and the countries are realizing that that process will take a lot longer. But let's get the process rolling, and that's what Asia is leading the way on so far.
Yeah, to that point, Scott Bessent calling it an agreement of understanding between the U.S. and South Korea. Brendan, thank you for your work this week. Brendan Murray there on our Bloomberg team. Coming up, we get to tech. We're going to unpack Alphabet's sales beat, plus Apple looking to build more iPhones out of India. More on the details next. You're watching Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, yet ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
let's take a look at the front pages this morning, what different outlets have for their top headlines. First up on the Wall Street Journal, the FCC is discussing diversity concessions with Paramount. Journal sources say that the FCC is asking Paramount to ditch DEI initiatives in order to win approval for its merger with Skydance. Next up, the New York Times leading with Trump's Crimea proposal, breaking a decade of U.S. resistance. American and European officials say the U.S.'s new peace proposal would include U.S. recognition that Crimea is part of Russia. That shifts U.S. policy extending back to 2014. The FT leading with this, Apple shifting its U.S. iPhone production from China to India. Apple currently produces about 60 million iPhones a year for the U.S. market. It's aiming to ship most of them from India by the end of next year. Now, we'll come back to that Apple story in just a moment, but let's first shift and talk about Alphabet. Shares are rising in the pre-market, more than 5.5%. The Google parent company delivered a beat in the first quarter in profit and revenue. Joining us is Bloomberg tech reporter Newly Purnell. Newly, great to see you. So take us through the results. What were the takeaways?
Yeah, it was really positive for Google. Revenue and profit beat expectations, and the number that really jumps out, $50 billion, that was the revenue in its search sales business. So, with all this talk about Google Cloud, other cloud companies, AI, the brave new world that we're entering with all these newfangled technologies, it's easy to lose sight of the fact that for Google, search advertising is absolutely the engine of its business. And there have been questions within the company and outside the company about how it's going to adapt to a new world where we might go to chatbots instead of searching on Google for stuff. So still showing that there's a lot of demand for their services. There were even questions about whether the macroeconomic conditions would lead companies to curtail their spending on ads online, but no evidence of that for Google.
Yeah, again, everyone's looking for a company that's immune to the macro environment. Newly, I mentioned Apple, that it wants to produce most of its iPhones out of India next year, that FT reporting. How mammoth of a task would that be for Apple?
It would be huge. And to put it in context, it's something that Apple has been working to address for some time. As we know, they're so dependent on the mainland for China for producing and consuming so many of its devices. And going back to COVID, they've really been starting to try to attempt to diversify their supply chain away from the mainland with ramping up production in places like Vietnam, but especially in India, a massive market of its own. And what they seem to be doing here is, wanting to really increase the number of phones they make there. They've made good strides. They make some of the most expensive and sophisticated devices there, not just lower-end products. They really want to accelerate that. Again, to, as the U.S. decouples from China, they want to be able to have a safe environment. Tariffs now, of course. There are challenges. One of the reasons that makes China such an attractive manufacturing base is just the huge concentration of suppliers within the region, highly trained workforce, predictable and stable political environment. So those will be challenges for India, but it makes sense for Apple to really try to double down on that market.
All right, Newly, thank you so much. Excellent coverage. Newly Purnell there on the latest in tech. Now, a quick check on your markets this morning. Those results from Google are helping to lift up S&P 500 futures. Can we make it a fourth consecutive day of gains? The dollar starts to rebound, but again, we were just speaking with Derek Halpany of MUFG saying that we are fully in a downtrend for the U.S. dollar. A lot of people agree. Bank of America's FX team moments ago putting out a note saying something similar, calling it a new regime, that they are bearish U.S. dollar. Your 10-year yield lower by 2 basis points. Coming up, stocks making a round trip near the end of a roller coaster of an April. We're going to catch up with Katrina Dudley of Franklin Templeton. That's coming up next on your Bloomberg Brief.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Mixed signals. Beijing overnight once again denies any ongoing trade talks. Trump says that the two sides are speaking. Rate cut hopes. FOMC members Hammack and Waller revive the odds of policy easing. And it's a tale of 2 tech earnings. Alphabet rises on a sales beat. Intel suffers after a disappointing forecast. 3 days of a market rally. Can we make it a 4th? We attempt to this morning with both S&P and NASDAQ futures up 0.4%. Small caps decline. By the way, if we do get 4 sessions in a row of rallies, it'll be the first time we've done that since January. Hope is a hard thing to kill. Trump saying that the U.S. is talking to China despite their denial. A Treasury rally getting a boost from Fed speakers yesterday. Again, both Hammack and Waller speaking about cuts. The 2-year yield takes a break from that rally, while the 10-year is lower by nearly 2 basis points at 4.29 this morning. Let's get you some stocks on the move underneath the surface. With that, yet again, is Bloomberg's Joe Easton. Hi, Joe.
Hey, Danny. So Google really the strong point of the Mag 7 today, lifting those NASDAQ futures, as you were mentioning just now. We can see Alphabet up almost 6% at the moment. Strength in the search business and also in the cloud unit as well. So that seeing some strong gains today. But going the other way, Intel, a weak report once again from the big chip maker, and the company confirming those job cuts that Bloomberg reported a couple of days ago. There we can see Intel really sliding now in the pre-market, down almost 6%, pretty much the reverse of what Alphabet is doing. And then finally wanted to flag Novo Nordisk. Plenty of traders here in Europe scratching their heads on why this stock was down today, but there is a note out from Morgan Stanley saying that the Wegovy obesity drugs are potentially going to be weaker than expected in terms of the demand on the results that are due May 7th. MS thinks Novo could downgrade its earnings guidance next month. Therefore, we are seeing Novo, the ADRs, a little bit lower today. Danny, keep an eye on that one ahead of the open in New York.
Joe, excellent work all week. Joe, thank you so much. Bloomberg's Joe Easton there. Now, it's been a roller coaster of a month, but the latest glimmer of hope surrounding trade deals and Fed speak on cuts. And with all that, U.S. stocks have basically made a round trip. They closed yesterday where we were the morning of April 3rd, the day after President Trump's so-called Liberation Day announcement. I'm pleased to say joining us now is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. So, Katrina, we have this hope, but at the end of the day, China tariffs are still on. Shipments have paused. Have we run a little bit too far with the narrative of positivity?
No.
I think, you know, we've had 3 trading days in a row that are positive territory, and that is the signal. You know, the number of bears out there is just extreme. It's at levels we never see. So the market is telling you we're bearish. We don't believe any of this, and the market is rallying even with that bearish sentiment. And we think that's one of the indicators that suggests it's time for a rally. And we look forward 1 year, and we think that if you invested today, you're going to be happy 1 year in the future.
That is some positivity we need. Thank you so much for that. Okay, not to bring it back down after that, but we have seen CEO after CEO in the earnings commentaries we've gotten so far be so dour. I think we've got about 25%, something like that, of earnings. And Bank of America ran the study basically saying the negativity that we've seen from earnings calls, the sentiment reading is somewhere near 2009 lows. Does that not give you some pause?
Look, it does give me pause that the CEOs are somewhat negative. I think what that's going to do is kind of pause hiring. But if I look at the unemployment rate, it's still at a very, very low level. So, you know, job growth was, and a lowering of the unemployment rate was not a driver of our economy. So it's not such the negative that you would see. The second thing is, where are companies spending their money? And they're spending it in AI. And you cannot pause that investment, because it's exponential. The growth, that need to invest, if you decide to take a couple of months off, you're not just 3 months behind, you're 6, maybe 9 months behind your competition. So they may be talking about the fact that they're being cautious, but I think behind the scenes, they're continuing to do things which will just give us a base.
So that's really interesting, because before we had sort of the policy-induced sell-off, there was a different flavor of a sell-off, and that was the AI sell-off. The DeepSeek, China's getting better, tech is overvalued. Perhaps walking back some of the trade stuff, we fixed that narrative. But what about the AI, the DeepSeek of it all? Should tech really rally back if that's still sort of present in the overall market landscape?
Look, I think the DeepSeek innovation is really what we needed to see in AI, which is making AI cheaper and more accessible. So if I take a look a year back and the work that we were doing on AI at Franklin, and I look at the tools that we were designing, and I fast forward now a year, the capacity, the capabilities, and what those tools can do today versus what they were able to do a year ago is night and day. And I think that that's what, you know, the DeepSeeks and that will take these AI tools and bring them to a much greater, you know, population of companies. If you take a look at smaller companies, their ability to use these tools now is much, much easier. They've developed significantly. So I think it's easy just to say, oh my gosh, tech is overvalued. I look at it versus its own history. But, you know, you've got good earnings growth in tech. But let me go back to that narrative that we talked about at the beginning of the year, and I think we're stuck. You know, it's a little more, you know, concerning with the tariffs, but it's this breadth. And that is where we think it's going to continue to happen, is this breadth of earnings.
So it sounds like this narrative that's been building of American exceptionalism is fading, that you don't quite buy that, or is there some element of truth in it?
It's not just American exceptionalism. What we're starting to see is bringing it back to America and bringing back the jobs. If you take a look, why did one of the interesting facts about how President Trump won the election is that swing in the union vote that went over to Trump. And you know that's just very, very unusual in terms of if we look back in history. And so he's made a commitment to the American worker. And what we're seeing is that these tariffs, they're not taking America from being a high tariff country to being an even higher. They're taking America from being a low tariff country to being, you know, more in the middle of the road. And what's happening is we're seeing some of the announcements come through. We're seeing companies talking about bringing jobs back onshore. That is good for the American worker. That is also good for us from a security perspective.
How necessary is it that we see some of the stock market losses ebb in order for that to happen? Because I imagine if you're a company looking at intense shareholder dissatisfaction, you're not going to be willing to commit the CapEx, especially when some of these projects take longer than Trump will likely be in office. They take longer than 4 years to build up a huge manufacturing plant.
You know, I've been a shareholder and I've invested in companies my entire career, and I always think that CEOs should always listen to us as shareholders and take into account our views. But I do think that most of the companies here in America are run by people who are probably much smarter than myself. They take a much longer term view of the company. They have the luxury of that inside view, and I think think that they are investing for, you know, a 3-5 year benefit. So while we tend to focus much more on the short term, and I do think they listen to us, where they listen to us more in terms of capital allocation and prioritization, and they take that input in. But if I was sitting in the CEO seat today, I would be looking at what do I need to be doing today to make my company set for success in 3 to 5 years, and that involves continuing investing in AI.
I think a lot of people really admire the destination that the Trump administration is pushing for, but there's been so much back and forth of tariffs on and tariffs off. Does that uncertainty also complicate executives who are willing to do that if they don't know day to day exactly what the tariff regime is going to look like?
So the interesting thing on the tariff side from an American company perspective is you need to look at where our margins are historically for these companies. And we are at historic high levels of margins, which to me says there's a little bit of room for an adjustment, that not all of these costs need to get passed on to the consumer into the CPI metric, that maybe the companies can share some of the tariff pain. And that adjustment, I think, can be done within the current margin structure. So I think that there's going to be a little bit of margin pressure. I don't think that that's going to destroy multiples, given that people were not expecting the margins to continue to keep going. I think that people were, you know, baking in already that there was a little room for margins to come down, and this is the way it was.
So just on that note quickly, Katrina, then you'd agree with a wall of sorts, saying that we're not going to see this like big inflationary increase with tariffs?
No, I don't think. If we have a look at the last time he put through significant tariffs, which is in the first time he was in the administration, you didn't see a significant amount of inflation. I think we're seeing signs of other, you know, potentially out of China, some deflationary concerns. I saw some concerns out of Europe as well. So it looks like deflationary concerns or lower than expected inflation seems to be the message. And if that's what's going to happen, it means that the U.S. is probably, you know, keeping well under that, you know, not well under 2, but, you know, probably in that 3 to 2 range, which is completely manageable.
Katrina, this has been such a joy. So wonderful to have a positive outlook, especially on a beautiful Friday morning. Katrina, thank you so much for joining. Great to see you. That is Katrina Dudley of Franklin Templeton. Okay, let's get to some other top stories that are trending on the terminal this morning. China is bracing for external shocks on trade uncertainty. The country's Politburo pledged to set up new monetary tools and policy financing instruments to boost tech consumption and trade. The government, though, signaled it's in no rush to aggressively expand economic stimulus. The U.S. will demand that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Bloomberg sources reveal that U.S. Special Envoy Steve Witkoff will travel to Russia to raise the issue with Russian President Vladimir Putin. The development marks a pushback on Russia's insistence that Ukraine demilitarize as part of a peace deal.
I have my own deadline. And we want it to be fast. And the Prime Minister is helping us. He wants it to be fast, too. And I think everybody in this, you know, at this time in NATO, they want to see this thing happen. So we have a deadline, and after that, we're going to have a very much different attitude. But I think that has a very good chance of getting done.
Elsewhere, the Trump administration will make it easier to deploy self-driving cars on U.S. roads and loosen crash reporting requirements. That's according to a report from the FT. Transportation Secretary Sean Duffy said the move to slash red tape is to enable the U.S. to be more competitive with China, a win for Elon Musk and Tesla. Coming up, China doubles down on its denial of any ongoing trade talks with the U.S. We're going to have more on whether or not the U.S. is actually talking and possible tariff exemptions on U.S. goods. All of that coming up next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg.
This morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China. And so I think you have, Jeff, as usual, I think you have your reporting wrong.
President Trump confirming talks on trade after Beijing denied discussions yesterday. Sources say China is considering suspending its 125% tariff on some U.S. imports. But the country's foreign ministry spokesman responding today with the same message that we got yesterday. China and the U.S., quote, are not having any consultation or negotiations on tariffs. The U.S. should not mislead the public. He also stated that he is unfamiliar with reports of tariff exemptions on U.S. goods. Joining us now out of Washington is Bloomberg's Mike Shepard. Shep, how do you make sense of this?
Well, it's a little difficult to do that, Danny, because we're getting so many mixed signals from both sides. You know, the Trump administration has come in heavy on China with its trade policies, with such heavy tariffs. Even with the exemptions against electronics, it's a very strong signal against the world's second largest economy and the third largest U.S. trading partner. And when Donald Trump yesterday was talking about talks, he offered no specifics. He wouldn't say who was in the discussions or where they were taking place. And it's important to note that the IMF and World Bank are holding their annual meeting, semi-annual meetings in Washington this week. And there is a Chinese delegation of fairly senior officials here. And it's the first big group of top Chinese officials to visit Washington since the big tariffs packages have been unrolled by the new administration. Now, when Donald Trump is talking about talks, it may be more lowercase t, but China is really looking for the capital T talks where they get what they have been looking for, and that is a point person from the administration to actually sit down and really go through all the key issues on trade, not just the tariffs, but some of the other barriers, including technology export curbs that have come up, as well as Taiwan. And they also want to see a cooling of some of what China views as the disrespectful rhetoric toward China that they've been hearing in recent months since Trump took office. So, Danny, this is we're getting that kind of signal that maybe there are talks, maybe not the full level of talks that China would like. But we are also seeing that China may be extending a little bit of a reprieve to its own people and perhaps an olive branch to the U.S. by weighing and easing of some of its own retaliatory tariffs on products like medical equipment and on critical industrial chemicals. So this could be a step toward getting to those bigger talks that both sides might want to see, Dan.
Just that in itself, Shep, does it suggest that there is an icing, a thawing rather, of some of the icy relations between the U.S. and China? Again, if it's that lower T talk. Presumably that's something that is a prelude to bigger talks if China is offering these types of relief on some of the tariffs, at least for their own people.
Well, Danny, we are seeing discussions that are in much more advanced stages with other key Asian trading partners. That includes Japan and South Korea and India, but they had a head start. The relationship with Trump was much better established after the election and in the early days of the administration, and China really just hasn't had that same level of engagement. The most senior official really to have that kind of big, high-profile contact with Beijing was a Republican U.S. Senator who's close to Trump, Steve Daines, and that was back at a business forum last month. So China really is starting from much further back from the starting line than some of these other trading partners. So you really have to have that initial contact before you get to something more advanced.
Well, Shep, if we need to define what a talk is, maybe we should also define what a deal is. This from the Treasury Secretary, Scott Bessent, that the U.S. and South Korea might have an agreement of understanding as soon as next week. What could an agreement of understanding be?
Well, he offered no details on what that exactly would look like. And that is a key step. At least they can agree on the broad strokes of a deal before getting to the nitty gritty. And, these trade negotiations, which the U.S. is trying to conduct at light speed right now, usually take years to carry out and execute. So, but to get to the real tricky stuff, the fine print, you have to, get to the capital letters and the outline first. And that is what he is signaling they'll be closer to. And some of the key areas, of course, are autos and steel and aluminum that are probably the biggest areas of contention between the two countries.
Shep, thanks so much for joining us this morning. That is Bloomberg's Mike Shepard. From Washington to tech, shares of Alphabet extended gains in the pre-market session, up more than 5.5%. Pleased to say that joining us for more is Bloomberg Intelligence Senior Tech Analyst Mandeep Singh. Mandeep, what was your takeaway from Alphabet earnings?
I mean, look, everyone was so negative on search that they showed, there are multiple levers when it comes to the core search business, and the margins expanded quite nicely. What they didn't really elaborate on is how it will affect the second quarter, because remember, the Liberation Day was after the first quarter was closed, and all the softness started to happen in April. So I think from that perspective, the end of the de minimis rule, where Chinese companies could ship their products directly to the U.S., I think that will have an impact on Alphabet's ad spending in 2Q. And ad pricing, which was the key reason why margins expanded, may slow down. I think you will not see that sort of strength. I mean, all their other businesses, cloud, YouTube, were in line with consensus. So it was really the search that outperformed. But my feeling is that outperformance is not likely to continue.
Well, Mandeep, because we've also seen earnings report after earnings report, and let's be honest, very different businesses from Google, but talk about the concern of weakness, especially among the consumers to come. Is Google vulnerable in something like their retailer advertiser business because of some of the economic concerns?
It is, and that's where, the Chinese advertisers probably make up a larger portion of Meta's ad sales. So I think the headwind may be more pronounced for Meta, and Meta does give a full year guidance. So we will find out about the impact on 2Q guide and full year guide. But in the case of Alphabet, they have a more diversified advertiser base. What they did call out was AI overviews monetizes at the same pace as the traditional blue links. So that, I think, comforted the investors. But overall, there is no doubt that, ad pricing will take a hit if some of the advertisers are pulling back because of macro concerns.
Mandeep, let's wrap it up with this FT story about Apple looking to ship a lot of its iPhone manufacturing to India away from China. How mammoth of a task is this for them?
Well, so I look at it this way. Right now, Apple doesn't have a choice but to, kind of relocate some parts of their supply chain to avoid the tariffs. So in this case, a lot of the manufacturing may still be done in Taiwan and to an extent China, but the final assembly will take place in India just to avoid the high tariffs, 145% or whatever may come next. So from that perspective, yes, they will be shipping the final product from India, but then the intermediate steps may still go through multiple countries. So that will be, I think, the easiest way for them to relocate some parts of the supply chain in the near term.
Mandeep, thank you so much for your time this morning. That is Bloomberg Intelligence's Mandeep Singh. Coming up, we're going to wrap up your week. We have more earnings in your day ahead. We'll go through it next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Friday. We're going to have more earnings before the bell. That includes Colgate Palm Oil and AbbVie. Plus, we're going to get the final reading of UMich sentiment that comes out at 10 a.m. Eastern. And more IMF and World Bank interviews will be happening throughout the day. Tune in for Bloomberg Surveillance for that one. Some earnings to get a view on ahead of the market open. We're looking at a nearly 6% gain for Alphabet. Revenue and profit beating the street's expectation, driven by Google's search ad business. T-Mobile, though, to the downside, much like Verizon, reporting fewer new wireless subscribers than expected. Analysts saying that the firm is under pressure with rising competition, though shares down more than 5%. Finally, with some pharma, Gilead down 4%. Sales missing estimates, especially from key medicines for breast cancer and HIV. All right, a quick look at markets this morning. Your S&P 500 future session trying to make it a fourth consecutive day of gains. They are up 1/3%. If they're able to do that, it will be the first 4 consecutive days of gains for this market since January of this year. Meanwhile, your 10-year yield, that's lower by 1.5 basis points. The dollar strengthens, but Derek Halpenny of MUFG, as well as Bank of America this morning, both saying that we are in a structural downshift for the U.S. dollar. Bank of America, Michael Hartnett, still recommending to sell the rips. All right, that is it for Bloomberg Brief. Surveillance live from D.C. takes things from here. This is Bloomberg.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Investors are not only worried about the economic outlook, but the whole structure of the international system.
We all really appreciate that if global trade begins to destabilize, all that we have to lose.
Our overriding theme, of course, is uncertainty.
The world economy cannot afford a continued confrontation between the two largest economies in the world.
The world is holding its breath, waiting for the U.S. to indicate where it wants to end up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, heading towards a solid week of gains as President Trump dials down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So as the White House says they had a meeting, China continues to say that negotiations aren't actually happening, leaving the clock ticking and the pressure rising. Following forecast cuts at Pepsi and P&G, American Airlines pulling its outlook, and Southwest CEO stating, I don't care if you call it a recession or not, in this industry, that's a recession. In some places, Lisa, the damage is already done.
And that is really the big takeaway from this week. And I do think this has been a pivotal week because it turns out that on again, off again, potential talks underscores that it does seem like mutually agreed, mutually assured destruction is a motivating factor for talks. And that seems to be the consideration both for corporate America here in the United States, as well as what's going on over in China with industries that are hinged to U.S. industry, whether they like it or not.
The tone is better this week. The equity market performance is obvious. Equity futures up again this morning on the S&P 500. Does it matter if talks are happening or not when the president clearly wants to send the signal that he's ready to bring these tariffs down?
Oh, I think it matters, right? At some point, you want to see whether or not there are going to be contours of a deal between the two largest economies in this world. The question is, who is the they the president is talking about? And if there was a meeting, usually he'd be very excited to say, my Treasury Secretary, my Commerce Secretary, my NEC Director met with their counterpart. There's still hope that a meeting will take place, though. Remember in February, Scott Bessent sat around the table with us and said, I will be meeting my Chinese counterpart for the first time during the IMF World Bank meetings. We heard from the PBOC governor today. He's leading a delegation here. there could be a meeting that takes place. There's still time.
Let's see if we get both sides to agree that that meeting actually took place before we get into the weekend. Going into the weekend, 3 days of gains on the S&P 500, looking to make it day 4. Equity futures higher by 0.25%. Coming up this hour, Sarah Hunt of Alpine Sachs and Words with Stocks on a 3-day winning streak. Sarah Bianchi of Evercore on US-China trade talks, and Scott Devitt of Wedbush on Alphabet's better than expected results. We begin this hour with stocks heading towards a solid week of gains. Sarah Hunt of Alpine Sachs and Woods writing, these shifting tariff rates and timeframes will likely to continue to sow uncertainty. Sarah joins us now for more. Sarah, uncertainty is a word we've all been grappling with. I think that Andrew Honhorst City has summed up things nicely. Tariff headlines reduce tail risk, but lack detail and still imply a large increase in effective trade costs. Sarah, with that in mind, how do you approach this market now?
Well, I think right now we've got a lot of different dynamics that are happening at the same time. And one of the issues is as these tariffs move around, you see a lot of pull forward. So it's likely that a lot of the economic data is going to start reflecting the fact that people are thinking, well, if I'm going to buy something, I better buy it now. And I think it just makes this year very difficult to look at the estimates and look at what's going to happen, because how much of that pull through is early in the year, how much of it slides in the back of the year, or do we keep chasing it if the target times keep moving? Does that data keep getting better because people keep chasing things in case those tariffs come? So I just think it's very difficult to look at what's happening this year with any certainty.
Sarah, do you think at some point in the next couple of months there might be an air pocket in the economic data?
I think there could be, but this is where I'm looking at what's going on, and even just the anecdotal choices that people I know are making, which is, well, if I need a phone, maybe I should replace it now and not wait until September. If I need this, maybe I should do that. So I don't know that you're going to get that much of an air pocket in the near term. The question is what's going to happen if you pull forward too much, and do you get an air pocket later in the year once everyone's starting to think that everything is okay? And I think that's why this year is a very difficult one to game out this early.
Sarah, since Liberation Day, it's felt like a roller coaster in markets, a roller coaster of emotions on Wall Street analysts' desks where they've revised downward their economic projections. The S&P is down 3.2% now since Liberation Day on April 2nd. Does that account for the potential economic damage that CEOs are telling us is happening right now in real time?
Well, I think that we've gotten a window into some of that damage as you've seen this market be so volatile, because it may be down 3% now, but we've had a couple of days where we've seen some recovery, and we had that massive recovery a week or so ago. So I think that the market has been reflecting the uncertainty and has been discounting some very dire scenarios. And what I think this week has shown is that when some of that rhetoric starts to get a little bit less frightening, and you start talking less about doing things that are quite outside of the regular thing, like getting rid of a Fed chairman, and you start talking about bringing some of those tariff talks down and being less aggressive about that, then the market is starting to play out and say, you know what, maybe there is going to be a solution, versus a week or two ago when we thought maybe there won't be a solution. So I think that volatility still stands. And what we're seeing right now is a quiet period, which, you know, from those of us who trade is sort of nice.
There's the trade on again, off again kind of discussion. We'll get to that in a second, though I am wondering how much we're conflating the trade uncertainty with the big tech uncertainty. We got Alphabet earnings yesterday, and they were better than expected. They indicated that the demand for large tech and some of the chips isn't necessarily diminishing in any kind of way, and they were doubling down their investment efforts. How much is that almost a bigger piece of the support to markets right now than questions that keep swirling and maybe progressive talks in Washington, D.C.?
Well, that's a great point, because one of the reasons that the market was also feeling so volatile, I think, was that concerns about that AI spend had started to creep in when people started talking about whether or not there was enough data center capacity. And then some people were pulling back on building data centers, or maybe they didn't need as much. And I think that was as much of a problem for the market as the tariff situation was, because the AI story was really a big part of what got people interested in tech stocks, especially last year and the year before. So I think that staying there and those investments continuing to be made is a big part of the CapEx story going forward. And so I think that is also a key part of what happens this year. So it's good to see that come through in some of those discussions and those earnings.
Sarah, that's what the Treasury Secretary said to me when the Mag 7 stocks were taking a hit. He said that's a Mag 7 problem. They have a DeepSeek problem, not a MAGA problem. When it comes to what you do right now, the team over at Bank of America is saying investors should sell into these rallies. There's more to go. And they say that This will continue until the Fed starts cutting, U.S. reaches a deal with China, and consumer spending stays resilient. That's when you can see the trend upward actually stick. Do you agree you need all those three parameters?
Well, I think a lot of it depends on your time frame, right? If your time frame is the next 3 to 5 years, then those parameters will come into play. If your time frame is very short, or you need money on a short-term basis, then I think that there's something to be said for that, because we have had the market come back after a real drop. And I think we've got more volatility ahead on these headlines, as we've been talking about, because right now there is nothing certain. What we're going on is a lightening of the tone as opposed to any factual changes that have happened in these tariff regimes. So I think that there is a lot to be said for near-term needs for liquidity and doing something like taking some money off the table. But if you're invested on the long term, I think that this is something that we just have to get through. And once we get through it, you'll start to see reasons for people to be more optimistic.
Well, this is what John asked me at the start of the program. Is the tone enough? Because it shows the direction of travel where this administration wants to go.
Right now, the tone is enough, and especially after some of the tone that had been much more negative and some of the declarations that seem much more problematic for markets. So I think that right now the tone is enough. It will not remain enough all year. So you're going to have to see some agreements come through, and you're going to have to see, I mean, you're already seeing the fact that China is talking about taking some of the tariffs, and we're talking about some of the tariffs. People are starting to understand how problematic it would be if we don't get somewhere where there's some agreement. But I do think that you've got more up and down going forward, because right now we've just come off of a period of problematic discourse versus quieter discourse.
Sarah, it does seem like we've learned something this week. We've learned something when it comes to CEO commentary, and we've learned something when it comes to foreign leaders and how they're approaching President Trump, their approach to the dollar, their approach to treasuries and their safe haven status. At least the rhetoric has been really supportive, saying that, no, actually, we need the treasury to be that haven asset. The dollar will be the reserve currency. Does that give you any conviction? Basically, do you believe them that there isn't this sort of bigger shift away from the dollar and dollar-denominated assets over the longer term?
Well, I think that you can make an argument about why there should be an alternative to the dollar, but in practical reality, there really isn't that much of an alternative to the dollar. On the margins, money can move around and capital flows can occur, but the U.S. markets are still the most liquid and the deepest. And I think that the U.S. market is also, from a consumer standpoint, one of the most important markets in the world. So there has to be some ability for companies and countries to come to terms with what's going on. And we have been discussing for years some of the trade imbalances. So I think that there is a recognition that while this may be painful to go through, it's not an untoward idea that this should start to shift and some of these regimes should start to shift. So I think that there is a lot of trying to figure out exactly how that comes out and where you want to be positioned. But the U.S. is still going to be a major piece of that no matter how it shakes out.
Hey, Sarah, appreciate your input. As always, Sarah Hunt there of Alpine Saxon Woods on the equity market. A better week, heading towards a week of gains on the S&P 500. 3 days of gains for the first time since April 2nd. One small problem, though. You are continuing to see bonds and stocks trade in lockstep, and we'll see if we can break that trend sometime soon. For now, equity futures just about positive on the session by 0.1%. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Yahira Heckes. Hey, Yahira.
Good morning, John. We start with the latest on trade, with China continuing to deny it's in talks with the U.S. about a deal. A China Foreign Ministry spokesman said this morning the White House should not mislead the public about talks. Bloomberg News has learned China is considering suspending its 125% tariff on some U.S. imports, including medical equipment and industrial chemicals like ethane. Meanwhile, in earnings, Alphabet shares are higher 5.6% in the pre-market. The Google parent reported first quarter profit and revenue that topped analyst estimates, driven by strength in its search advertising business. Alphabet remains heavily invested in AI, boosting spending on servers and data centers. It's a different story over at Intel, with shares falling 6% in the pre-market after the chipmaker's second quarter revenue forecast missed estimates. The CFO warning that a tariff-fueled recession could hurt chip demand. And Intel confirmed our reporting that it plans to cut management jobs as its new CEO, Lip-Bu Tan, attempts to turn around. That's your Bloomberg Brief. John?
Hey, Yahira, thank you. More from Yahira later on this hour. Up next on the program, the president dialing down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is.
Up next on the program, Sarah Bianchi of Evercore, live from Washington, D.C. this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Three days of gains on the S&P 500 this morning, and good morning, just about positive again by 0.2% on the Nasdaq 100. A similar move. Under surveillance this morning, the president dialing down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So here's the latest this morning. President Trump insisting trade talks are taking place between the U.S. and China. China once again denying any negotiations are taking place. Bloomberg's Tyler Kendall joins us now from the White House for more. So, Tyler, have we got any confirmation as to whether those talks have actually happened?
Yeah, hey, John, I guess it depends on who you ask as the ongoing disconnect between Beijing and Washington continues, with President Trump there, as you heard him, saying that those talks are indeed happening, but declining to really give us many specifics, including on who is conducting them. We do, of course, know that one of the preconditions for Beijing is that somebody other than him lead those negotiations. And we should note there is a Chinese delegation here in Washington this week for the IMF spring meetings, but at this point, there have been no official bilateral talks announced. But it does come as we could potentially get some updates on de-escalation. Bloomberg News new reporting this morning, according to people familiar, that China is considering exempting some U.S. goods from tariffs. These would be in certain sectors where Beijing is more import reliant, such as medical equipment for things like imaging and ultrasound devices, as well as industrial chemicals used for things like plastics and cooling agents. The reporting also does indicate that potentially plane leases could also see tariffs waived as well. A source familiar does caution Bloomberg at this point, everything is so in flux as we try to parse exactly what is happening here when it comes to U.S.-China trade talks. But it is clear, John, that the administration wants to push out progress when it comes to other trade talks. Just yesterday, the Treasury Secretary Scott Bessent saying significant progress has been made towards an agreement of understanding with South Korea, of course, one of those countries that has been given priority during these trade talks. He declined to give us specifics, elaborate on exactly what that could look like, but did say that they were working out the technical details as soon as next week.
Yeah, it was interesting. The Treasury Secretary yesterday in the Oval Office, the president saying he was actually surprised at how quickly the meetings were going with South Korea. What about what's going on with Japan and India? Is the U.S. making any progress when it tries to ask its partners and trading allies that they want to basically form a bloc and confront China together?
Right. Well, Anne-Marie, Bloomberg had some very important reporting yesterday that Japan is prepared to push back against the U.S. if the U.S. does ask it to curb its own trade against China. Now, we should caution, our reporting indicates at the moment the U.S. has not quite made that ask just yet. But we do know, of course, that it's something that this White House has been mulling, and it's something that China has come out preemptively saying that they will take any countermeasures against any of those countries that do come to take action against China that the U.S. would like to see. Our reporting indicates that could include asking countries to stop absorbing excess goods that are going to come into the market from China's overcapacity, as well as working with the U.S. to give us more favorable trade deals over what they are currently dealing with when it comes to China. So it really has put some of these countries in sort of a hard place, considering how geographically close they are to China, but also that this White House has made clear that they are prioritizing those countries like India, like Japan, like Vietnam, that are so close to China. So sort of a give and take on both ends there. I will say earlier this morning there was reporting that we are moving closer to one of those framework deals, particularly when it comes to India. We know that the U.S. would like to see them boost their crop imports when it comes to U.S. crop imports. So we'll have to see how that one develops, but that is another key one that we are watching.
Tyler, thanks for the update. Tyler Kendall outside the White House. More from Tyler a little bit later this morning. Here's a take from Washington. Sarah Bianchi of Evercore writing, we believe Trump will find a way to lower the tariff rate on China in the near future to somewhere in the 50 to 70% range and try to find some way to not make it feel like a unilateral concession. Sarah joins us now for more. Sarah, good morning. Good to see you.
Hi, nice.
So it's time for some imagination. What can he do to do just that?
Well, I think he does need to be creative because President Xi is not really making this easy for him, and I think playing the situation quite well. But I think this president's extremely creative, and I think he will find a way. I think he's feeling pressure, listening to the retailers who were in the White House this week, watching the markets, really seeing the impact of 145%. That's almost an embargo, essentially. So I think he is just going to have to do that Trump magic and find a way to say that we've all agreed and pull this down just a little bit, at least in the meantime.
Sarah, at the moment, is he basically negotiating with a brick wall?
Well, I think that this administration has realized, and this president has realized, that the April 2nd, the Liberation Day, was too much and too far. And it's not only, we always ask, what's the Trump put? And I think the bond markets have made him nervous. I think some of what he's hearing from real participants in the real economy. And so we are seeing him walk back. We saw the exemption on electronics, which was huge. We saw a real indication from the White House that they're really moving forward on these talks with other countries. Having done trade negotiations myself, I can tell you maybe they're going to get a framework quickly, but the nitty-gritty of these details are really challenging for this country. You got to have a lot of conversations about agriculture and beef and other things. I think they got more work cut out for them than they may think.
How I read is that the framework will be enough to keep the reprieve going, and you're not going to see those sky-high tariff reciprocal rates. But how long to get an actual agreement?
Well, it can take time. And I think one of the things that they are not fully thinking through is that a lot of these countries, take a Japan or a South Korea, they don't just want relief on the reciprocal. They need relief on some of these sectoral tariffs, autos, electronics, other spaces. And so that's what's going to kind of really be driving them a little bit. I know right now the White House says, look, we think sectoral, that's national security, that's about reshoring. I think they're going to have to give a quick break. But in terms of, I mean, look, depends what the deal is. If it's, trading rice for LNG, sure, you can do that really fast. But if you want to get into the issues that the president really has identified as the problem, trade deficits, ag access, auto access, takes a long time.
Do we have a sense of who's leading these negotiations, who the architect is of the ultimate goals and the nitty-gritty, as you talk about?
Well, it does seem like, it sounded like yesterday they did a 2-on-2 with South Korea, and that I think is Bessent and Jameson Greer. Look, I think those two are the right people to lead it, but I think the Treasury Secretary will find that when you get into some of these topics, you really want your trade negotiator there. Again, these issues can go really weedy. How long the calf can be alive before we take the beef. I mean, I'm nitty-gritty, so I imagine ultimately a lot of this will get handed over to USTR. It's exactly what they know how to do. They're excellent at it. I just don't think anybody is even thinking you could operate on this time frame.
It seems like practical considerations and the reality of financial pain really is getting to the White House in terms of the meetings with some of the retailers. Do you have a sense of how much it's getting to the Chinese authorities at a time where they've expressed a great deal of patience, even though they are also experiencing a great degree of pain?
Look, I think, of course, they are, and this is not a good for either economy. And particularly on particular exports like chips and other things where they very much depend on the United States. But they do have a higher pain threshold than the United States. And I think my sense, being in the region, I'm actually on my way out there Sunday, is that they've been planning for a return of Trump for a long time. They've studied who was successful with him. They understand that if the United States retailers can, help negotiate this down before they even get in the room, that's really helpful.
You talked about the Trump magic earlier, but now that everyone knows his playbook and how he operates, is it much harder for him this time around?
Well, I think people are seeing, they are watching.
Because it looks like he's blinking.
Yeah, look, I mean, so far we have seen simply, I mean, I know the White House wouldn't want to call it unilateral retreats, but they do very much feel that way. Sometimes when you put too much pressure on the system, it feels like it's going to break, and it might. I think that's what they're feeling. I think most people would say the amount of tariffs at one time taking our country to the high 20s of a overall trade rate, import rate from, low single digits is too much for the economy at once. And so I think they are pulling back where they feel the pressure valves. I think the other thing is it's confusing to these countries exactly what they're solving for. We hear that from these countries all the time. What do they want? You saw Vietnam come in and say, well, we'll reduce our tariffs. That's not what this administration wants from Vietnam. They want some bifurcation, some distinction from China. That's much harder.
We've had the same problem this week here in Washington. We've asked various finance ministers, what is the ask? They've been very diplomatic about how they talk about the United States and the White House for obvious reasons, being here in the nation's capital, but they never really describe what the ask actually is. The ask from Wall Street right now is to move the conversation onto taxes and do it quickly. How quickly can we do that in Washington?
Well, I think you can move, again, you can do a framework and you can do transactional deals, but if you want to have anything that remotely solves the problem that the president identified, whether it is trade barriers or reshoring or any of these things, it's complicated. I think the first Trump administration, they did a very narrow Japan deal. It took a year. So I think we are going to get into a delay here, which unfortunately the market may be okay with, but the real economy is going to have a bigger problem. And these things are going to take months. Now, again, some of the countries are easier than others. And the other thing I think the White House isn't a surprise for is some of these countries, South Korea, Japan, they cannot go back to their countries with a deal that doesn't have some relief on autos.
Sarah, it's good to see you. Thanks for dropping by. Sarah Bianchi there of Evercore. One of these stats of the week for me that I saw from Ryan Pedersen of Flexport, good friend of this program, runs a logistics firm. He put this out. In the 3 weeks since the tariffs took effect, ocean container bookings from China to the United States are down over 60% industry-wide. And I imagine that's what the retailers, the likes of Walmart, Target, Home Depot, were warning about at the start of this week to the president, that the shelves could empty pretty quickly in the next several weeks unless they do something about what is effectively, in the words of many, an embargo. Coming up on this program, we'll catch up with Scott Devitt of Wedbush following a big quarter for Alphabet. That stock up in a pre-market. Equity futures just about positive. On the S&P here, we're up by 0.1%.
in case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Heading towards a solid week of gains on the S&P 500. 3 days of really decent gains of more than 1.5%. Equity futures this morning just about turning negative, but no drama compared to the gains we've seen over the last few days. On the Nasdaq 100, just about negative by not even 0.1%. With 3 hours to go until the opening bell, let's get you some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. It continues to be all about earnings. We had Google after the close, Alphabet reporting a really solid set of results driven by their advertising, their Google search business. They also had a good cloud result too, thanks to AI. So those shares up more than 5%. There'd been a lot of concern about Google heading into this result. Would the macro environment mean, for example, that retail advertisers pull back? We didn't see evidence of that. So things like CapEx continue at a healthy pace. You can't say the same for Intel. In fact, they talked about cutting CapEx. They talked about cutting employees, matching the Bloomberg scoop from earlier in the week. Those shares declining 6%. It was the first earnings set of results with the new CEO, basically laid out wafer-thin expectations, didn't give any splashy numbers of goals that they wanted to reach, and talked about having to make difficult decisions ahead. Another rough set of earnings came after the bell yesterday from T-Mobile. You can see that reflected in the share price, down 5 1/3%, adding less mobile subscribers than expected. Not as bad as Verizon, which lost subscribers, but still another bad set of results. It seems only AT&T out of the 3 big had a really strong performance. I gotta say, elsewhere, T-Mobile, the earnings were okay, but those subscribers not living up to expectations. Really, what's hurting them this morning, John?
Danny, thank you. More from Danny later on in the program. Let's get you some top stories on our radar this morning. China reiterating that it's not engaged in trade talks with the United States. The comments coming after President Trump said his administration is negotiating with China. An interview with the President of the United States just dropping across the wires. The President sitting down with Time.
Very interesting when it comes to Time and how they got to this reprieve. He's asked about, were you worried about the bond market and the stock market? I wasn't worried. He said that his advisors, Scott Besson, Howard Lutnick, didn't tell me. He said, I did that. And then what made you decide? He said, it wasn't for that reason. There wasn't a reason. I'm doing that until we come up with the numbers that I want to come up with, which begs the question, if these weren't the numbers you wanted, why did you come out with that chart on April 2nd on Liberation Day? I was there in the Rose Garden, pomp and circumstance. Everyone was dressed up. There was music, flags. Then they started handing out the reciprocal tariff rates. And what did you see? Equity futures tank.
Initially, equity futures rallied because people thought we were going to have a baseline tariff of 10%. And then that little display came up with all these massive numbers, and we all said the same thing. What is this? So how quickly can we do something about this? The president, Lisa, saying we can announce deals over the next 3 to 4 weeks.
And that seems to be reflected by a lot of finance ministers who are here. But as we just heard from Sarah Bianchi, trade deals aren't exactly a, hey, let's do one. Okay, great, we've done one, and here it is. So this is the challenge right now. How much does reality match the rhetoric? And what is going to take the temperature ultimately down between the 2 biggest economies, which is China and the United States, which is going to be difficult given that we don't actually know whether there has been a call between Xi Jinping and President Trump. He said, yes, he has called me. Xi Jinping and the authorities from China say there has not been a call, so the mystery will continue.
My favorite headline from this interview is this one right here. The president signaling some support for a ban on congressional stock trading. I think that a lot of people would support that as well. Why have we still not got that done in Washington?
Because you're asking members of Congress to ban themselves from trading. And it might sound like a good campaign idea, and then you get in the seat and you're like, actually, I don't want to be doing that. I have money in the stock market. I don't want to be doing that. But like you and I,
we follow stricter rules than them.
We have very strict rules. We cannot touch everyday trading. If you want to put your money somewhere, you do it blindly, basically. The president signaling that, I think will be interesting. Maybe they can get across the finish line.
Let's see if we can finally get this done. News elsewhere, Walmart doubling down on discounts, the company looking to drive demand and grow market share. Bloomberg learning the retailer is rolling out managers' special signs, calling out price cuts on key items, something you flagged a number of weeks ago, Lisa, and this is ultimately the direction of travel for this company.
They're going to invest in price, which basically meant they were going to absorb it on their margins to gain market share. The unintended consequence of some of this uncertainty is who has the most resilient balance sheets. It's the biggest companies. It's the ones that have the heft to go into places like China and negotiate. You also have Walmart coming out and saying that they're going to help local companies in China to actually circulate their goods. They're making themselves indispensable on both sides of the world. This highlights how it just prolongs what we have seen over the pandemic and exacerbates it, which is smaller companies are going to have a much harder time than the big ones.
Who's going to have the inventory? That's another question for some of the bigger names as well. Clearly, they're worried about that in the coming weeks. Let's get you an update on the earnings. Alphabet reporting first quarter earnings that beat expectations, driven by strength in its search advertising business. It's a different story for Intel, delivering a weaker than expected outlook. Intel in the pre-market's down by 6.7%. Alphabet is up by close to 5%. Let's keep it on Alphabet and on Google. Scott Devitt of Wedbush raising his price target on the stock, citing optimism about Gen AI's impact on search. Scott joins us now for more. Scott, welcome to the program, sir. Great to get your insight. I'm sure it's a busy morning for you and the team. I just want to understand what happened with the ad business, because this is a decent read on the broader economy. What stood out for you, and do you see the gains as sustainable through the rest of this quarter?
Good morning, Jonathan. So the ad business, or search specifically, outperformed expectations in the quarter by 100 basis points. So they did 10% top line growth for search, and that was really the overperformance from a revenue standpoint in the quarter. YouTube and the cloud business were in line. The company also overperformed in operating margin as well. And so I think, we've hit peak uncertainty for, the economy and companies like Alphabet, where you're now starting to check off boxes where, hey, this isn't as bad as we thought it could be. So you fast forward to kind of 2Q, the company doesn't give formal guidance, but gave qualitative guidance. And, our numbers, which had been below the street for 2Q, still are below where the street was, but not quite as much as it was before the call. And so I think net, this is a very positive report, especially given the stock was 200 3 months ago.
Scott, interested in the read across for Meta as well. And I guess the most important question there, one of the most important questions, is how the retailers are doing in the Asia Pacific, the kind of advertising they're doing at the moment, and whether you expect them to pull back anytime soon, given some of the restrictions we've seen come through.
Right. That's the one thing that stood out in the 2Q qualitative guide for Alphabet, which is that the de minimis exemption does go away, that will impact advertising spending by Chinese e-commerce companies from these U.S. advertising platforms. And Meta has more exposure than Alphabet. About 3.5% of its revenue comes from the Chinese e-commerce companies, and with Alphabet, it's under 2%. But I would anticipate that's going to be a headwind in the second quarter and really throughout the year. It's priced in, and it's now in expectations because it's pretty well advertised that that's coming. So I don't think it's new information, but it will proceed to be a headwind this quarter.
Scott, can we say that Alphabet is ultimately an advertising company, or has it shown enough progress with the cloud computing services, the number 3 in the industry, that you're growing more confident about the revenue stemming from that business?
I think you put it well. I mean, there are 3. There's room for 3, but they're a distant 3 in the category. 28% top line is healthy, but given the size of the business, in terms of absolute dollar volume growth, Azure and AWS continue to kind of run over GCP. So that's a good business, but the success of this company over the long term and where the fears have risen more recently have been around the AI impact on search. And quarter in, quarter out, Alphabet just continues to beat search expectations, is integrating AI into the search results and building out that business as well. And that's 2/3 of the business. This is a company now that trades at an S&P multiple, and we forecast the earnings growth rate for the next 5 years being 2x the S&P. So it's a very maturing tech company, but still a very well-positioned company, and one that we think is mispriced for that reason.
And Scott, part of this is not just the AI with respect to search, it's also the AI with cloud computing and how they're integrating it. And one thing that they doubled down on was the investment, the capital expenditures that they had committed to for cloud computing centers that a lot of people had called into question just based on the rhetoric that we've been hearing. And we'll hear more next week when we get a whole host of other big tech players reporting earnings. Do you think that the death of some of the AI boom, particularly in the infrastructure space, has been grossly exaggerated?
No doubt. I mean, you've had Alphabet now twice reaffirmed CapEx. Microsoft's reaffirmed. Amazon has said no real changes. NVIDIA's made commentary recently. Meta's made positive commentary. So this air pocket, or whether there was a natural air pocket approaching anyway, according to some, or the effects of tariffs and the economy on the business, it's not showing up in CapEx spending. Now, that doesn't necessarily mean there couldn't be impacts in terms of cloud growth because customers are pulling back a little bit in the short term. But in terms of the interest of these companies to continue to build ahead of this AI revolution, that was definitely affirmed in Alphabet's reaffirmation of the $75 billion last night.
Scott, we're all in Washington, D.C., and Google returned to Washington, D.C. earlier this week for a court case with the DOJ. How are you seeing this play out?
So there's two cases. One is, going directly at the search business, and I think that's probably the one that, to the extent that there was a negative outcome, would be more damning to the business. It's not one where we think it will be something where they have to do something like sell Chrome, but that's the one that we pay more attention to, because the second one, which is on ad tech, the ad tech business for Google's declined in revenue for 11 consecutive quarters. It's slightly more than 10% of revenue, but it's about a single-digit percentage of the profitability. You could extract that business, and the stock would probably perform positively on the back of that because it would remove an overhang related to antitrust. So I think the second case, the ad tech case, is a total non-event, and the one to pay attention to is the one related to search. And we'll just have to continue to monitor. It's not in the best interest of the U.S. government to really kneecap any of these large companies, given the battle that we're in with the large companies in China. And I think in the end, they'll come to that conclusion as well.
Hey, Scott, appreciate your time. Scott Devitt there of Wedbush. Alphabet doing better in the pre-market. That name is up by something like 5%. Equity futures more broadly down about 0.25% on the S&P. Moments ago, a release of an interview, the transcript between the President of the United States and Time, and an interesting exchange on a range of things, but importantly for a lot of you out there following markets, whether these talks with China and Xi Jinping have actually happened or not.
The president says yes. Xi Jinping has called, and he says, I don't think that's a sign of weakness on his behalf. So even if Xi Jinping, and now I feel like I'm gaming out something in the president's mind, but even if Xi Jinping has not called, the president is putting out there, yet once again, it is not a sign of weakness for you to pick up the phone and call me. Another interesting point. He's saying the fact that he thinks that basically where they are right now with the tariff rates is unsustainable. They won't do any business here. At 145%, it's going to be very rare that you see business. And this is what the Treasury Secretary said to me about a week ago, saying it's unsustainable. No one wants to see these rates stay this high.
Something Scott Besson has repeated time and time again. Equities right now down about 0.25% on the S&P with an update on stories elsewhere. Let's get an update with your Bloomberg brief and Yahara Hackers. Hey, Yahara.
Hi, John. Germany's finance minister says the best path forward for an EU-US trade deal would be to eliminate tariffs on industrial products. He spoke to our own Lisa Abramovic on the sidelines of the IMF meetings.
Of course, the devil is in the detail, and there's still a lot of topics that are open and that need to be ironed out. But there's a willingness on both sides to come to an agreement. At the end of the day, if it's generally the direction of travel were for tariffs to come down instead of go up, I think the markets would see that as a very positive signal.
Later today, Lisa will be hosting a panel with IMF First Deputy Managing Director Geeta Gopinath at 12:30 p.m. Eastern. Meanwhile, Japan is trying to strike a trade deal with the U.S. to avoid tariffs, but doesn't want to be part of a U.S.-led economic bloc against China. Sources telling Bloomberg Japan is pushing to strike a deal before the current 90-day reprieve expires. The country's lead trade negotiator is due to return to Washington soon for a second round of trade talks. And Apple is aiming to shift major parts of its supply chain out of China. Sources say the company is planning to make most of its U.S.-sold iPhones in India by the end of next year. That means Apple will need to roughly double its iPhone output in India. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on in the program. Up next, boosting rate cut bets.
Wouldn't surprise me that you might start seeing more layoffs. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Governor Waller becoming a more and more important voice on the FOMC. In just a moment, we'll get the outlook from Mike McKee, who sat down with Governor Waller yesterday, and we'll get some reaction from Nathan Sheets of Citi. Live from Washington, this is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from Washington this morning. Good morning to you all. Equity futures on the S&P 500 shaping up as follows. Your scores into the weekend look like this. Down about 1/3 of 1%. Some losses building in the last 15 minutes or so, but nothing too dramatic relative to what we've seen to the upside over the previous 3 days on the S&P. On the Nasdaq 100, negative by about 0.4. Small caps underperform, down by 0.9. Other surveillance this morning, boosting rate cut bets.
Wouldn't surprise me that you might start seeing more
layoffs, tick up in the unemployment rate going forward, if the big tariffs in particular come back on. You might see layoffs start to happen about the same time you start seeing prices going up. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
So here's the latest. Traders raising their rate cut expectations following that conversation. Governor Chris Waller of the Federal Reserve sitting down with Bloomberg's Mike McKee, and Mike joins us now for more. Mike, fantastic exchange with a voice that is becoming increasingly important on the FOMC. From your perspective, following all the speeches and the commentary from the Federal Reserve over the past few weeks, is that Governor Waller speaking for Governor Waller, or do you think that reflects the consensus on the committee?
I think it's a little bit of both. Governor Waller speaking for Governor Waller, definitely. But the committee itself has, almost all of them have said the same thing, that if we see a deterioration in the labor market, we're probably going to have to cut rates. Now, the question is, how much of a deterioration counts for each one of them? Chris Waller was saying, you know, we'd have to move up fairly dramatically in order to get him on board. And he said we aren't going to have any data, really, to do that until after July 1st when the president's 90-day delay runs out. So I'm not sure it'll be quick in the sense of moving up into the time frame we're in now. But what he was saying was if we get that deterioration, then the Fed will move fast.
Mike, some people read speeches and look at exchanges like that one from Governor Chris Waller, and in the market at least, and I'll share the perspective on Wall Street, they look at that and they say he's running. He's putting some daylight between himself and Chairman Powell, and he's looking for that open seat on the committee in the next 12 months or so. Mike, what's your perspective, being close to the FOMC yourself? How do you think about that dynamic?
Well, I think there's definitely a dynamic at play there because everybody knows that one way or another, Jay Powell's not going to be chairman after May of next year. So there will be an opening for that. Now, Chris is already on the board, so he doesn't have to worry about getting nominated to the board first, like some other candidates would. But I asked him about it. He said, yes, there's maybe some daylight between me and Powell, but at the end of the day, we both do the right thing for the economy. I think he would probably take the job if it were offered to him because, of course, he's been doing central bank work for his whole career. And so it's kind of the pinnacle of the career path for him if it were to be offered.
I think it's fair to say he'd probably take that job. Mike McKee, thank you. Great work as always. More from Mike later on this morning. Here's the take on the economy. Nathan Sheets of Citi writing the following. We see global growth this year softening to 2.1%, down from under 3% last year. Given the trajectory of recent developments, the risks to our forecasts are skewed to the downside. Nathan joins us now for more. Nathan, good morning.
Good to be here.
How much has changed for you and the team in the last 4 months?
Oh, this is a completely different world. One, as you read, our view is that global growth this year and next year are both going to be much weaker. But even beyond that, it's deeply structural. And I think we felt that this week during the bank fund meetings. The U.S. has been the center of the system for decades. And now the U.S. is standing up and rejecting in very fundamental ways key features of the system. And I think the rest of the world is just kind of looking around and saying, what's next?
They're the near-term effects and they're the longer-term ramifications. In the near term, all of the finance ministers and central bankers are saying we need the dollar to be the reserve currency. How much do you expect that, though, to change longer term? And are they questioning that in private conversations with you?
I think that's one of the leading questions that I'm hearing is what about the dollar's role over the medium to long run as reserve currency? But even if we extrapolate out 5 to 10 years, it's still not clear that there are really any real challengers for the dollar in that role. And I think most say, well, you know, we're kind of stuck with the dollar. But then the question comes, at what price? And I think that question of risk premium on U.S. assets is one that markets are struggling with as we speak.
Which goes to the question of weakness. And if there is some sort of downturn in the United States, what is the fiscal impulse and the ability for the United States to borrow into weakness at a time where we have near record deficits as a percentage of GDP and you have this structural shift going on?
If we have a downturn, and that is a very reasonable, plausible scenario, many people have that as their baseline forecast. If we have a downturn in the United States, the implications for the U.S. fiscal deficit are grim. we could be, again, easily knocking on the door of 10% fiscal deficits. And in that environment, do I think the Treasury can issue? I do. But again, at what price? What do those yields look like? What are the risk premiums? And I think that's the question we're going to be struggling with in the years ahead, is where is this risk premium going?
The president this morning speaking to Time magazine saying that he didn't get the yips, the bond market got the yips, but it wasn't the reason why he came out with that pause, even though everyone is saying that was the Trump put in action. Do you think that it is this bond market that is putting pressure up against this administration to come out and tweak and change policy?
I think the bond market has been front and center in this. I think it's the financial markets more broadly. But I also think it's the discussion with CEOs and what he's hearing. And I think it's political realities. I think there was a lot of pushback to this tariff policy. And I think the upshot of that is that we've officially now moved, it seems, from the phase of announcing tariffs to the phase of negotiating what these tariffs are ultimately going to look like. And maybe that's progress.
When it comes to China, the 145% is unsustainable. Everyone continues to say that. But even if we go to 60%, which was what the president talked about on the campaign trail, is that still, in essence, a trade embargo between Washington and Beijing?
145% tariff is prohibitive. And I argued during the election that a 60% tariff would be prohibitive. It would destroy many supply chains and mean a lot of shelves at various stores were empty. So absolutely, 60%, we're going to still see sharp declines in imports from China with negative ramifications throughout the economy.
We've seen some pull forward, and certainly we've seen that in retail sales, and we're probably going to see that in inventories too. I want to understand from your perspective how much time we actually have here. It takes somewhere between 20 to 40 days to get a ship from China to the United States. Tariffs went on April 2nd. How close are we?
This is another issue that we're debating in real time. My view is that the second quarter is likely to be okay, that we've seen the soft data fall off, but the hard data are lagging, and they're going to continue to lag as people continue to front load inventories and probably certain types of consumption. But the third and fourth quarter could be pretty ugly. I think that's the heart of darkness.
How convinced are you and the team that they'd respond quickly, the Federal Reserve being they, to any sign of weakness?
The Fed is in a very tough place here, where the bond market is equally focused, if not more focused, on what's going to happen with inflation. And so what the Fed has got to do is make sure that inflation expectations are well anchored. And once that's achieved, then they can pivot to rate cuts. And I do expect that by the end of the year, we'll be seeing rate cuts, but it could take us a few months, and it may not be at the first sign of weakness.
And that could mean a lot of pain in this market still to come.
It absolutely could.
Nathan, it's good to see you. Thank you, sir. Nathan Sheets there of Citi. Chairman Powell has basically made the point, Lisa, of suggesting that he is pledging to anchor inflation expectations. Governor Chris Waller was putting the emphasis elsewhere in the last 24 hours.
You're basically saying at the first sign of weakness in the labor market, then maybe we could take a shift. You know, Beth Hammack had the similar kind of commentary, so he's not alone in this. But how long is it going to take for that weakness to show up? And that's increasingly the question.
More on that story in just a moment. Equity futures on the S&P, a bit softer here, negative by 0.5%. In the next hour of Bloomberg Surveillance, we'll catch up with Jason Thomas of Carlyle, the former Deputy Treasury Secretary Wally Adeyemo, the WeWork CEO John Santora, and the IIF President Tim Adams. That's all still to come from Washington. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The outlook for markets are very, very uncertain.
All of this has been a disruption to the way America does business.
Companies are really good at adjusting. I would still bet on Fortress America from a corporation standpoint.
This is not the time to get out of the market, right? You need to play this out.
This too shall pass. And I'm still looking for the roaring 2020s to be a description of the entire decade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital this morning, good morning to you all. For our audience worldwide, your scores this morning looked like this on the S&P 500, following 3 days of gains on the S&P for the first time since April 2nd, Liberation Day. We pulled back this Friday, going into the weekend, we're down 1/3% on the S&P. On the NASDAQ 100, we're down by 0.4. Lots of warnings this week from corporate America, American Airlines pulling their outlook, Southwest saying the industry is already in a recession. Some soothing numbers in the bond market, though. For the second consecutive week, bond yields are lower. That is good compared to where we were a number of weeks ago. Yields down again this morning by a basis point at the front end, down by 3 at the long end. The 10-year, 428.17. The rhetoric has improved. The policy hasn't changed too much. And for that reason, Torsten Slock of Apollo writes this morning. The consequence will be empty shelves in U.S. stores. Lisa, in just a few weeks.
This is the concern, and maybe this is what was expressed by some of the retail executives who came to Washington, D.C. before the pivot or a shift in tone. This idea that the pain has happened, you just haven't seen it yet. It takes a while for those container ships to get over to the United States. Here's the question. What is the end number that we're going to? Let's say we do get a ratcheting down of the 145% tariffs on China. As we just heard from Nathan Sheets of Citigroup, 50%, 60% is also prohibitive. So at what point will there be a whole rethink of the structure of tariffs as it's been laid out?
And that could potentially why we see this rhetoric coming out of the Oval Office. This morning in Time magazine, the president said Xi Jinping has called him. He wants to do a deal, also at 145%. These tariff rates are unsustainable, probably because those executives, like the Walmart executive, walked into the Oval Office and painted this apocalyptic picture ahead of back to school, ahead of holidays later this year. This is not something you want to do as you ran on trying to bring prices down. Groceries, gasoline, everyday goods for America.
The corporate America has had its say this week, that's for sure. You mentioned that meeting at the start of the week. The most important meeting that took place in Washington, D.C. this week so far. The pressure from the likes of Walmart, Home Depot and Target on the administration. I think we've got to deal with this up front. Where are we in talks? The Chinese have repeatedly over the last several days said there aren't any.
And today, the Chinese Foreign Ministry came out and said on no level are there negotiations, and that said that this administration is misleading the public. What I think you see the president doing is wish casting, because potentially what he's saying, and he said to Time magazine, is it wouldn't look weak, Xi Jinping, for him to call me. So maybe he's trying to insinuate and tease out there, Xi Jinping, I'm available, pick up the phone.
The president attempted to dial down the temperature this week. That's helped out equity markets. This morning we pulled back just a touch. We're down a third of 1%. Coming up this hour, we'll catch up with Jason Thomas of Carlyle, with stocks looking for a fourth day of gains. We'll speak to the WeWork CEO, John Santora, on business confidence in America, and the IIF president, Tim Adams, on the latest with US-China trade talks. We begin this hour with this week's rally on hold as China downplays progress in trade negotiations. Jason Thomas of Carlyle writing, if Treasury yields do not decline when stocks sell off, investors may discover they've been paying for a hedge that no longer works. Jason joins us now for more. Jason, good morning. Good to see you.
Good to see you. Thanks for having me.
I'm pleased you've picked up on that piece because I want to pick up on it with you as well. This EM-type dynamic that started to take hold of U.S. assets, dollar-denominated assets, what's behind it, one, and do you think it's sustainable, two?
Well, I think, first of all, we have to remember that bonds are volatile in a way that cash is not. So at the start of this month, if you had $100 invested in money markets, it was yielding 4.3%. The 10-year Treasury at the time, 4%. A week later, the cash was still at par, as it always is. The bond was down to 96. And so in the past, there's generally been, of course, a term premium to compensate for the volatility. That went away in the decade after the GFC. Why? Because anytime there was a hint of weakness in the economy, anytime there was a decline in stocks, the Fed would launch another round of QE, with, of course, the intention of driving down bond yields. So, of course, there were many risk parity strategies. You had investors who were hedging their stock market risk through leveraged positions in bonds. That worked very well. Some years, stocks down 12%, those leveraged bond positions up 15%. Now, I think we're in a somewhat different world. Partly, of course, that's the external sector wondering about being over-allocated to the U.S. That's stocks, that's bonds, I think more broadly. The deficit, when you think about how large the deficit is, this year, Treasury net issuance is consuming over 42% of U.S. private savings. That is the savings of the household sector, the free cash flow of the corporate sector. So, you know, if this is not going to be financed in large part by external investors, you have to wonder what the market clearing interest rate is going to be. So I think that what we're seeing is that if there is not this hedge, if treasuries do not predictably rise when stocks fall, then there has to be a much larger risk premium on bonds relative to cash. And if you look historically, the 1980s, 1990s, that was in the range of about 150 basis points.
So it feels like that process is underway. We're working our way through it. Without doubt, you can see it on the screen in the price action of the last several weeks. I want to understand from your perspective how investors should now manage that risk. They've got very used to having this ballast in the portfolio that treasuries typically provide. Where do you go now?
Well, of course, I would recommend that people go to private assets, particularly private credit. But I think that the general portfolio thoughts have to be re-examined. There's talks of, of a 50-30-20 portfolio. But in general, it's that what worked so well in that decade after the GFC is not going to work today. So whatever your solution is, there needs to be a rethink. And I think that, again, it's been so ingrained that treasuries are supposed to rise in value when stocks fall. There's no mathematical law that's supposed to occur. And again, the return correlation with stocks and bonds was positive in the 1980s and 1990s. So this is not entirely new.
Yeah, there is a larger consequence here, though. I'm thinking through as you're saying this, and if you're talking about a clearing price that's different for treasuries to account for that additional risk premium, we could be talking about 5.5% on 10-year treasuries pretty easily based on your calculations, which would have a massive effect on private asset valuations, which would have a massive effect on stock valuations, which just kind of really speaks to this question of whether it's a sell America trade.
Well, I think that, again, if I were thinking about exposure today, it would be short duration. I see a lot of duration risk in the market. And I think generally investors have not had to worry about duration risk. You know, it's again, the mindset is whenever we get into trouble, there's going to be another round of QE, and they're going to drive down longer-term yields. Now we're in a situation where those prices could move in the opposite direction, and that actually compounds losses. I think that the issue right now also, the Treasury is funding 22% of the outstanding stock of debt in the bill market, in the money market. There's of course a desire to term that out, but there's of course a hesitancy. We want to wait for the right time. I think people were hoping that the 10-year would fall below 4%. Then let's term out some of that debt. And by waiting, they might be in a situation where they have to term it out at much higher yields. So it's certainly a concern. And I think, as was mentioned earlier, if you do have a downturn, if you have a decline in tax receipts, if you have an increase in transfer payments, just the scale of debt issuance, and now you go from 40% to 50 or 60% of private savings being consumed. So again, I think it's taking the short-term assets. Sometimes the credit spread on that is less risky than the duration spread of holding longer dated assets.
Has this dynamic removed a lot of the power from the Federal Reserve to really address downturns? And I say this at a time where potentially if they drop rates right now, that will only lead to a furthering of this trend of yields in the long end going up.
It's a great point, but we have to remember the Fed is an extremely dovish institution. I mean, and of course they say that's because of the dual mandate. But I mean, think about 1998. The U.S. economy in real terms growing at 4%. Employment to population ratios at all-time highs. The enthusiasm of the stock market. This is 2 years removed from Alan Greenspan's irrational exuberance speech. And they cut rates by 75 basis points because the hedge fund failed. When you think about 2020, the way they did the autopsy of the last 10 years and the statement for policy goals going forward, they said the big mistake in the decade of record monetary accommodation was hiking too fast in 2015. So the Fed is going to cut this year. I mean, it's funny that this is like controversial or, oh, the Fed's in a box. The Fed is going to cut, and likely by September.
But how much has the pandemic actually hit them hard in terms of wanting to make that mistake again? Governor Waller said that to Mike McKee, that idea of being transient. He's even nervous to say that word out loud.
I think that this is what Chair Powell has made clear is they can't do preemptive cuts. They have to wait. They have to see.
Didn't they preemptively cut before the election?
Well, I think there was certainly a strong case for rate cuts in September. Now, whether they needed to cut by 100 basis points in just over 3 months, again, this is sort of the dovish nature of the institution coming to the fore. But I think that this is a situation where if you are cutting as tariffs are first taking effect in terms of the increase in the price level, you could accommodate a spiral. So they have to wait. But we're talking about waiting a couple of months. This isn't really, an elongated pause or anything of that sort.
You've said a lot of things that require some real deep thought. There's one thing that scares me. Typically in an economic downturn, bonds rally. And that allows a government to act counter-cyclically. A developed market government, EM, of course, face a very different dynamic. Are you saying that if we go into a downturn, the long end doesn't rally?
I think that the rally is going to be muted. And so, again, if we think, I think the Fed will be more cautious this time, of course. But imagine that we have base rates in the 365 range. Well, these yields actually might be appropriate given the risk premium, the term premium that is required. Maybe you get down to something closer to 4%. But again, I think the important thing as investors think about the next 5 years is that if bonds do not rally in this scenario, that on a prospective basis, when the economy recovers, that they're going to need to target much higher yields, that compensation for the bond price volatility that doesn't exist in cash.
Jason, this is an important exercise, and I'm pleased you dropped by this morning.
Thanks so much for having me.
Thanks for being here. Jason Thomas there of Carlisle. Just to touch base with your bond market right now, we're doing okay. Yields are down by 2 or 3 basis points. 420, 430 on 10s is where we've been over the last few weeks or so. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahira Hackett. Say, Yahira.
Hi, John. The U.S. is said to be demanding that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Sources say U.S. envoy Steve Witkoff will travel to Russia to raise the issue with President Putin. It's a sign the Trump administration is seeking some concessions from the Kremlin, as well as Ukraine, as it tries to end the war. Meanwhile, Skechers shares are falling more than 7% in the pre-market after the company withdrew its full-year outlook. The shoemaker cited macroeconomic uncertainty stemming from global trade policies. According to regulatory filings, Skechers, like many other shoemakers, makes a significant portion of its footwear in China and Vietnam. And Alphabet shares are rising 5% in the pre-market after reporting better than expected earnings. Interestingly, the company said its first quarter profit got an $8 billion boost in unrealized gains from an investment in a private company. Sources tell us that company is Elon Musk's SpaceX. Google has been a major investor in SpaceX since at least 2015. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later on this hour. Up next on the program, conflicting reports on trade talks.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is.
We're trying to attempt to find out who they actually is. We'll catch up with the former Deputy Treasury Secretary, Wally Adeyemo, in just a moment. Live from Washington, D.C. You're watching Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equity futures on the S&P 500 just a little bit softer so far this morning, following a 3-day run of gains on the S&P 500. Under surveillance this morning, conflicting reports on trade talks.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So here's the latest this morning. China continuing to deny trade talks with the United States, even as President Trump says negotiations are ongoing. A little bit more insight into the president's thinking in the last few hours and a new interview with Time magazine. With the latest on that front, Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Yeah, hey, John. Well, this new interview with Time magazine was released today but conducted back on Tuesday. And in it, President Trump contends that he has no plans to call Xi Jinping if the Chinese leader doesn't pick up the phone and call him first. But at the same time, he suggested that Xi has phoned him, although he did not give a timeline on exactly when. And it's probably worth saying that, of course, these leaders have had calls before, most recently right ahead of the inauguration. Now, President Trump, though, did reiterate that he thinks the 145% levy on Chinese goods is very high, amounts to a trade embargo, and suggested that he knows the tariff rate that Beijing would be more comfortable with seeing. It comes after our Bloomberg News reporting this morning that China is preparing to potentially exempt some U.S. goods from tariffs, including those industries that are more import reliant, including medical devices as well as industrial chemicals, in a bid for Beijing to protect its own economy. Of course, we're talking here about the disconnect between Beijing and Washington, particularly when it comes to where talks currently are situated. But President Trump in this interview did say when it comes to other talks, other trade deals, we could expect to see those in the next 3 to 4 weeks. Although earlier this week, he told us that we could expect to see revised tariff rates in the next 2 to 3 weeks. So clear that the timeline here is, of course, very fluid. And, of course, we still don't have details on exactly what we will end up seeing. And, John, I will quickly leave you with this. One thing that President Trump did say in this interview, when asked if higher tariff rates were still in place 1 year from now, would that be considered a victory? He responded that it would be a, quote, total victory.
Tyler Kendall with the latest from the White House. Tyler, thank you. Here's a take from a man who's seen it all, the former Deputy Treasury Secretary Wally Adeyemo, writing, "The only way we can address the China problem is by working with other countries. But for many of them, they're still waiting to hear what the U.S. even wants." Wally joins us now for more. Wally, good morning, sir. It's good to see you.
Good to see you here. Thanks for coming to Washington, D.C.
You've been in the room with the Chinese many times. How difficult is it to negotiate with them? Just set the scene. What is it like?
The reality for the Chinese is they are very systematic in trying to find your weaknesses by both talking to you directly, but also talking around you to other people. So when you are negotiating with the Chinese, you have to be very clear about what you want. You have to repeat it over and over. You need to tell your friends and your allies in the hopes that you'll get 50% of what you want in that conversation. And it's always about how do you make progress rather than perfection with the Chinese.
You referred to the China problem. What is the problem? And what do you make of the approach so far?
The reality is, and over the course of this week, in addition to getting to see you, I've gotten to see a number of my former counterparts. And the thing you've heard from our closest allies is just disappointment, because they all face the same challenge, which is that China takes steps to subsidize their industries and export excess capacity to the world. And the challenge we have in the United States is the same challenge they have in Europe, is the same challenge they have in parts of Southeast Asia. And for many of them, they want to work with us to address this, because if the U.S. blocks Chinese goods from coming to America, the people today who are afraid those goods are going to show up on their shores are in Southeast Asia and in Europe, and they now need to think through what are they going to do to deal with China's excess capacity that's coming in their direction.
Let's look at Europe. Are they speaking with one voice? We had the Spanish finance minister in the room here yesterday, and John picked up on something he said. He called it China an ally, and we have seen the Prime Minister, Pedro Sanchez, go to Beijing 3 times in the past 2 years. It feels like they're placating to China and actually not coming on board with the United States.
So I think you're right. That's part of the challenge, is that Europe doesn't speak with one voice, because today, if Europe did speak with one voice, they'd be in a better position to negotiate terms. Europe is the 3rd largest economy in the world. If they were willing to work together to do things like put in place the free trade agreement they have with other countries, and to go and work with the TPP countries, they'd have the ability to dictate more terms. But today, because they're unwilling to, they're caught between China and the U.S., and that's the most important thing for the Chinese. They're concerned that if they don't find a way to dial back this, they're going to end up in a place where countries like Europe or regions like Europe or other countries will choose the U.S. over them. But unfortunately, the approach the Trump administration has taken has, instead of bringing Europe closer to us, put them in a place where they're up for debate. And you hear things like that from the Spanish in terms of, Are we allies with the U.S.? Are we allies with China?
And then Rachel Reeves in the UK and along the sidelines of the IMF is saying things like Trump is right. China does need to rebalance their economy. How difficult was it for you and Treasury Secretary Janet Yellen to get that message across to China? You have to start rebalancing your economy.
And this is not a new message. Secretary Paulson sent it to the Chinese, Secretary Geithner, Secretary Liu, Secretary Yellen, and I know that the current secretary is sending it as well. The truth is that China is only going to respond if they feel pressure, and it's not just going to be from the United States. They've got to feel it from the UK, they have to feel it from Europe, and the best way to do that is to work together to confront the Chinese. Today, the Chinese feel empowered because instead of being confronted by the world who's suffering from their excess capacity, the United States in lots of ways has alienated the world. The hope over the next few weeks is that Secretary Bessent and the President are going to be able to work with our allies and partners to find an approach that works, because the people who are going to suffer most from this are American consumers. You could see their bills go up by $3,000, and that's not just the statistics. You heard all of the CEOs who've been doing earning calls who have said that they're going to have to raise prices. And they've all said that they had great first quarters because the economy is doing quite well. So we're in a place right now where if the United States doesn't get into a posture of working with our allies and partners and reducing these tariff rates, I can't guarantee that we're going to have a recession, but I can say that prices are going to go up for American consumers.
Is it too late to really create that alliance and go after China? Has China already made inroads in terms of making alliances, whether it's with the Spains of the world or even in Southeast Asia?
So the interesting thing I've heard over the course of the last few days here is that people are equally as nervous of American tariffs as they are of Chinese excess capacity. So the people who live in Southeast Asia, the people in Europe, are worried that all those goods that were headed to the United States that were hurting our industrial base are heading to a port near you, and that China's excess capacity is going to overwhelm them. So I don't think it's too late, but our allies and partners are going to be more cautious about dealing with us. But the reason that countries are coming to the United States is because they want to make sure that their industries and their countries aren't overwhelmed by Chinese overcapacity either. So there is an opportunity here, but it's not one that's going to be open forever. And the Chinese are working hard to try and counter that. President Xi's visit was all about trying to buttress their ability to have allies and partners as the U.S. confronts them. But Vietnam, in addition to gaining a great deal of economic value from their relationship with China, has to be worried about Chinese excess capacity showing up there as well.
There was a story in the Financial Times and on Bloomberg about how Apple was moving all of its iPhone production away from China into India. Hopefully by the end of next year, hopefully for them, that is the projection they put out there. Is that how this is going to work from what you hear, that essentially India is going to be the big beneficiary from a lot of the tariffs, particularly on China?
That's how it's worked the entire time. Since basically the Obama administration, a number of companies have been moving to a China plus one strategy where they build for China in China and they build for everybody else somewhere else. That's been Vietnam, Malaysia, India. But the problem has been Chinese companies have taken a China plus one strategy too. They've moved away from the tariffs they put in China by setting up shops in Vietnam, Malaysia, and probably now in India too. That's why we have to work with these countries, because the Chinese are being very clever about this. They see the huge tariffs that are being placed on them in China, so they're setting up shop. And my understanding is that a big part of the negotiations with Mexico and Canada is around making sure that Chinese firms can't set up plants in Mexico. Ultimately, I think that they should be able to get to a deal with Mexico and Canada because we're such an integrated economy, but it's going to be harder to get to those kind of deals with countries that are closer to China.
Wally, I've got 30 seconds left. Is there anything you wish you'd done differently with regards to this topic?
I think the reality is that the thing you always hope that you could do is get to a deal with your allies and partners to confront the Chinese. But the other thing that I think is clear is that tariffs work when you use them strategically. They don't work when you use them in a broad-based way, because what that does is it causes more pain for your consumers and your allies. And the thing that's worried me a great deal is talking to asset allocators around the world. And for each one of them, they've been overweight the United States for a long time because of the exceptionalism of our economy. But today, each one is talking about reallocating their assets. Hard to find other places to do that in the short term. But if over the long term we don't provide clarity and certainty, the things the the American economy has done over the last decades, I do worry about our ability to attract capital into the United States.
Wally, it's good to see you, sir.
Great to see you.
Thanks for being with us. Lots to talk about, particularly the deficit. Got to talk about that with Wally at another time. The former Deputy Treasury Secretary, Wally Adeyemo. From New York, this is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
As of Thursday at the close, we're heading towards a decent week of gains on the S&P 500, even with losses. Monday morning of more than 2% into the close on Monday, the first trading day of the week. We're still higher on the week by 3.8% on the S&P, thanks to the rally over the previous 3 days. Elsewhere on the Nasdaq, we're negative by about 0.1% this morning. On the Russell, we're down by 0.75% with some morning movers. Let's cross over to New York and get the latest with Danny Berger. Hey, Danny.
Hey, John. Some much welcome relief, I am sure, for Google investors. A really solid set of results. Their search business outperforming, really leading the results higher. You also had cloud services doing well thanks to all of the AI demand. In fact, their capital expenditures were higher than expected, saying the demand we have, we don't have enough data center capacity to keep up with it. So those shares up about 4.75%. To the other side of things, though, a very different story for Intel when it comes to tech earnings. Also reporting after the close, a disappointing outlook for Intel. They're also cutting CapEx and cutting their staff. Those shares down 7%. The new CEO, his first set of results, giving wafer-thin expectations for what's to come for this company. So disappointing one on their part. Also to the downside after their earnings post-close is Gilead. This is the drug company. They had disappointing results in sales for some of their key blockbuster drugs, things that treat breast cancer and HIV. For example, those shares down nearly 4%. One interesting little nugget in their earnings, too. They said that their forecast would have been higher. However, they had to write it down because of increased costs due to tariffs on things that are impacting the price of stuff like lab supplies and raw materials. John.
Danny, thank you. We've seen that movie a few times so far this week from corporate America, that's for sure. On our radar this morning, President Trump continuing to say the U.S. is holding trade talks with China. China denying there are any negotiations and saying the U.S. should not mislead the public, something China's said now repeatedly for the last few days.
But the president continues to double down. Yesterday, he said there was a meeting, they had a meeting, and then when the Reuters reporter said, who are you talking about when you say they, he said, maybe we'll disclose that, maybe we won't. It's not on brand for this president to not disclose who the meeting is with. So it does feel like the negotiations are not taking place. But then a Time magazine this morning interview, the president said that Xi Jinping, yep, he called him. One thing that is clear, whether or not the calls are taking place or not, the president doesn't want the tariffs to stay at 145%. He thinks that's unsustainable. So the direction of travel is lower.
At the same time, scenario analysis is going to be important, not just at the Fed, but also for a lot of companies. If it's 60%, is that sustainable? 50%, at what point can you start shipping goods back over? This is going to increasingly be the path of travel for conversation.
We're seeing changes. Lisa, you mentioned this story just moments ago that Apple's aiming to shift its supply chain out of China, at least some of it. Sources telling Bloomberg the company is planning to make most of its US-sold iPhones in India by the end of next year. Lisa, that shift is happening.
Yeah, and this is fascinating at a time when Apple has doubled down for years in China to build up some of its factory capacity and has a huge presence there, both as a manufacturer as well as a producer in the mainland of China. A question here, A, whether this is feasible, because this is actually a pretty big shift in such a short period of time. And then B, is this okay? We were supposed to have all the people on Wall Street making iPhones. Remember all those memes where people were sitting next to each other, quickly doing this? Is it really just going to go to India? And is that really okay with this administration?
Dan Ives was trying to make it happen in New Jersey, wasn't he? Apple's down in the pre-market by 0.9%. Let's keep it on tech. Amazon, Nvidia, saying demand for AI data centers remains robust. According to reports, executives from both companies dismissing reports that recession fears are slowing demand. Look at these moves over the last week. Lisa, Amazon up by 8%, Nvidia up by close to 5%.
I wonder how much of the story of the rebound isn't just the sense that there is more conciliatory tones from Washington, D.C., but the tech story. That actually these investments are still happening and that maybe some of the fears of the AI trade and that sort of key piece of U.S. exceptionalism isn't as dead as people had previously expected. What you saw was higher than expected outlooks for fiscal capital spending for the likes of Alphabet. If you see that reiterated by the others that report next week, how much does that do to this trade?
A lot of Max 7 reports in the next week or so, including from Apple. Elsewhere, it's been very mixed for earnings so far this week. Large corporations from Pepsi to P&G cutting their outlooks due to Trump's tariff policy. One company, however, thinks they'll benefit from the uncertainty. WeWork, which provides co-working spaces for companies and individuals, is hoping that market risk will help it bounce back from bankruptcy. Joining us now is the WeWork CEO, John Santora. John, it's good to see you, sir. Thanks for being with us.
Good morning, John.
Give me the strategic update. What is the strategy now and how has it changed in this certain period for the company compared to a very uncertain period for the company a number of years ago?
So where WeWork stands today, we're a maturing company. We're a company that has no debt. We're investing in our portfolio around the world. We're investing in our members and our people. So it's a very different place today than it has been in the past.
Does it rely on a different kind of business?
Our business is flexibility, right? It's to be able to provide from 1 to 1,000 seats for companies, for the entrepreneurs. That's always been a part of our business, right? It's about 27% of our business. Then you have the small and mid-sized companies, 50 people, 100 people. And then you have that whole enterprise platform that we have, which has been really growing the last year or so.
Are you finding those changes are coming because of what developed during the pandemic coming out the other side? Is that what forced the issue for the larger enterprises?
I think if you look historically during different markets, right, there's always that downturn. There's always that need to sublease space. We always take too much space in good times. We get rid of too much space in bad times. We fill that gap. So giving them 20 or 25% of their portfolio that's flexible, increase it, decrease it without taking the hit to your books, without writing off that space and writing off all the capital, and being able to provide that flexibility in markets around the world is key.
So where are we right now with respect to the uncertainty that we hear from corporate executives around the country? Is this a time where they want to ramp up their flexibility and increase their footprint with you, or pull it back because they actually see that as a lever that they can pull without being seen too much?
This is a time, any pause, a recession, whatever, is not good for any company, right? For us, our clients are saying, with the pause, I'm not sure if I'm going to take more space. I'm not sure if I'm going to cut back. They pretty much are pausing with us, and that doesn't cost them anything, right? They stay in our spaces. They'll move. They'll adapt in different markets. You talked about India earlier on the show. We're seeing a big move out to India with our clients. All the big banks, all the financial institutions are growing their presence in India. The clients, you mentioned Apple and so forth, they're all looking to take more space in India. But are they going to take 10 and 15-year leases with the uncertainty of what's going on in the market? They'll look to a player like us to give them that flexibility.
Just to be clear, are you seeing stasis when it comes to leasing right now, or are you seeing leases increase in places like India and decrease in places that previously have been popular? I'm wondering whether it's even some of the Northeast cities.
I think it's a little too early to tell what the long-term effect will be. But, in discussions with CEOs and CFOs, are you willing to make that 15-year commitment to a market today with the uncertainty? You have to pause. You have to think about it. You have to think whether or not to invest that major capital in a market, at least for this short term. You have to step back.
In the go-go days of WeWork, I remember that every time a building was getting rebranded, it was going to be a WeWork. When I was walking around the city, there was just this massive expansion plan. And then there was a retrenchment. Are you back in expansion plan? Are you looking for acquisitions in terms of properties, or are you kind of happy with your footprint and just expanding in other ways?
Yeah, we have a really good footprint now. It's been restructured. We're in the markets we want to be in. We're in the markets that our members want to be. We're in the right product. Over time, though, for the first time in the history of the company, we're going through a traditional lease expiration. So we'll look to upgrade in some markets. We may look to leave a market, but that's going to be a rare case. We like the markets that we're in. So we're going to do some upgrades here and there.
During the pandemic, we saw a number of companies move from New York to Florida. Are you seeing companies still leave New York?
You know, and I've grounded in real estate and grounded pretty much in New York real estate, where I've always lived in New York and always worked out in New York. The New York market is it's the capital of the world, right? It's the capital of finance. It's the capital of most companies. Their headquarters are there. A lot of companies, their headquarters are there. It will always have a presence. It will always be important. There'll always be headquarters there. There'll be some changes, though, over time. People will adapt.
When it comes to new markets, though, across the U.S., are you seeing more of a buildup?
No, we're not.
Midwest, West Coast?
Yeah, we're not seeing that much. We're seeing markets start to return. I was in San Francisco 3 times so far this year, and we're seeing that market start to return. We're seeing people on the street. We're seeing buildings start to fill up.
They finally cleaned up that city. Are you happy with progress?
They've made progress. They've definitely made progress.
What needs to change there? How do they fix this mess?
I think part of it is, it's security, it's safety, right? People need to feel safe when they're going to work. They need to feel safe as they're walking the streets. They need to feel safe on the subways and the transit systems.
John, it's good to see you, sir.
Great.
Thanks for being with us. Thanks for dropping by. John Santoro there, the WeWork CEO, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hake. Say, Yahara.
Hi, John. South Korea says it's reached an understanding with the U.S. to prepare a trade package before July, when President Trump's 90-day tariff pause is due to end. The comments came after U.S. Treasury Secretary Scott Bessent said yesterday he expected an agreement of understanding on trade with South Korea as soon as next week. Meanwhile, Nintendo shares rose more than 3.5% in Japanese trading today as pre-orders for its Switch 2 console sold out at several stores in the U.S. Orders for the $450 device are no longer available on the Walmart, Best Buy, and Target websites. The console will be released on June 5th. And a 19-year-old man has been arrested and charged with arson in connection with a New Jersey wildfire that could become the largest in the state since 2007. Authorities say the man set a bonfire and left without fully extinguishing the blaze, sparking the quick-moving wildfire. It is partially contained and no deaths or loss of homes have been reported. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, pushing China to rebalance.
You'll be meeting with your Chinese counterparts. How will you help them understand that it's not just about talking, it's about executing?
There is an opportunity for a big deal here. Let's do it together. This is an incredible opportunity.
That was the Treasury Secretary, Scott Bessent, sitting down with the IIF President and CEO, Tim Adams. We'll catch up with Tim in just a moment. From Washington, D.C., you're watching Bloomberg TV.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures on the S&P 500 shaping up as follows. On the week so far, poised for a week of gains on the S&P, up about 3.8% on the week so far. This morning, futures lower by 0.3%, but lots of bullish commentary. Julian Emanuel of Evercore earlier in the week saying our base case is the lows of this sell-off have been seen. Binky Chadha at Deutsche Bank now targeting 61.50 year-end on the S&P. That's down from 7K, but saying this, that the base case remains for a significant rally on a credible relent on trade policies, and that credible relent likely needs a significant decline in approval ratings, which begs the question how much pain we need to see before we get there. In the bond market, 2-year, 10-year, 30-year, certainly some better news in fixed income over the previous 2 weeks, including this one. Yields down for a second consecutive week, yields lower for a fourth consecutive day. We're down by 3 basis points on a 10-year to 4.28. On 30s, we're down 4 to 4.73.68. Under surveillance this morning, pushing China to rebalance.
You'll be meeting with your Chinese counterparts. How will you help them understand that it's not just about talking, it's about executing?
There is an opportunity for a big deal here. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, let's do it together. This is an incredible opportunity.
So here's the latest this morning. The US calling it a big opportunity, but Beijing denying White House claims that talks for a trade deal are even underway. Joining us now, the man who sat alongside the Treasury Secretary Scott Bessent, the IIF President and CEO Tim Adams. Tim, it's good to catch up with you, sir.
Good morning, everyone. Thanks for having me.
Thanks for being here. What did you make from the address and the approach of the Treasury Secretary earlier this week?
Well, I think this was Scott Bessent's breakout week. I think he really established himself as the sober voice of reason in this administration, and boy, they need one, and I think he's the guy. And I think he did a very good job of articulating where this administration wants to go. But importantly, this week, he said they want to stay anchored in the Bretton Woods system. That's really important. It was a collective sigh of relief across this town.
When you've spoken to financial executives, policymakers, finance ministers throughout the week, are they clear on what the demands are now? Do they walk away from Washington going into the weekend knowing what the ask is?
No. And it could change, even if you did know. I think everyone wants to see Scott. I think they understand the secretary's at the epicenter of really rational thought. And if you want a reasonable answer, he's the person to see. But they just want some certainty. They want to know, where do you want to take this discussion, whether it's trade with China or whether it's broader tariff issues. They just want some idea of what's the trajectory look like.
April 2nd was a shock to many. Just the scale of the tariffs, the reciprocal tariffs. We've had the policy shock. We've talked about it being potentially a shock to the system, not just a shock to the cycle. Does it have the potential to morph into a financial shock in the months and years to come?
It does, but it's the real economy shock that's yet to come. You see the soft indicators have all indicated that there's concern. The real indicators haven't shown that yet. I think a lot of there's early inventory stocking. That's the second half of the year, but it will come. And the markets really matter, this administration. I know the president sort of downplayed the bond market and equity market. It matters, I can assure you.
Well, and this raises a question for the banks, the institutions that you talk with on a regular basis. How concerned were they at the prospect that we might have gotten some dysfunction in the Treasury market if there hadn't been the pivot from the White House, and what that means for their safe assets, for their portfolios, for market functioning going forward?
Well, they feel pretty good about the way the markets function. So there was another sigh of relief. And the institutions, the banks I represent, have plenty of capital liquidity, and the markets actually function well. The question is, where do we go from here? And especially if you have an economic downturn, we see a blowout in deficits. We're running deficits of 6% of GDP. They're going to go higher if the economy, the cycle turns. So the question is, what does the future look like? I'm not worried about financial stability per se. I'm worried about fiscal sustainability.
There is a theory that this government could reduce some of the regulations around the liquidity provisions and how banks have to hold them, and basically allowing them to invest more heavily in U.S. Treasuries, which could alleviate some of these concerns. Do you see that as coming to the fore in the near future?
I don't think in the near future. I think this administration is looking at a broad range of financial regulation. The Secretary said he's going to direct that. What I did hear from regulators around the world here this week is a sense that the globe needs growth. We need global growth. And regulators need to think about all that they've done over the last 15 years. And did it really make the system stronger? I think it did. But did they go too far? And do we need to focus on capital formation, risk-taking, and economic growth? And I think that's something new I heard this week.
What's interesting is that this is one of the pillars of the whole financial bet at the outset of the Trump presidency. People truly believed that this would be a deregulatory regime, and it would boost the traditional banking system in a dramatic way, at least from a profitability standpoint. Is that offsetting some of the pessimism around growth and actually maintaining this sort of feeling of optimism among the financial institutions you talk with?
You know, their animal spirits are always there in the United States, and that's what's, we should celebrate that. Right now, they're dampened a bit just out of uncertainty. I think deregulation is going to help. I think they're serious about that. We just need to get some fiscal sustainability, and we just need to move beyond the tariffs and trade dislocation, because that's really weighing on the markets.
The Treasury Secretary is dying to move beyond tariffs. He wants to go to the tax bill. Do you think this administration can really get anything more done than the extension of current policy?
Well, he's certainly trying. Now, you need a team in place. You need bodies in the buildings to actually negotiate all these trade deals. I think he himself, Scott Bessent, he's got a tax bill, he's got trade bills, he's trying to watch the markets, he's on an airplane, he was in Argentina, which you know well. I think he's trying to do quite a bit. Thank goodness he's there. And I think left to his own devices, he'll get us a long way. But we do have a historic tax bill that needs to get negotiated.
When you say thank goodness he's there, and the Chinese come out and say, or at least we've reported that they are looking for a point person, is that who they want to negotiate with?
That's who they want. That's who you want. I worked for Hank Paulson. We started the Strategic Economic Dialogue. We've been talking about China, U.S.-China imbalances for 20 years, if not longer. It's time to really do a deep dive and address these in a practical, rational way. I think Scott can do that.
He said to you, as similar to what he said to me, it's like Fantasia, the Disney movie. It's a broom and a bucket. It just keeps circular economy when it comes to China. Can the U.S. do this alone, or does it need Europe and Southeast Asia to also confront China?
Well, it's possible to do it alone, but you don't want to do it alone. Alliances really matter, and I think other countries suffer from the same set of concerns that the United States does. Build those alliances. We've been talking about it for years. I think they're willing, but you've got to incentivize them, not just with sticks, but with carrots.
There's something key you asked the Treasury Secretary. You led him. You said you're going to be meeting your Chinese counterparts. He just kept talking about China's imbalances in their economy. Has he met his Chinese counterparts this week?
I don't know if he has, but he should. It would be improper if he doesn't actually see them. But that's where the negotiations start. And the challenge with China is there are lots of officials. Ultimately, Xi Jinping's got to make some serious decisions about how they rebalance that economy. But Scott the secretary can be the principal point person for this administration.
Forgive me for going into the realm of speculation and gossip, but what do you make of the situation we're currently in, where the White House is saying these talks are happening and China is denying they're ever taking place?
Oh, there's so much noise out there. So you got to look for the signal. I just look for someone like...
What do you think the signal is?
I think the signal is that they do want to have this discussion. I think the president wants to be seen as the Chinese coming to him rather than him going to them. let's just get beyond the antics and get down to brass tacks. We need to negotiate. This markets are looking for certainty. They're looking for direction.
They're always looking for that. One thing that we've been looking for decades is for China to rebalance. And you've touched on this issue several times. You've worked on the issue. Other people have worked on the issue.
Yeah.
What are the lessons of the mistakes that we've made over the last several decades in this country that we can correct under this administration to push China to finally rebalance?
Should have been tougher 20 years ago. You know, we talked about it. We were engaged. I spent, countless trips flying back and forth. We should have been tougher. I think there were many in China and Beijing who wanted to do the right thing. I think they understand they've gotten themselves in a precarious position. I think they want to rebalance. But rebalancing that economy is incredibly difficult. I think we have a golden moment now to resolve this. But we need our allies there. We need Japan and South Korea and Europe and Australia. We need everyone on board. It needs to be a global effort.
You've been flying around the world. That's part of your job, is that you travel a lot and you talk to a lot of leaders, and you have been. And this spring meeting at the IMF and the IIF feels a little bit different than it has in the past. Can you just frame what a seismic moment it feels like it could be? Is this a regime change in a new kind of way for both the financial structure as well as the trade system going forward?
Yeah, it's true. I think of it as a new operating system that you put on your phone, right? And people are trying to figure out how it works. You know, when it automatically downloads and all of a sudden you have these new features, they're just trying to sort their way through it. I think there was concern up until this week about the role of the dollar. Did this administration want to downplay the exorbitant privilege of the dollar and the dollar's role? I think the Secretary was pretty clear this week that, in fact, he is committed to the dollar's role as the principal global reserve currency. That's an important statement.
He may be committed to it, but Wally Adeyemo, who formerly worked at the Treasury Department and was here just a moment ago, said that every portfolio manager he's talking to is speaking about diversifying away from U.S. assets. Are you seeing the same?
Oh, absolutely. You know, there's a lot of excitement about Europe. Europe really has an opportunity. I met with many European officials this week, and I've been spending a lot of time in Europe. This is Europe's moment to actually show that they can make some reform progress. They've got to build a defense and security industrial base. The Germans are going to spend money after not spending money for 2 decades. This is Europe's moment. We'll see if they actually seize it.
Pushed by Trump. Do they have this White House to thank for this?
Oh, it's a Trump shock. And I tell them you should thank him. Send him a thank you note, because this is Europe's opportunity to actually do what they should have done 20 years ago. It's China's opportunity and it's our opportunity. But we've got a role to play as well. We have to get our fiscal house in order.
We've said it a few times on this program, pushing the Europeans to do what's good for them.
Exactly. Trump is making them do that. He's also now tweeting and truthing a lot about how he loves that the ECB is cutting rates. They're cutting rates because the environment he created, he's almost dictating policy, monetary and fiscal, on the continent.
Yeah, the ECB stuck between the Trump shock and the China shock volume 2. That's for sure. Tim, it's good to see you. Thank you, sir.
Guys.
Thanks
Happy
for dropping
Friday
by. Thanks for being here in Washington with us. Tim Adams there, the IIF president and CEO. Lisa, you brought up the point. I think it's an important one. We've been talking about it with portfolio managers and asset allocators over the last month or so, this push to rebalance from this huge dollar long that's built up over the last decade plus.
Yeah, and it really raises the question, there's a short-term reprieve right now, and you're seeing this with some sort of assets into the dollar and into the Treasury market as a reprieve from some of the sell-off. But longer term, Michael Hartnett, you mentioned this, Anne-Marie, earlier this morning at Bank of America, saying he would sell the rallies because ultimately there is a slow structural shift. It's not get out of dollars wholesale. It's just on the margins, tweak it, diversify it, and you hear that again and again.
3 days of gains on the S&P, bumping into just a small loss this morning. We're negative by 0.2% on the S&P 500. Next on the program, we'll catch up with Alifia Dorawala of Rock Creek, Doug Redeker of International Capital Strategies, the NASDAQ CEO, Adina Friedman, and Nikhil Rathi, the Chief Executive of the Financial Conduct Authority. Live from Washington, D.C., this is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world, and so that has been very lucrative as a business.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Investors are not only worried about the economic outlook, but the whole structure of the international system.
We all really appreciate that if global trade begins to destabilize, all that we have to lose.
Our overriding theme, of course, is uncertainty.
The world economy cannot afford a continued confrontation between the two largest economies in the world.
The world is holding its breath, waiting for the U.S. to indicate where it wants to end up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from the nation's capital, from Washington, D.C., for our audience worldwide. Good morning to you all. For investors worldwide, everything's relative, but this week, quieter than it has been over the last month so far. Equity futures, your scores look like this. On the S&P, negative by 1/10. On the NASDAQ 100, down by 0.2. On a Russell, negative by 0.8% on the week. So far on the week, the S&P 500 higher by 3.8%. Some comfort in the bond market. Your bond market this morning looks like this: a 2-year, 10-year, and 30-year, with yields lower again for a fourth session on the 10-year. We're down by 4 basis points to 427.39. The thing you hear repeatedly at the moment from the south side is time. This will take time. Mike Gapen of Morgan Stanley, the U.S. economy may be in a race against time. Andrew Honhorst of Citi just moments ago saying this: waiting for the hard data to turn. Lisa, the clock is ticking.
The clock is ticking. We did find out some aspects this week, though, about what the ramifications are for corporate America. In earnings calls, we're not making as many investments. We've slowed our hiring plans. We've expanded. We haven't necessarily expanded in the same kind of way that we had expected to. What you also have heard is a recognition, at least in the margins from this administration, that it does take time. And that is the reason why it's calmer. The bigger question is longer-term shifts away from the U.S., and that is still a question mark.
We we've had a different tone from the administration, from the president, a softer tone. He's talking up talks with China that China says aren't even happening. And we're still trying to figure that out this morning, aren't we?
China today came out and said this administration should stop misleading the public. Also this morning, Time Magazine, the president sitting down with journalists at the magazine saying, yeah, Xi Jinping has called me. Interesting, though, the president did say 145% is unsustainable. He also said it's not weak to show Xi Jinping. It's not weak for him to pick up the phone and call me. So I think he's wish casting. He's negotiating out loud and hoping the message reaches Beijing.
It's something between 145 and 0. And consensus is building around this view that you've been talking about for a while, that maybe we land exactly where the president said we would land months ago.
At 60%, somewhere between 50% and 75%, I think is what the Wall Street Journal was talking about, and an official had briefed them. But here's the fact of the matter. 4 months, you could have prepared exactly what the president was saying on the campaign trail. 10% on the entire world, 60% on China. And we might land there within this 90 days reprieve.
It's been a very volatile month of April. Still got a week to go. Equity futures on the S&P, negative by 0.2%. Coming up this hour, Alifia Doriwala of Rock Creek, as trade optimism boosts investor appetite. We'll speak to Adina Friedman, the chair and CEO of NASDAQ, on business confidence. Nico Rathi, the CEO of the UK's Financial Conduct Authority, will round out the programme with us a little bit later. We begin this hour with stock steady following 3 days of gains. Investors looking for clarity, as President Trump says the administration was talking with China, and China denied those talks were even taking place. Alifia Doriwala of Rock Creek joins us now for more. Alifia, good to see you.
Nice
Thanks
to
for
see
dropping
you.
by. You work very closely with endowments, and I'd actually like to start there because everybody is facing policy volatility, including colleges in the United States of America. Question a lot of people are asking, are they selling? Are they looking to move into high liquidity products?
I think, we obviously heard about Harvard, we heard about Yale, we've heard about very large investment portfolios that are looking to sell some of their private equity portfolio. I'd caution $1 billion out of a $53 billion portfolio is not necessarily a state of panic selling. So the amounts are large, but because they're large investors and they've been investing in private equity for the last 20, 30, 40 years. Their portfolios are extremely complicated, and this is actually a good time to be out there in the secondary market, try to get a bid, try to pare down your portfolio, and yes, prepare for what could come and maybe a period of uncertainty. But, we also expected a very dynamic IPO market, a very dynamic M&A market, and we're not getting that so far. We might get that, but we don't have it now. And so being, a little bit prudent and having liquidity and flexibility is what every endowment is looking for.
What is so complicated about their portfolios? And given the threats to the nature of their business at the moment, what would need to rebalance? What would need to change?
Yeah, look, private equity portfolios that have been built up over the last 20 years are going to have multiple line items. They're going to still be working off private equity investments from 10, 15 years ago. And so reducing your tail, some of those positions that are still unwinding, and then getting into new investments. This is all about having the flexibility to go invest for the next 10, 15 years. That's what endowments are all about. And so I think that it's a complicated business of trying to reduce that, increase your flexibility, and still get a good price on your portfolio. But that's what the secondary market is for.
This is fascinating because so many people have come on this show and say, look, it's hard to know where to hide in private assets because private assets are the place to hide. And what you're saying is essentially private equity, which has been hurt in a couple of different factors, the fact that the IPO market hasn't revived in the same kind of way, is not it, at least not for these endowments. How much are you seeing price discovery that's a lot less favorable, sort of the washout in private equity that a lot of people are waiting for over the past couple of years?
I don't think it is a washout, and I think that there are still buyers in the secondary market that are willing to bid up some of these portfolios. These are great assets. Some of these are going to be really good funds that other investors that have no private assets want to get into. If you're an endowment and you have not had a large private equity allocation, today is the day to go and see what can I actually get into for the next 10 to 15 years. So it all depends on your perspective. We're still very enthusiastic about private equity. It's just a matter of what is the allocation in your portfolio and how much liquidity can you bear.
Stepping back, this idea of liquidity has traditionally been interchangeable with treasuries, and we've been talking all morning about whether that still is the case, especially given some of the volatility that we've seen, particularly on the long end. Have you seen any of the funds that you work with materially shift away from treasuries as sort of this ballast?
I mean, they haven't worked in the portfolio, right? So in a short-term period, you're saying that fixed income is going to be your safety, or, flight to, I mean, even gold. We have positions in gold. It's done great. But do I really think it's that safe? Maybe not in this environment. And so nothing is safe. I think everything is a risk today, and you have to look at your portfolio in terms of relative risk. Is fixed income still relatively less risky than other parts of the portfolio? 100%. Is it probably overplayed? How much is getting, really depleted from treasuries and how unsafe treasuries are? I think the markets are changing so dynamically and fast that you can't really say what's going to happen in 6 months in the treasury market.
Because the markets are taking their cues from Washington. And this is a Trump administration. This is a 12 news cycles in 124 hours. How do you position for the long term?
Yeah, and I think that's why you've seen the bond market react, I think, more to what is coming out of the administration than you have in the equity markets. And your point is very well taken, and this is the problem, right? If you're a long-term institutional investor and you look at the market every day, those two things don't match. And you don't want endowments to be market timing. They have probably had this private equity, these large asset owners that are selling private equity, they've probably been thinking about it for the last 3-6 months. And so this has spurred maybe the speed at which they do things, but this is not an overnight decision. And you can't manage an endowment with the ticks of the market every single day. You'll just be caught wrong-footed each time.
But investors are thinking about other places outside of the U.S. Who's benefiting the most from those flows?
I mean, if you just look at the markets in the short term, right, it's been Europe, it's been emerging, it's been everything but the U.S. Now, we came into this period a little bit more conservative on equities. We had rebalanced, but that's a lot, I think a lot of institutional investors were already feeling that the U.S. was at high valuations. U.S. exceptionalism, yes, but how long can that persist with the market valuations we saw? So there was a little bit of a rotation. I have to say I'm still skeptical at how long-term this, great Europe is going to be great, emerging markets is going to be great. We've seen that quite a bit of number of times in the last 5 years, and everyone returns to the U.S.
You work with endowments, so you're specifically vulnerable on a number of different levels in terms of policy uncertainty. Yes. There's this question around trade, what that does to the macroeconomy, but there's also this question around the universities in particular, and where they get their funding, their accreditation, and how that might be changed going forward for them to be able to be eligible for certain loans that are particular to their businesses. How much do you see this as potentially spurring some sort of liquidations of some of their assets to bolster their business models at a time of such incredible uncertainty?
I think university endowments have been disciplined for the most part. And so I don't, again, think that there's a panic because they are losing some of their funding unless it has been such a material portion of your budget. And some might have to increase their spend in the interim to be able to cover some of those programs that they want to continue. But it's going to bring also a financial discipline back into maybe the budgeting that the last 10 years, because you were relying on your endowment, didn't necessarily force you to do. So maybe it's also a time where universities are going to really be looking at their business model and saying, where can I pull levers? I can't only rely on the markets. I can't only rely on my endowment.
Alethea, just a final question. When we wrap up the week here in Washington, D.C., do you have a firm handle on where policy is and where things will land? By the time we get to the end of the year, do you have a decent vision of things now?
I think if anyone says they do, they have not been living in Washington for the last quarter or 3-4 months. I mean, I think we have scenario planning, and we can say that we think, equity markets are going to be here, that everything will come back to the 10% tariffs. It's all about China. But I don't think China tariffs are going to be resolved in the next year. I think that's a 2-3 year game until we really see where it's going. So, that's a lot of uncertainty, and there's a lot of careful positioning you need to do for our portfolios in that environment.
Alethea, appreciate your time. Just to share some of your thinking with us this morning, we appreciate it. Alethea Doriwala there of Rock Creek. Equity futures at the moment down by 0.2% on the S&P, still up nicely on the week so far. The opening bell about 1 hour and 20 minutes away. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara Hackett. Say, Yahara.
Hi, John. President Donald Trump expects to wrap up trade deals soon. The president telling Time magazine he anticipates finalized deals over the next 3 to 4 weeks. Trump also reiterating the U.S. is engaged in trade discussions with China, despite denials from Beijing. Meanwhile, Intel shares continue their fall this morning. They're down 7%. Now, the chip maker gave a revenue forecast for the current quarter that was well below what analysts were expecting. Plus, the CFO warned that a tariff-fueled recession could hurt chip demand. The company also confirmed plans to cut management jobs as its new CEO, Lip Bhutan, attempts a turnaround. And Walmart is increasing its focus on discounts to drive demand and grow market share amid tariff uncertainty. The retailer is introducing manager special signs to highlight price cuts on key items and match competitors' prices. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, the morning calls, plus Douglas Redeker of International Capital Strategies, with the U.S. looking to strike some big trade deals. That conversation next. Live from Washington, this is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The opening bounce 1 hour and 16 minutes away. Equity futures doing okay on the S&P 500. Only slightly softer on the S&P. We're down now by 0.2%. That's the price action. Let's get you some morning calls with just one stock in focus. Alphabet, first up, Wells Fargo, raising its price target to 175, citing resilient first quarter surge growth. Your second call comes from the team at UBS, boosting its price target on the stock to 186, noting positive CapEx guidance. And finally, your third and final call from the team at JP Morgan, raising its price target on Alphabet to 195, highlighting the company's progress on AI features. That stock is up in the pre-market still. Off session highs, but still firmer, up by 3.8%. Let's turn back to the main story. Trade. Here in Washington, President Donald Trump telling Time magazine he expects to wrap up deals with U.S. trading partners over the next 3 to 4 weeks. Joining us now, Douglas Redeker of International Capital Strategies. Doug, good to see you. Good morning.
Thanks for being here.
Can you get these deals done in 3 to 4 weeks?
Depends on how you define getting deals done. Secretary Bessent specifically said agreements in principle can be done much more quickly than actual trade agreements. So actual trade agreements take years. Let's just take that aside. The agreement in principle, from what we're hearing, is let's take all the controversial stuff, put it aside, find that common area where we can at least amorphously agree, and then say, deal done. So yeah, I think you can get a bunch of those, but again, there's a difference between the announcement and the actual implementation.
Let's talk about the biggest controversy, China. Can a deal be done with China?
Can? Yes, likely, absolutely not. I mean, I tend to believe the Chinese when they say we're not talking. I'm not sure that President Trump has a lot of facts behind it when he says, yeah, we are talking, when the other side says, no, we're really not. In this context, I think I believe the Chinese.
But this week specifically, we were expecting the Treasury Secretary to sit down with the Chinese delegation. He had said that to us back in February. Do you still expect that meeting to go through?
I think that there are probably almost protocol-style meetings where, hi, how are you? Nice to meet you. I'm Secretary Bessent. That's usually what happens at these meetings when you're a new cabinet official. And so that's not to say they wouldn't raise some issues. But I really think this was supposed to be Scott Bessent's introduction to his counterparts. Remember, he did not go to the G20 finance ministers meeting, and everything was about, well, I'll meet them all when they come to Washington. Not, I'll meet them all and discuss the fine points of a trade deal. So there's a difference between introducing yourself and actually getting into the nitty-gritty.
Tim Adams was just on. He sat down. I know you were at that speech that the secretary gave, and then that interview that he had with Tim Adams. Tim Adams says this is Scott Bessent's breakout week. Do you agree? You talked to everyone from the IMF.
Absolutely. I think Scott Bessent was, I don't mean this to be in a disparaging way, but I think a couple of weeks ago, he was a diminished figure. He seemed very uncomfortable. A guy who in his confirmation hearings was a reasonably good communicator came off as a terrible communicator. He didn't sound like he believed the words he was saying. Suddenly, in the last week plus, he's standing up taller, he's got more stature, he's got more gravitas, he's got more confidence. He's clearly got the ear of the president for now. And that has come through. So I think this has been a great week for Secretary Bessent. What I worry about is that investors and officials who are here are going to misconstrue that as a long-term trajectory. We know in the Trump administration, anybody who's up this week is just as likely to be down next week, and that's probably a misleading signal if you think this is a linear path to Bessent's dominance.
I love that we're at the point of analyzing verbal, nonverbal cues as sort of a way to understand U.S. policy going forward. I do wonder whether we did get any sense this week of anything concrete that moves us past peak uncertainty to a greater understanding of the framework going forward, what the ultimate goals are, which players might come to the table, and which maybe not.
I think anybody who leaves Washington this week after the IMF spring meetings and thinks that there's any more clarity is probably misplaced, misguided. That doesn't mean that there weren't some signals. The signals probably were that President Trump really wants to talk to China, and that other countries know that he really wants to do these agreements in principle with them. And so they are, as I said earlier, sort of circumscribing what they're willing to talk about in the short term. So I think that there's some signaling that deals can be had. But again, if you think those deals are actually being made, I think that's probably overly optimistic.
There were some changes, though, in rhetoric and the sort of outward comments versus what people were saying behind closed doors. Two very different things. On the outward facing, we need U.S. Treasuries to be a haven asset. We need the dollar to be reserve currency. We hope that it maintains strength. Longer term, a lot of discussions about the euro and how the European region can fortify the euro, how different funds can diversify away from U.S. assets. How much was that a material shift in terms of how much that idea was accelerated?
I think for the first time in our lifetimes, we're seeing talk of the U.S. dollar as a credit instrument, not as a safe haven. And the U.S. dollar as a credit instrument is a big shift. That doesn't mean everybody's selling the dollar. But certainly the conversations I had with very large international asset managers talked about hedging their dollar exposure. That doesn't necessarily mean selling the dollar, but it does mean buying instruments, especially the euros at 115, 116. That's not a bad place to try and hedge yourself. So there's a lot of that that's going on. And again, just the talk of the dollar no longer being a safe haven, that's a very revolutionary shift in the global financial system.
Russia thought the same thing once upon a time and then had their reserves confiscated. And I just wonder if the likes of China are having second thoughts about diversifying into things like the euro.
I haven't thought, well, I mean, you've got to diversify into something.
Gold seems to be the pattern of things from the Chinese over the last few years.
I can't imagine the Chinese are going to take the majority of their dollar-based or euro-based assets and shift them into gold. And, there's always the TINA, right? There is no alternative benefit to the dollar, the euro, and others. I think Europe, classic, right? Everybody's been talking about it this week. What a great opportunity this is for Europe to step up. Oops, they're probably not going to step up. So that's, Europe is famous for ready, aim, 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 and they never actually get to the fire part. Is this a moment where they win the Charlemagne Award? I mean, where Putin and Trump win the Charlemagne Award as being the ones who brought Europe together? Probably not, but probably more so than certainly Europe would have done on its own.
Do you think we're past peak excitement when it comes to Europe?
When did we have peak excitement on Europe?
The debt break, winding down in Germany, them actually looking at potentially their own defense.
It's about as good as it gets for Europe, right?
No, look, I think that there's still, Merz isn't even chancellor yet. So I think that there's still a lot of steps to come. And again, I think we're getting a false sense of certainty or clarity coming out of this week. Suddenly Bessent is the savior and everything's fine. No, that's not the case. So I think there's still a lot of legs in this story to come, and Europe is going to be a central player in that, particularly on Russia-Ukraine, right? So there is going to be potentially this break. It's not what we're here to talk about today, but if, in fact, President Trump pulls the U.S. away from, if not out of, supporting Ukraine in the coming weeks, that's going to be a big moment for Europe to step up and a big schism in the U.S.-Europe transatlantic relationship on security issues, which is going to spill over into a wide range of issues.
When it comes to trade and the conversations the U.S. is having with their European counterparts and other Southeast Asian counterparts, how important are you hearing that these countries, these economies, confront China alongside Washington?
Well, this is the U.S. wants them to, right? The U.S. is trying in many instances to force countries into choosing. And these countries are desperate to avoid being forced to choose. If they are forced to choose, the U.S. might not be happy with the way that they choose. Not because they want to. I just want to make it clear. These countries are not saying we want to walk away from the U.S. But if they are being told it's us or them, one of the great advantages the U.S. used to have, and I say used to with a certain amount of sadness, is we were the provider of the global public good. We were the anchor of the institutional norm. We were the provider of security, whether explicitly or implicitly. President Trump has undermined all of that. So now the balance against China is our biggest trading partner for most countries in the world was the U.S. played this other role. As the U.S. plays a more uncertain other role, it's harder to use that to weigh in against the balancing that China is their biggest trading partner. It's really an own goal that the U.S. has squandered.
One of the more interesting features of this particular week, where you have the finance ministers coming together and speaking about some of what you're talking about, is the number of CEOs who are here as well for a variety of reasons. And there's this ultimate question this week about whether the idea of mutually assured destruction is a great negotiating incentive, and the idea that maybe the pain that some companies are experiencing and communicating to the White House is a tool of leverage that people had underestimated in the past. Do you think that we could say, not without some uncertainty, but say to some degree that that's the case?
I think that the concept of mutually assured destruction is don't go there, right? So it is basically to say, if you do this and the other guy does that, all of us lose, so let's not do it. You would have thought that President Trump and his advisors would have contemplated that scenario before they started going down this route. It's not clear that they actually either contemplated it or fully appreciated it. And now what you're hearing this week is that they're starting to maybe be told in pretty uncertain terms, or pretty certain terms, what the damage is likely to be. President Trump's almost pleading outreach to President Xi, call me, right, is an indication that they don't want to go there. China's expressions this morning of exclusions is an expression they don't want to go there. So nobody wants to go there. And the question is whether two kindergartners can actually decide who's going to be the first one to say, okay, fine, I'll talk to you.
30 seconds left. Not an easy question. The IMF. Does Gorgaeva need to step aside? Do we need new leadership?
I'm not going to say that she needs to step aside. I think that both the Biden administration and the Trump administration, Secretary Bessent this week, pointed out that the mission of the IMF has been guilty of some mission creep.
Under her leadership.
Under her leadership. But I think she's a very smart political actor and is trying to protect her position. So I'm not sure she's going to step aside. I think many of the answers to the questions she gave this week were it's up to the membership, which is a nice way of kicking the can to the broader-based membership. I think the U.S. runs a risk that they have not approved quota reform, which means that the rhetoric of we're going to step up and take greater leadership is belied by a lack of action.
It's a diplomatic response from you, sir. Appreciate it. Douglas Redeker of International Capital Strategies. this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The opening about 16 minutes away. Equity futures at the moment on the S&P 500 just a touch softer. We're down by 0.2%. But the last 3 days have been really quite strong. This week, we're heading towards a week of gains. So far, through Thursday's close, up by about 3.8% on the S&P. Lots of morning movers are out there, so let's get you a few of them. Let's cross over to New York and catch up with Danny Berger with more. Hey, Danny.
Hey, John. It's still Google that is leading the individual stock gains in the S&P 500 in the pre-market session. Those shares up nearly 3.5% for Alphabet, which reported results last night after the bell. Really strong set when it comes to things like Google Search, even their cloud business doing well because of all the AI demand. Their CapEx, that also exceeding expectations, saying we have more demand than we have capacity for in our data centers. So those shares charting higher. To the other side of things for tech, though, we also heard from Intel after the bell, completely different story, having an outlook that disappointed, cutting their capital expenditures, letting employees go, matching the Bloomberg scoop from earlier in the week. The new CEO, his first set of results, really, really thin, wafer thin expectations for what's to come, not laying out any big ambitious goals for the company, but saying they'd make hard decisions. Those shares up more than 7%. Finally, rounding things off with AbbVie, we heard from them just about an hour or so ago. The drug maker's earnings coming in ahead of expectations. Their newer autoimmune drugs, those also selling well, so they lifted their guidance. Those shares up 3.5%, but they said, like so many companies that we've heard from, that their current outlook assumes no change in the trade environment, especially when it comes to things like pharmaceutical sectoral tariffs. John.
At the moment, that's a major assumption. Let's put it that way. Danny, thank you. Danny Berger there with the latest going into the opening bell, about 59 minutes away. Let's turn to the broader economy. Traders raising rate cut expectations over the last 24 hours. The Fed Governor Chris Waller sitting down with Bloomberg's Mike McKee, saying a serious deterioration in the labour market would move up the timeline for rate cuts. Michael McKee joins us now for more. Good morning, Mike. Well-followed conversation yesterday. Tremendous effort from your side. Where do you stand now and where the rest of the committee is relative to where Governor Waller is at the moment?
Well, I think basically the committee is in the same place, that if there is a reason, they will move, but they need that reason. And the biggest difference with Waller and Powell and the others is how long it's going to take to get the kind of evidence that they want to see. You heard Dr. Waller yesterday say that if inflation goes up, it's going to be a one-time thing, whereas Powell's been talking more about it being lingering. And if it's lingering, then they would have to act. If it's a one-time thing, you look through it. So we're going to have to see how this all plays out in terms of the data that we get, which, Waller says, probably won't be enough until after July 1st.
Mike, let's talk about that data. Later on this morning, Mitch, inflation expectations, the final read going into the weekend. Those numbers have been terrible, Mike. Are they set to get any better?
Not set to get any better. When you look back, the final Michigan numbers usually rise a little bit from what we see in the preliminary. And the preliminary one-year ahead inflation number is 6.7%. Analysts are expecting 6.8%. And it is the longer-term number that would figure into the Chris Waller scenario. That's at 4.4%. That's the highest since 1991. So if that goes up, it's another signal. Now, it may not mean that inflation is going to rise that much, but it might suggest that consumers will get concerned and it will change their buying behavior.
Mike McKee with the latest here in Washington. Mike, thank you. That's the soft data. We've been asking the question repeatedly, when does the hard data follow? Does the hard data catch down to the soft data? We're still waiting. The outlook for corporates gets harder. American Airlines and Pepsi joining a growing list of companies trimming or pulling forecasts due to trade uncertainty. NASDAQ hoping to provide stability in this volatile environment, and the NASDAQ CEO, Adina Friedman, joins us now for more. Adina, good morning. Good to see you.
It's great to see you. Great to be here.
Can you describe the last month for us, if you can? Just how busy have things been? Describe the volume, the activity going through your business.
Well, thanks for having me. First of all, we just announced earnings yesterday, so I think that shows a little bit of what we've been working with. We had 12.5% revenue growth. We had double-digit growth in each of our 3 divisions. And a couple of highlights. One is within our Capital Access Platforms division, our index business grew 26% in the first quarter because of inflows. And we had $27 billion of inflows in the quarter. Very strong futures volumes as well in our NASDAQ 100 franchise. And then we look at our fintech division, that grew 10%. And one of the highlights there is our anti-financial crime business grew 21%. And that's an important key grower for us. And then within our market services division, which is our trading business, that grew 19% in the first quarter because of record volumes in the first quarter. And we continue to see those volumes persist and actually grow into April. The first 10 days of April, we had 5 of the top 6 trading days ever in U.S. equities, 4 of the top 6 trading days ever in options. And in one of the days, we also measured message traffic because that's how many messages our system's handling during a given day. On the peak day, which was April 7th, we had 550 billion messages flow through our systems on that single day. So it has been an incredible period of time from a trading perspective. And the one thing to note, because we talked about this earlier, you don't get necessarily credit for this, but the fact is that the plumbing within the markets, all of the markets, has done really, really well. Hyper resilient. I think we've all been able to manage this volume extraordinarily well. We're very proud of that at NASDAQ, and I can tell you that our markets have done quite well in this period of heightened volatility.
We don't thank you when it goes right, but we'd be very quick to criticize you when it goes wrong, that's for sure. You've handled a lot of volume, volatility good. When does volatility become bad?
Well, I think the one thing to recognize is volatility, in short-term volatility that then can resolve itself. I think that's something that we've seen, frankly, multiple times over the last 5 years. I think the concern is, of course, is if we cannot have some certainty in the markets. Investors like certainty, and right now it's a very uncertain environment. So they tend to take a risk-off attitude about that. And as we know, we are hoping to see more companies go public this year. We did have 45 IPOs in the first quarter, raising $5 billion. One little side fact also is we had 7 companies switch from New York to NASDAQ in the first quarter, and we crossed $3 trillion threshold of companies that have switched to NASDAQ since we started our switch program 20 years ago. But I also would say, though, we have a lot of companies that are looking to go public this year, and and right now, of course, investors are not really in a mode of underwriting a lot of risk, so we're seeing them take a wait-and-see attitude in terms of how to tap the public markets and when to tap the public markets this year.
That was a very subtle but well-placed shot over at the New York Stock Exchange. I'm sure that they will be listening. I am curious about what that pipeline looks like now and how much smaller it is now in terms of IPOs than it was earlier in the year. There's this big question, how much have deals been sort of put on hold and how much have they just been scrapped altogether? Do you have a sense of that?
I think there are more being put on hold. I mean, we have not seen companies suddenly decide they're not going to go public. It's really a matter of they've gotten themselves ready. They've gotten approval, all the approvals they need. It's really now a matter of just having a wait-and-see attitude. And they should be, in terms of thinking about how can they maximize value for their shareholders. How can they make sure that they're entering the markets in an environment that's welcoming? And that could be, you could find windows and pockets of time throughout the year to be able to do that. And we did, as I said, still have 45 IPOs in the first quarter. So it wasn't like the markets are shut. It's just a matter of finding those windows of opportunity within a more volatile environment.
Do you see companies trying to decide or having a harder time deciding whether to IPO in New York or in the United States, in the deepest markets of the world, versus somewhere else, based on the turmoil that we've seen?
Well, we are really the home to global companies as well as American companies. The conversations continue to be very constructive, robust. They're very interested in coming and tapping the American investor and frankly the global investor base. I mean, in the United States, we are the most liquid markets in the world. We have the most variety of investors. We have the deepest pools of liquidity. I think those things are, constant attractions in terms of companies who want to go public. Again, it's really more a matter of timing than it's more a matter of when than if they want to come and tap the public markets here in the United States.
I was here during Trump's inauguration while you were speaking to John and Lisa over in Davos, and you were very constructive on the incoming administration when it came to the excitement around IPOs, also deregulation. You were pushing for this regulation overhaul. Are you seeing what you were expecting back in Davos from this administration now in their first 100 days?
From a regulatory perspective, we are very excited about the fact that we can work constructively with the regulators that are coming into with the positions. With Chair Atkins coming into the SEC, he has deep understanding of the markets. He has a deep understanding of U.S. capital markets and also the need for companies to have a good public company experience and how important that is in terms of giving citizens access to the growth of our economy. So we are looking forward to engaging with him. We just put out a white paper on the need for reform in the regulatory landscape for public companies to have to be able to have a life as a public company, not have it be a oh gosh moment, but more a I can't wait moment. And so I think that that's something that we're really looking forward to engaging Chair Atkins on.
How big is the tone shift from the Biden administration and Gary Gensler to Chair Atkins?
Well, he just came into office, so we are going to introduce ourselves to him. We actually do know him from when he was a commissioner many years ago, but reintroduce ourselves to him, and we'll look forward to engaging with him as he gets going in his new seat.
You've been through a lot of different market regimes. How would you describe this one? How unique is it?
Well, it's funny. I have actually been part of many market events. I've been at NASDAQ, started at NASDAQ 32 years ago, so I've seen a lot. And every single one of them is different. I have to say, there's no two situations where you see a lot of volatility that are exactly the same in terms of the causes of volatility. What we've seen in terms of the reactions from investors is pretty consistent. When they, the thing, as I mentioned before, is that the thing that they like the least is uncertainty. And in any period of time where you suddenly have a big moment of uncertainty, they take the same attitude, which is a risk-off attitude. I'm going to take some of my positions out of the market. I'm going to sit and wait and understand what's happening, and then I'm going to re-engage in a smart way. That's a very consistent reaction. But the causes of every single period of market volatility have been different, actually, over the last 32 years.
Certainly feels unique this moment, that's for sure. Adina, thanks for dropping by.
Thank you.
Appreciate your time. Thanks for being with us. Adina Friedman there, the chair and CEO of NASDAQ. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to New York and catch up with Yahara Hacker. So, Yahara.
Hi, John. Colgate-Palmolive is the latest company to cut its growth and profit outlook. The toothpaste maker says tariffs are expected to add $200 million in costs this year. In its earnings presentation, Colgate said the levies will drive raw and packaging materials costs higher as commodity prices increase. Meanwhile, the Trump administration is updating rules to allow domestically produced autonomous vehicles to qualify for exemptions to safety standards. The National Highway Traffic Safety Administration will continue to require car makers to report crashes involving self-driving systems, but with less strict reporting requirements. And NFL teams are paying a premium for the top picks in this year's draft. Signing bonuses for last night's first-round selections came in at a record 26% higher than last year. That's according to reports from Sportico. The Tennessee Titans drafted University of Miami QB Cam Ward with the first overall pick. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Up next on the programme, Nick O'Rathi, the CEO of the UK's Financial Conduct Authority. Plus, we'll set you up for the day ahead, going into the weekend following a long week in Washington, D.C. Live from the nation's capital, this is Bloomberg.
case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening bout is about 45 minutes away, and your scores look like this. Doing okay on the S&P 500 on the session, better than okay on the week. On the session on the day, we're down by 0.15% on the S&P. On the week, we're higher by 3.8%. Going into the weekend with one more trading day to go. Elsewhere here in Washington, D.C., the UK Chancellor Rachel Reeves meeting with the Treasury Secretary Scott Bessent at the IMF as countries line up to strike trade deals with the United States. Corporates and regulators looking for clarity as President Trump shifts the global economic landscape. Joining us now to discuss, Nikhil Rathi, the CEO of the Financial Conduct Authority, a financial watchdog which monitors over 40,000 businesses in the UK. Nikhil, welcome to the program, sir, and sorry to miss you. You're up in New York, we're down in Washington, D.C. We crossed paths, I think, in the last 48 hours. I want to start with the nature of this shock and what it means to you personally and for the institution and ultimately for the UK. Nikhil, this is a policy shock across many dimensions. Does it have the potential to morph into a financial shock as well?
Good morning, Jonathan. What we've seen over the last few weeks has been extraordinary volatility, record trading volumes. In London, we oversee a huge global financial centre with asset classes ranging from commodities, equities, fixed income. And what you've seen is actually the financial markets staying resilient. You heard that from Adina just now, and coping with the changes in the external environment and seeking to find the price. And that is what we're focused on as regulators, making sure market integrity is maintained and the markets are functioning and preventing what you asked about, which is a policy shock turning into a financial shock.
Nikhil, one word we've heard repeatedly over the past few weeks, and I'm sure you've heard the same word, is orderly. Things have been orderly. When I think of certain vulnerabilities in the UK, my mind often shifts to the UK housing market. What is the positioning of the housing market at the moment? And do you think now is a good time to reconsider whether to lighten up some of the stress tests on, say, mortgage applications in the not-too-distant future?
You're right, market conditions have been orderly, and I think that's testament to all the work that's gone in over a number of years on operational resilience, on liquidity, on capital, and on data and vigilance in the markets to make sure that we do keep things orderly in these periods of extraordinary volatility. And the same applies to the housing market. We've seen a very significant shift in the interest rate environment in the UK, like in other countries around the world over the last few years. But the housing market has held up. Our repossessions are actually lower than pre-COVID, and we're seeing continued resilience in consumer balance sheets. And therefore, we think it is appropriate for us to have a discussion in the UK about how we support first-time buyers access home ownership. A lot of people are paying high rents in cities around the UK, and that isn't great for their long-term financial well-being. And so that's why we've moved in that direction as part of our overall push to support growth in the economy in the UK, which is obviously an urgent need.
Nikhil, there are two sides to this. On one hand, you could say that the resilience of the global financial system is a result of some of these regulations and stress tests. On the other hand, you could say that maybe some of these consumers don't have access to maybe as easy credit because of how regulated some of the financial institutions are. Are you pushing back against what we're hearing globally, in particular in the U.S., saying let's remove some of the regulations that maybe are too stringent on the financial sector?
We've had great conversations here in the US this week. I had the pleasure of meeting Chair Atkins shortly after he was sworn in, and I'm meeting a number of my other US counterparts. And I think on the whole agenda of growth, innovation, competitiveness, I think we're aligned. And this conversation is happening in the US, it's happening in the UK, it's happening in the European Union. We have significantly improved standards of capital and liquidity. In the UK, we've raised standards of consumer protection with our consumer duty. And it's right, having done that, to make sure that the regulations are fit for purpose for the needs of the future and what the economy needs right now. And I think we're moving very fast after putting around 50 proposals to our Prime Minister at the start of the year to implement those, simplify our rules, whilst maintaining consumer protection and market integrity.
Well, I guess that another way to frame this is in the years after 2008, there was a steady march toward tightening financial restrictions on banks. And we've seen, as a result of that, financial institutions lose businesses to private ones and a whole host of other transformations. Are we going to see some modicum of reversal of that? Are we going to see going forward walking back of some of the regulations around major financial institutions?
Of our significant reforms in the UK on capital markets, we've put through some of the most far-reaching reforms to our listing rules. In the last year or so, we're reforming the rules around prospectuses. We're transforming the way advice is provided in the UK so that our pension system is better able to provide capital to infrastructure and scale-up companies. We're also, though, a global financial centre, and we want to make sure that our markets serve all needs. So I don't see this as a opposition between banks and non-banks. We want businesses of all sizes to be accessing the capital they need, equity or debt, from public markets, from private markets, from banks. And the important thing is to make sure that all are well regulated and that we have the data we need to monitor and make sure the risks are well managed.
Across multiple policies, really, this White House, Washington, is setting the agenda for the rest of the world. Are you concerned at all for a race to the bottom when it comes to deregulation?
That's not the message I was getting from my US colleagues this week at all. There is an energy here around regulatory reform, for example, in the area of digital assets and stable coins, but also a commitment to making sure we have high standards of integrity. I think Chair Atkins said in his statement when he was appointed that he was committed to secure markets in the US. We have a very deep relationship with our US capital market counterparts. We share considerable amounts of data, and we work really closely together on market developments, on enforcement. So, for example, in recent weeks, we've seen significant volatility in sovereign debt markets and in bond markets. There's been a significant rise in hedge fund participation in those markets. We're talking about those issues and making sure we have a good mutual understanding.
You are the first head of the authority to actually get a second 5-year term. What do you hope to achieve in the next 5 years?
Our Prime Minister has talked about rewiring the state in the United Kingdom so that we are digitally enabled and fit for purpose for the rapidly changing technological environment we are living in. And I think that applies to regulators too. And we oversee one of the world's largest financial centres. We want to be open to business, to participants from all over the world. That's based on high standards, and we want to move fast on embracing new technology too, and forging deeper relationships with all of our key trading partners. So I think you'll see us moving very fast now on regulatory reform and seeking to make sure that we are right at the cutting edge of these new technological shifts.
Nikhil, thanks for sharing some time with us this morning. We appreciate it. A busy morning for you, I'm sure, in New York City. Nikhil Rathi there, the CEO of the Financial Conduct Authority, talking about the digital age and regulation. This story just dropped in moments ago. Allow me to share it with you. The lead story coming from our team, the lead paragraph. The US President, Donald Trump, and the administration putting pressure on Europe to ditch a rule book that would compel developers of advanced artificial intelligence to follow stricter standards of transparency, risk mitigation, and copyright rules. The pressure building on the Europeans from the US side on a new dimension.
On a new dimension, but this has been the message from this administration to Europe across a number of issues. Whether or not it's a digital service tax, whether or not it's now AI, you have to deregulate the tariffs when it comes to beef or autos coming into Europe. They want a more open market when it comes to Europe. And maybe potentially this is going to be a part of the grand trade deals when it comes to the European Union and Brussels.
As if that trade deal wasn't hard enough, it gets even more complex. That's the latest news from our team here at Bloomberg. The latest price action, we are negative by 1/3 as we count you down to the opening bell, about 36 minutes away. Your trading diary, the calendar looks like this. At 10 a.m. Eastern Time, we get UMich consumer sentiment, plus trade talks between Treasury Secretary Scott Bessent and the British Chancellor of the Exchequer, Rachel Reeves. On Tuesday, we'll get JOLTS data and consumer confidence. Wednesday, PCE data, plus earnings from Meta and Microsoft. On Thursday, another round of jobless claims and results from Amazon and Apple. And then before you get to next weekend, Lisa, an important jobs market report. Payrolls just around the corner.
Will it matter? Will people take a look at it and say that this is the hard data we've been waiting for? It looks like it'll be another one. If it's bad, it might have an implication. If it's good, people will say it's not actually reflecting the pain. This is the difficulty and the reason why corporate earnings still front and focus about getting a real-time read on just how companies are adapting and adjusting, as well as consumers.
The corporations in wait-and-see mode. What does it mean for this jobs market? The payrolls report a week away. That wraps up our coverage here in Washington, D.C. from the nation's capital at the IMF World Bank Spring Meetings. Thank you very much for choosing Bloomberg TV. Coming up on Monday, we'll catch up with Lori Calvasina of RBC, Abby Yoda of JP Morgan, Amanda Lynham of BlackRock, and Seema Shah of Principal Asset Management. If you can, enjoy a quiet, calm, relaxing weekend. Live from Washington, D.C. This was Bloomberg Surveillance.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. The Queen of Clay, Iga Swiatek, had to fight back from a set and a breakdown against Alex Ayala to reach the third round. The victory avenged her defeat to the teenager in the quarterfinals in Miami last month. The world number 2 fired 40 winners in her 58th consecutive opening round win on the WTA Tour.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
in case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, we are looking at futures that are down, but potentially we have triggered a technical signal that means we're going to rally over 6 and 12 months. 30 minutes till the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, mixed messages on trade. China denies talks again, contrary to what President Trump says. And Google is gaining on strong results, setting the tone for next week's Mag 7 reports. Plus earnings, tariffs, volatility. We're going to round all of that up, as well as the swag breadth thrust with Rob Arnott, investing legend. Katie?
Meanwhile, some stocks we're keeping an eye on. Alphabet rising after topping earnings estimates driven by strength in Google's search business. You can see shares up about 3.4%, Matt.
All right, Intel is falling after the CEO announced those job cuts we've been reporting and a shakeup for the company's culture, all signs of short-term stress for the firm.
You can see shares down about 7% right now, but let's get to the latest trade developments because President Trump told Time magazine that he should announce trade deals in the next 3 to 4 weeks. That comes as China considers suspending its 125% tariffs on some U.S. imports, including medical equipment and some industrial chemicals. Bloomberg's Tyler Kendall has the latest. And Tyler, just give us the lay of the land here because there is some question marks still remaining over whether these two countries are even talking. But if you read the tea leaves, it seems like there's some positive signs there.
Yeah, hey, Katie. A potential de-escalation, Bloomberg News reporting that this would really focus in on those certain sectors where Beijing is more import reliant in a bid to protect their economy and shore up those industries that could be hit particularly hard. You mentioned their medical equipment, also industrial chemicals used to make things like plastics and cooling agents. Bloomberg News also reporting that potentially plane leases could see a reprieve as well. But at the same time, sources familiar do caution Bloomberg all of this is in flux as that disconnect between Beijing and Washington does appear to be continuing. Yesterday, you had President Trump in the Oval Office suggesting that talks with China were happening that day, even as Beijing denies that they are happening at all. And then in that Time magazine interview released today, but actually conducted on Tuesday, President Trump suggested that Xi Jinping has called him. However, he didn't give us any specifics on what was discussed or even when the timeline was. And it's probably worth mentioning that, of course, these leaders have had calls before in the past. Most recently that we know of is right before the inauguration. Matt and Katie, while we try to parse through whether or not these talks really are happening and what they potentially do contain, we can say there is a Chinese delegation here in Washington this week for the IMF spring meetings, but at this point, no formal bilateral talks have been announced.
Has it not gone beyond a suggestion, Tyler? Didn't President Trump answer in the affirmative when asked if Xi Jinping had called him?
Yes, he did. He said that he had called him, but he didn't give us those firm timelines on when that call had happened. And earlier this week in the Oval Office, when asked if talks with China were active, he responded that, quote, everything is active. So he is saying here that that call did happen. He also said that he would not call Xi Jinping directly if the Chinese president wasn't the one to call him first. But definitely still some ambiguity here on exactly how these talks are happening and at what level, because Bloomberg News had been reporting that Beijing had some important preconditions here, including that somebody other than President Trump be the point person to lead any trade negotiations.
A fluid situation, to say the least. Bloomberg's Tyler Kendall at the White House staying on top of all of it. But let's switch gears now to tech, because it's a tale of two earnings for Alphabet and for Intel. You have Alphabet posting a strong quarter thanks to search and its ad business, while Intel posts a bleak outlook. We also have Apple in the news after reports that the company is looking to build more iPhones in the U.S. Here to look at all things tech is B-Tech co-host Caroline Hyde. There's a lot to get to, but I want to start with Alphabet, up about 3.6% right now in the pre-market. It seems like the consensus from the sell side is that this was better than feared.
Phew, is what the consensus is. And actually, advertising revenue really resilient, considering that retailers, for example, is what some analysts called out. The fact that they're still committed to spending on Google products is notable. Now, this is also a company that's managing to weave itself into the new AI age. AI overviews, we got from Sundar Pichai the call that basically got about 1.5 billion people coming per month to be using their search, and with AI overviews too. They did miss ever so slightly on sales when it comes to the cloud, the growth narrative within Alphabet, but the profitability was strong there. So that showed some real gains. They're still managing to be investing infrastructure-wise, $75 billion as the capex that they're sticking to, because they need to keep rolling out. Once again, they're limited by supply on compute rather than by demand. And YouTube, look, we saw a slight miss in terms of the overall revenue for YouTube, but again, they're calling out numbers like 1 billion people coming for podcasts on YouTube per month. That's much more than Spotify and Apple. So overall resiliency coming from Alphabet, I think.
I hope they're listening to my podcast, Hot Pursuit with Hannah Elliott.
Who doesn't? Who doesn't?
Yeah. If you care about cars and motorcycles, you will listen to Hot Pursuit. I want to ask about Apple, because Dan Ives recently said they build more than 90% of their smartphones in China. And now Apple plans to import, I guess, the lion's share of U.S. iPhones from India. So can it really move that quickly?
Unbelievable. They're going to be doubling, basically, their production in India in just a year. So up to fiscal March 2025, they basically were shipping about 40 million iPhones per year from India. Now they're going to make it 80 million. Here in the US, we import about 60 million. So they're going to be able to meet all of the demand. That's so important because at the moment, yes, smartphones and electronics have been stripped out of all these tariffs, but India faces far less hurdles than China does eventually. And so I think everyone's thinking, okay, we've got to redistribute. India has taken, remember, about a decade for them to get their manufacturing to where they need it to be, but we're managing to pull out all the stops, and they're really accelerating that shift, Matt. You're so right.
All right, Caroline, thanks very much. Caroline Hyde there talking to us about the tech stuff, because she's an expert, because she anchors Bloomberg Tech. It starts at 11 a.m. Definitely tune in for that. Let's get more right now on Google. For that, we're joined by Laura Martin, Needham analyst. She has a buy rating on the stock with a $178 price target. And I want to talk first about these AI overviews, Laura, that Google is doing. I guess it doesn't matter to me so much whether they're slightly successful or not, because they can't ever be as successful with that as they can with search, can they? They absolutely dominate in search.
So, good question. What they're saying is that the monetization is equal to their search. So what's getting hurt is you used to have links, and that would actually drive traffic to off Google site websites, and that's ended because now you're just getting your answers from AI Overview, that product. So Google isn't injured because it's getting the same monetization as it used to get with search, and they do have 1.5 billion users. So you're right, from the point of Gemini, which is their generative AI product, which is sort of different from Google Search or from AI Overview, they are way behind ChatGPT over at OpenAI. But in terms of Google Search, it seems like they're elongating engagement, equaling the monetization, and they've now got 1 billion people globally in 140 countries essentially using their search engine, but it has answers now instead of links.
Laura, I also want to talk about the ripple effect that we're seeing from this report from Alphabet, because you have the likes of Meta and Reddit, some of the other social media names up today. You wrote about this in your reaction piece. Basically, we heard from the CRO that they haven't necessarily seen a slowdown in ad demand during April yet as a result of the tariffs. Do you think that's a sustainable situation?
I mean, good question. Technically, tariffs doesn't affect these virtual companies, but what affects them is consumer demand and consumer sentiment. So we need to keep a close eye on what's happening with consumer spending. And in some cases like retail, I think the market was really pleasantly surprised to hear that Google had said that in the second quarter, they haven't seen big deviations from the first quarter. And they called out retail as one of their 2 strongest ad drivers in the first quarter. So if that hasn't changed, that's a big surprise, because you would have thought, or the worst case would have been that advertisers who are seeing tariff increases in retail would immediately cut their ad spending in order to hit their promise of earnings to their CEO. So if that's not happening, that's a good sign that the enterprise isn't slowing their ad budgets and that consumers haven't stopped buying goods.
I keep listening to reports on Google, reports on Alphabet, and usually in the second half of the discussion, they talk about a breakup. But it's shocking to me because if you're talking about the potential breakup, you know, I grew up during the breakup of Ma Bell. I would think that takes the lead. Why is this so buried, Laura?
So, for one thing, they didn't talk about it on the call. None of the 2 lawsuits they've lost got discussed on the call, and no analyst asked about it. So I think a reasonable question to this management team would have been, look, if they force you to spin off the ad tech business or spin off Chrome, or what does Google do? I think that's a reasonable question. Nobody brought it up. The other thing I'd say is all of our work shows that this stock would rise 20% if they were forced or just decided to sell all or part of YouTube. Wow. Because a lot of the assets here are a lot more valuable standalone than they are as part of this conglomerate because it's undermanaged. I mean, I think the market is telling you it is 17 times to 2025 earnings per share, which is half the market average. They do not like this management team.
That is really interesting. I just want to meditate on that point a little bit more. So you're saying if they spun out YouTube, basically, that could drive 20% upside in the shares. I mean, do you see that as a possibility? Are there any tea leaves to read there that could be something that happens?
So, good question. I think so. That's a good question. I think the government is talking already about spinning off their ad tech business and Chrome. The point we're making with YouTube is that this company is worth more in pieces than it is together, in my opinion.
All right, Laura, really interesting note to end on. Hope to have you back soon. That is Laura Martin of Needham. Now coming up, Rob Arnott of Research Affiliates joins us at the desk. This is Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom Mackenzie in Paris, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. First off, a Bloomberg scoop. It's a deal that would rank among the biggest buyouts ever. Toyota Motor Chairman Akio Toyoda is proposing to buy out Toyota Industries, and the move would consolidate the chairman's grip on Japan's biggest business empire. Toyota Industries famously makes textile looms, as well as parts for Toyota's cars, and discussions are ongoing. Foreign investors have sold $63 billion of U.S. equities since the start of March, according to a Goldman Sachs estimate. The data from high-frequency fund flows shows that European investors have been driving the selling. Goldman notes that since 1980, there have been 10 other instances of substantial foreign investor selling. And it's been quite a week here in the U.S. The S&P 500 has risen more than 1.5% on the last 3 consecutive days. This is an uncommon event that usually precedes bull runs. The question is, what happens on the 4th day? And according to our London-based charts producer, Dan Curtis, who incidentally is an Olympics-level rower, equities fall over 60% of the time on the 4th day. So don't hold your breath today. And by the way, speaking of silly technical indicators, I am super pumped on the swag breadth thrust. This means that if you see positive breadth going from 40% to 62% over a 10-day period on the NYSE, 6 months out, you get a gain, a double-digit gain. 12 months out, an even bigger double-digit gain. I think the average is 24%. And we've only listed a few of the occasions here. This signal has been triggered 19 times since World War II, and the market has finished up 6 months out and 12 months out each of those 19 times. So, Katie, it's 100% for the swag breadth thrust.
Incredible setup, Matt Miller. Let's discuss this with Research Affiliates Chairman and Founder Rob Arnott. Rob, it's great to see you on this Friday.
Great to see you.
So Matt's psyched, and he's not alone when it comes to the swag breadth
I got dressed
thrust.
in the dark.
He came
because
over
of this.
to my desk at 8:47, basically hooting and hollering about this thing. So tell me how you're taking in some of these signals. There's a lot of people also on social media and in notes this morning who are jazzed about it. But at this moment in the markets, how much stock can you put in technical indicators such as that one?
I forget who it was who coined the expression, but if you torture the data long enough, it'll confess to anything. If you mine data and look for predictive relationships that have a great batting average in the past, you'll find a gazillion of them. I think that's the technical mathematical term. And most of them will be nonsense. This one, my confidence in it is about the same as tea leaves or sunspots.
Some people have a lot of confidence in those. I will just note that last time you were here, we talked about dead cats and then bouncing. Now we're talking about torturing data, so it's always a violent
this is
conversation.
a dark conversation.
Yeah.
Let's talk about something in which you have a little bit more confidence, and that is when we get these periods of high volatility, you see investors shifting into lower risk stocks, diversifying their portfolios, and looking for value stocks. How's the best way to define that? Is it value by PE? Is it value by price to book? Is there any kind of consistency measure? How do you define that?
Well, firstly, we like to use multiple measures. We like to look at relative price to earnings, price to cash flow, price to book, price to sales, price to dividends plus buybacks. And using multiple measures is a much richer picture. But
a blended
right. But the relatively simple ways that Russell, for instance, bifurcates between growth and value are perfectly adequate. So what we find is that periods of turbulence lead to a flight to safety. Periods of elevated inflation lead to a flight to safety. And we're in a very special environment in which value is extraordinarily cheap relative to growth, fueled in part by the surge of money into indexation, which pushes the expensive up and the cheap down. But you have value extraordinarily cheap. You have a possibility of renewed inflation, perhaps on the back of tariffs. I can come back to some observations on that in a minute. And in addition to that, you've got heightened volatility.
Well, just meditating on that a little bit, what you're saying that you look at value, it's historically cheap to growth. I feel like you could have said that, it looks like we are actually going to hear from the president.
President Trump is talking. We have to listen. Let's tune in.
It's going to be very interesting. We're going to meet with a lot of the foreign leaders. They want to meet. Trade deals are going very well. I think Russia and Ukraine, I think they're coming along, we hope. Very fragile. And Iran, I think, is going very well. We'll see what happens. We're working on plenty of things that shouldn't be worked on because none of this stuff should have happened. This should have been taken place by Biden. It should have been fixed by Biden, but he couldn't do it, nor could he come close to doing. So anyway, we're going to Rome to pay our respects, and we'll be leaving that same day. We'll be coming back home tomorrow night. And I'll see some of you over there. Otherwise, I'll see you on television.
How was the Waitlist meeting this morning? You said you spoke with President Xi. Have you spoken to him since the tariffs? When was the last?
I don't want to comment on that, but I've spoken to him many times. Yeah. From Japan. From Japan, I'm getting along very well with Japan. We're very close to a deal.
Will you be meeting with the president?
I'll be meeting with the Italian, yes. Your prime minister? Oh, it's possible.
How would you with the First Lady remember Pope Francis, sir? How would you with First Lady?
Very well. Good man. He loved the world, actually, and he was just a good man. I met him twice. I thought he was a fantastic kind of a guy.
Time magazine that President Xi called you. When did that happen, and what did you discuss?
I'll let you know at the appropriate time. Let's see if we can make a deal.
The Witkoff-Putin meeting. Any updates on the Witkoff-Putin meeting, sir? The meeting right now. What do you hope to transpire?
They're meeting with Putin right now as we speak, and we have a lot of things going on. And I think in the end we're going to end up with a lot of good deals, including tariff deals and trade deals. We're going to make our country rich, but we're going to try and get out of war so that we can save 5,000 people a week. And that's what my aim is. I want to save 5,000 young men. They happen to be mostly Ukrainian, Russian. 5,000 young Ukrainian and Russian men, and that's a big honor if I can do it. I think we're pretty close. No deadline. I just want to do it as fast as possible. What?
12 states have sued over your tariff plan. What do you say to those who voted for you?
I think the tariff plan is doing very well. We're resetting the table. We're going to make our country very rich, very, very rich. It's already happening. Thank you very much.
And that was playback of President Donald Trump speaking to reporters moments ago. Let's bring back in Rob Arnott. So, Rob, we play this because this is what markets are moving on, trying to basically divine what is going to happen with our trade relationships with the rest of the world. And it almost feels impossible to try to model out what the impact will be on earnings, on businesses, on the economy. And I wonder, as an investor, how are you approaching the whiplash when it comes to the state of negotiations with China, with Japan?
George Box famously said that all models are wrong, some models are useful. I find it hilarious that Wall Street keeps trying to model tariff impacts on inflation, on GDP, on interest rates, when the tariffs change every single day. Relatively easy to model volatility. What's going to happen on the trade negotiations, on the tariffs? None of us knows, and I don't think even Trump knows. It's a game of high-stakes chicken. And so the way this plays out with relatively high confidence, we can say it plays out in a context of elevated volatility. Well, what happens when you have elevated volatility? The natural level of markets goes down because of risk aversion. The relative performance of growth tends to get hit harder because people are seeking the safety of basically a safe haven, a margin of safety. And in the quest for that margin of safety, risk-off assets tend to do reasonably well, and value tends to do well relative to growth. You also have disruptions that take perfectly reasonably priced markets cheaper. Small cap value has gone from cheap to a little cheaper. Well, that's a buying opportunity. And human nature conditions us to say, get me out of here when something is disappointing. The correct response is, has anything changed on the fundamentals? If not, take advantage of the bargain.
Interesting. Well, that's where I want to go. I mean, small cap value, that is not for the faint of heart.
No.
And as you point out in your notes, it's been hit really hard over the past couple of weeks, months. So the fundamentals haven't changed, but
no, they
even
haven't.
Still, do you need a catalyst for folks to actually be brave enough to step in?
The catalyst often is that it's already made a move and you've missed it.
Yeah. That's what I wonder about, the timing especially, right?
Average in. Average in.
The Russell 1000 value index is down 2.5% year to date. The growth index is down well over 10% year to date. I looked at this because I was looking at the S&P over 2001, 2002, right?
Yes.
3 years in a row of declines. And I was thinking, well, if at the end of 2000 you said, I'm going into value stocks, you still took huge losses the next year. The Russell 1000 value index was up in 2000, but then down 7% in 2001 and down 17% in 2002. So the timing matters.
Right. Right, but a lot of that, relative to the S&P and relative to NASDAQ, was a small hit. One of the things I found fascinating is dot-com bubble burst in March of 2000. Roll the clock forward 2 years to March of 2002, NASDAQ was down roughly 50% on its way to a 78% drop.
Ouch.
And
took
Russell,
20 years to recover.
Right, and Russell 2000 value was up 53%.
Huh.
So small cap value, despite its feeling risky, actually left you 3 times as wealthy as a NASDAQ investor in just 2 years.
There you go. That is a good place to put a pin in this conversation. Rob, you're sticking with us through the opening bell. Coming up in just a couple of minutes, and here is your setup as we head into 9:30. You can see the S&P 500, we're pretty much unchanged. We're coming off of a couple days of pretty sizable gains, as Matt led us through a couple of minutes ago. But right now, a little bit of a break. Same too when you take a look at big tech. Even though you had those good numbers from Alphabet last night, not really putting much of a bid into the NASDAQ 100 overall, and those small caps, as we were just talking about, small caps overall, as measured by the Russell 2000 right now, Matt, currently down about 0.8%. We will bring you all of the opening action up
Did you
next.
notice the Dow?
Tell me about the Dow.
Back up through 40,000. You didn't get that memo yesterday? The Dow Jones Industrial Average, the index that probably most living people recognize more than any other.
We're going to talk about the Dow, the S&P 500, the NASDAQ 100 up next. This is Open Interest.
In this facility, which is part of your $2 billion investment in the last 2 years, is a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, you know, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We have had 3 consecutive days of whopping gains, adding more than 300 points to the S&P 500. Maybe today is time for a breather. You can see the S&P 500 is unchanged even after good earnings from Google. In fact, most of the earnings that we've seen yesterday and this morning have beaten, certainly on the EPS, on the bottom line, if not on sales. Okay, we're flipping up to slightly positive there, but this is still futures. Let's take a look at the bell. First of all, it's the Arbor Day Foundation ringing the bell at the New York Stock Exchange, which is great because the whole thing started around a buttonwood tree in 1792, right? So going back to their roots, so to speak, no pun intended. Down at the NASDAQ, you have Merex ringing the opening bell. Their stock has more than doubled over the past 5 years, so they have good reason to be happy. And maybe everyone's psyched because the SWAG breadth thrust indicator has been triggered, Katie, and you know 19 out of 19 times since 1943. That means gains 6 to 12 months out.
I will note that the yield curve had a great recession track record, and it worked until it didn't. But
and the SOM rule.
We'll continue to talk about that, but let's take a look at the stocks that are making the biggest moves at the opening bell. We start, of course, with Alphabet. As Matt mentioned, it topped earnings estimates. It was driven by strength in the Google search business. Shares up about 3%, so a needed dose of good news here for this stock. I will note that Alphabet was down nearly 16% year-to-date through yesterday's close, Matt.
All right, so we see the moves there in Google. I want to point out also Intel moves to the downside 9% after the CEO announced job cuts. Bloomberg's been reporting for a week or so, but job cuts and a shakeup for the company's culture. He struck a very somber tone about what's going on at Intel. And as a result, the stock has pretty much been decimated today in the early minutes of trading. We are back with Research Affiliates Chairman and Founder Rob Arnott. And Rob, I'm so fascinated by this, not just the value play that you recommend, but also the small cap value. And I wonder, because I think of small caps as not profitable. I mean, a huge part, right, of the Russell 2000 is not profitable. And I guess you have to be a value stock, you have to have an E, right? If you're measuring PE.
If you're going to survive, it's useful to have an E.
Is there any way, do you measure consistency when looking at value stocks? I mean,
I tend to look at them in aggregate, but I also like to use quality filters. Look at the profitability, look at the debt equity ratio, look at the debt coverage ratios, filter out the possible value traps. We have quality filters that I like to joke eliminate 10 out of every 3 value traps. For every 3 that go bust, you're filtering out 10. But it winds up being a very useful way to make sure that the value investments that you're buying aren't merely looking cheap on their way to zero.
Your thesis makes total sense to me, that in times of trouble, people gravitate towards something that's safer, that's more, that's less risky. But on the other hand, you also point out that those frothy stocks, airy frothy, get sold off. And I was just wondering, do you prefer long investing versus short because your losses could be capped? Is it also inherently less risky?
I'm okay with long short, where you're long some stocks and short others, but shorting a bubble is really dangerous. My favorite example is the Zimbabwe stock market in 2008. They had hyperinflation underway. At the start of the summer, the currency was in free fall. Somebody could have looked at that and said, this country's in trouble. I want to short the stock market. Well, the stock market in the first 8 weeks of summer went up 500-fold in Zimbabwe dollar terms.
Ouch.
The currency fell 10-fold, so in US dollar terms, it was up 50-fold. If you had a 2% short position, you just got wiped out. The next 6 weeks, the currency fell another 100-fold in 6 weeks, and the stock market cratered and stopped trading. And so you would have been right, but bankrupt. Minor problem.
Right, but bankrupt. I would rather be wrong and rich. But let's talk about international a little bit more. Maybe not Zimbabwe, some painful history lessons there, but when it comes to this international theme that's really percolating around markets, you have a lot of folks talking about selling American assets and just going international. Where do you fall on that narrative?
I think non-US markets are cheap. You look at the U.S., we came into the year at a Shiller PE ratio of 37. We're still at 34. We had the Shiller PE ratio is price relative to 10-year average earnings. It takes out the effects of economic peaks and troughs. And Europe was 18 times. Emerging markets was 15 times. These are cheap. And of course, Europe has soundly outpaced the U.S. year to date. So what's cheap gives you that margin of safety, even if it doesn't feel like it.
So if international markets are cheap overall, I have to imagine that small cap international is pretty cheap as well.
Small cap international is cheap. Small cap and emerging markets, not so much. And value international is historically cheap. Value in emerging markets is near record cheapness. U.S. value relative to growth is near record cheapness. Small cap relative to large cap in the U.S. is near record cheapness. These are cheap markets. 2 years after the dot-com bubble burst, an investment in Russell 2000 value left you 3 times as rich as an investment in NASDAQ. I wouldn't be shocked if, at least directionally, we find a similar thing play out in the coming couple of years. I don't think it'll be a 3x multiple, but who knows?
All right, we'll have to check in with you on that. I've restrained myself long enough. I really want to talk about ETFs. I was explaining to Matt this morning at 6 in the morning that you recently have made some hay by shorting triple leveraged ETFs, both on the long and the inverse side, because if you hold these products for long enough, because of the volatility drag, because of the financing costs, they tend to underperform over time. And it's interesting, since I wrote that article about you on that trade, you saw Defiance, an ETF issuer, come out and file for a double short MicroStrategy ETF. It would hold a leveraged MicroStrategy ETF, but shorted. And Rob, I'm so curious to hear your thoughts on whether this trade can still work if you put it in the ETF wrapper.
By the way, I love this.
Yeah.
When Katie explained this to me, like a light bulb went off. And I absolutely adore the idea, because these are products that are meant to be used for a few hours or a few days at most. The idea that you short them over time, I think, is fascinating.
There's so much interesting about these triple leveraged and double leveraged ETFs. Firstly, put it in an ETF wrapper. Sure, why not? The issue is capacity. Right. I'm doing this on a $5 million scale, and the borrowing cost to borrow ETFs, triple leveraged ETFs, is astonishing. Typically, you're looking at 10 to 20% borrowing costs per annum.
Yeah.
Silver, there's a 3x levered silver ETF, long and short. You short both of them, you cancel the risk. Very cool. And you capture the volatility drag. But to short the short ETF, your borrowing cost is 7,000 basis points a year.
Ouch.
So, now, I was shocked. I did that one on a very small scale, and I was shocked I made money net of the 7,000 basis point cost. But that's a daunting cost. Now, put this into an ETF, and kudos to the folks launching the ETF. It's a clever idea. On paper, it'll work beautifully. I worry. I'm doing it on a $5 million scale, and the costs are insane.
Yeah.
Try it. Let's say that 50 million flows into the fund. Just 50 million. I think you'd swamp the market.
Yeah.
Imagine $250 million flows into the fund. You'd demolish the market.
Yeah, and that's not out of the realm of possibility because we've seen so much investor appetite for these leveraged products. So just to tie a bow on this point, so basically if these get any sort of meaningful scale, the trade ceases to work because the borrowing costs are going to skyrocket.
Correct. There's another fascinating nuance of triple leveraged ETFs, and that is if the market goes up, they have to buy in huge margin, in huge quantity, the asset that they are shorting or going long leverage. And the reason behind that is if you're triple leveraged long and it's up, you're now under levered and you have to buy more. If you're triple leveraged short, you're now over levered and you have to buy. So if the market that you're shorting or going long 3x levered goes up 10%, the combination of the two ETFs has to buy over 100%, over 100% of their total AUM on that day.
You got to stop telling people about this stuff, Rob, because then Katie writes about it and she blows up your spot, right? Because then your $5 million trade gets ruined by somebody coming in the market with size.
It's a game, and the game is coming to an end.
It was fun while it lasted, though.
But somebody's launching an ETF on it, so it's out there.
Rob, awesome to have you spend some time with us. Thank you so much for coming in. Research Affiliates Chairman and Founder Rob Arnott. Let's talk about some of the movers on our radar today. Skechers is a shoemaker. You may know the brand, and it is the latest to pull its annual guidance. So Skechers down 3.4%. It is a kind of a down-ish
They have
day
the light up sneakers
right
though,
now.
So.
We have T-Mobile missing on subscriber additions. As we know, some have missed, some have hit. In terms of the big two, T-Mobile in the former category. And then Colgate cuts sales and profit view on a $200 million tariff hit. I understand the sales, but in profit, do you have any choice but to buy toothpaste?
That's the thing. You would imagine that they have some pricing power when it comes to their very staple-like products, but it'll be interesting to see how that story develops. Meanwhile, coming up, Morgan Stanley's Jitanya Kandari on the Sell America trade. We'll discuss next. This is Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Hasbro getting upgraded to a buy over at Citi thanks to its underlying business momentum. The toy maker beat analyst estimates yesterday. Also said it's in good shape to weather the tariff increases. Shares up about 0.8%. Next up, we have Lowe's getting upgraded over at KeyBank along with its peers Williams Sonoma and La-Z-Boy. The analyst says that the recent pullback creates opportunities, pulling back a little bit more today. And finally, we have UBS upgrading Philip Morris to neutral as it sees strength in the tobacco company's smoke-free gross margins. Shares pretty much unchanged. Speaking of unchanged, let's take a look at the stock market right now. The S&P 500 almost perfectly even on the day. Now, there you can see it, even if this holds, even if the S&P 500 doesn't do anything today, it's still higher by about 3.8% on a weekly basis. A lot of people will take that in this market. Similar story if you take a look at the NASDAQ 100, unchanged despite a beat on Alphabet, but the small caps really taking a beating right now. Matt Miller down about 0.7%.
I'm kind of bummed out right now.
No.
My bubble has been burst because Simon White from the Markets Live team at Bloomberg in London has told me the swag breadth thrust indicator was triggered in August of 2008. And that means its perfect record is ruined. 6 months out, it was down big. 12 months out, it was still down.
19 out of 20 isn't bad, Matt.
True, 19 out of 20. Let's talk about these crazy markets with Jitanya Kandari. She's the Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Jitanya, thank you so much for coming in and joining us here on set. We've had a string of up days, 3 in a row, and that only happens like once every 5 years. We have a chart. We have a chart of this, and you'll see how rare it is.
We'll show it in about a minute.
Was that a head fake? I mean, or have we put in a bottom in this market?
$1 million question. I think we really have to see how the trade negotiations pan out. I was in DC recently, and it seems like we are at peak trade uncertainty. So from here, I think the marginal incremental news gets slightly positive. Section 232, which is pharmaceuticals and minerals, are still being contemplated and thought about. But I think if there are some bilateral deals struck, the ones that look obvious are Korea and India, maybe UK, there may be some respite in the market, but I think the longer term issues of where the earnings and margins settle is still a question.
And there we have
Here's the chart.
as you can see, pretty rare to see these types of gains. But it's interesting to hear what you're saying, that any sort of incremental positive news will probably send this market higher. Talk to us a little bit more, though, about the mood music at these IMF meetings. I mean, what did the conversations on the ground actually sound like?
Too much consensus, which is interesting. Worries about U.S. growth, worries about U.S. earnings, worries about the dollar, and diversification into gold and cash. So I think consensus has really swung to that direction. So it's important to keep in mind, even some of our dollar charts are indicating positioning in the yen has reached pretty extreme levels. So I think you could expect a bounce back, especially if there is some positive announcement. But I think over the longer term, I would question the margin sustainability in the market, because a lot of that margin improvement that has happened in the U.S. markets has been on account of globalization, which is now turning. So I would be worried from a longer term perspective on where those earnings are and what market multiples are assigned to that earnings. So I think longer term, there is still some room to expect more correction.
Are we at the point yet, Jitanya, where everything we've learned about finance, economics, and markets is now meaningless? Like, is this an absolute sea change in global trade? Will the dollar remain the world reserve currency? Do you still buy treasuries in times of fear?
Yeah, I think there's one thing where there's a sea change. The dollar, which is the reserve currency of the world, gives it distinct advantages. But with those advantages, it gives it a responsibility to act and preserve economic resilience and trust in the international community. And that is being questioned with the interference in central bank, with the interference in institutions, and that's what the US stood for. So I think economics is working, right? Fiscal monetary policy in the US is constrained, and that's going to also have an impact on growth. Fiscal and monetary policy in the rest of the world is much better, and that's why the markets are pricing in better outcomes in other pockets of the world. So I think economics is working. There's a regime change in the credibility of the dollar and what that means for institutional trust and stability. And I think that is something that is important to keep in mind, because it's reflecting in the term premium in treasuries. So we are watching that. My hope is that, we've reached like the peak fear situation, but something to really keep a close eye on.
We have 30 seconds left, but that's a really big point, so I want to just meditate on it for a minute here. Is that investable yet? You said you're keeping an eye on it, the dollar's credibility as the reserve currency. Can you invest in that yet?
I think diversification, you cannot get out of the dollar because it's still a large part of the financial system in terms of reserves, in terms of debt, in terms of transactions. But I think diversifying out of the US is making much more sense because, as I mentioned, the monetary policy, fiscal policy is better in different pockets of the world. ECB cut, India cut, Philippines cut. That's one. And I think the currency valuations for the rest of the world, it's very heterogeneous, so you really have to be active, can be a very strong component of total returns for international markets. I've always said that currencies can contribute to a third of returns. And that's an important tailwind for international.
All right, Jitanya, have to leave it there. Hope to have you back soon. That is Morgan Stanley Investment Management's Jitanya Kandari on a potential sea change. Now, coming up, we'll dig into those Alphabet results a little bit more in open interest. This is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back to Open Interest. Check on Alphabet, higher this morning on strong ad revenue. For more on Alphabet and all things tech, I'm pleased to say we're joined by Mandeep Singh of Bloomberg Intelligence. So Mandeep, when we spoke to you yesterday about Alphabet for a preview, you said that you were still a little bit worried about the fundamentals here. Give us an update now that you've had time to digest from what we heard last night.
Yeah, I mean, look, for a company like Alphabet, they can pull a lot of margin levers, and that's exactly what they showed last night. The search margins grew even though the top line didn't grow that much. And what it shows is the search franchise is still intact. Look, their Gen AI results may not be superior to ChatGPT right now, but they still are adequate for a lot of the search users, which is pretty much the entire planet, when it comes to the traditional search. So net, look, they have diversified their business, cloud, YouTube, Waymo, but the search franchise, I think, is intact, and that's what they comforted the investors last night.
Mandeep, I keep seeing in Google stories on page 4 that they may be broken up by the U.S. government. Why isn't that the lead?
Well, I mean, there are a couple of pending cases, the monopolization and the ad tech, and there could be remedies that come out of it. But there is no denying the fact that Google has more competition now than it did, 2-3 years back. So from that perspective, if you're looking forward, I think it may be hard to come up with a remedy that involves divesting a business because they have a monopoly. And look, it has hurt them in terms of flexing their muscle. When it comes to the, the ad integration they can show across the apps. But overall, I think they are showing that, diversification is helping their business. The cloud side will be a driver in the second half, regardless of what happens with the de minimis change, which will be a headwind. I mean, they called out softer 2Q and the fact that Chinese advertisers are pulling back. So I think they have multiple levers. Even if something were to happen on the regulatory side, they should be fine.
All right, Mandeep, thanks very much. Mandeep Singh there of Bloomberg Intelligence. Coming up in the next hour, Citi's Kate Moore joins us at the desk. Plus, we speak to the CEO of a major food group and Ducati North America.
We'll have to see over the next 3, 6, 9 months
how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump says Crimea will stay with Russia. In an interview with Time magazine, he discusses an endgame to the war and says Ukrainian President Zelensky understands that. Crimea was seized by Russia in 2014. For now, Russian Foreign Minister Sergei Lavrov tells CBS's Face the Nation.
The negotiations continue, and until the end of the negotiations, we cannot disclose what it is about.
Russia says a criminal investigation is underway into today's death of a top general. He was killed by a car bomb near Moscow. CBS's Holly Williams.
Russian officials say that Lieutenant General Yaroslav Moskalik was killed by an explosive device rigged with shrapnel and placed inside a car just outside of Moscow this morning. Moskalik was a senior figure in the general staff of Russia's military.
Sentencing begins this hour for former Long Island Congressman George Santos. He tells CBS News he's resigned to the fact the judge could impose a stiff sentence for fraud. Santos faces a maximum of more than 7 years. Loyola Law's Lori Levinson.
If we recall, this was a crime that was so bold. He basically took political donations and used them for his own personal casino holidays and designer clothes and even Botox treatments.
The public viewing for Pope Francis will wrap up today at St. Peter's Basilica, where the Vatican says about 150,000 people have now filed past his coffin. A funeral is tomorrow. Papal contributor Delia Gallagher.
One of the things the Vatican is doing is setting up here in St. Peter's Square for the massive protocol that's going to be required. 50 heads of state, 130 delegations, monarchs coming in.
Dignitaries will include President Trump, who's now on his way to Rome, marking the first international trip of his second term. Lawmakers in New York want to crack down on tour helicopters after a deadly crash.
The City Council approved a bill that would ban helicopters that exceed FAA noise standards from using the city's heliports. Council Majority Leader Amanda Farias.
Many of us are also looking at how do we regulate the safety measures that have to be put in place.
The bill's passage comes 2 weeks after a helicopter crashed in the Hudson River, killing a family of 5 from Spain and the pilot. It's not clear if Mayor Eric Adams will sign the bill. He's long defended the tour helicopter industry. Michael Wallace, CBS News.
Scientists say they've pinpointed exactly when a rough and tumble lifestyle catches up with you. A Finnish study finds smoking, heavy drinking, lack of exercise taking a noticeable toll on the body as early as age 36, with increased risks of health issues and depression. This is CBS News. Some of those ads you see about visiting Florida could disappear soon.
A Florida House bill would eliminate 62 county tourist development councils, redirecting that money to property tax relief for residents instead. Tourism drives much of the Florida economy, and industry officials say cutting their marketing budgets could mean fewer visitors and job losses. Kimberly Morgan is with Putnam County's Chamber of Commerce.
2 million people are in jeopardy of losing their jobs if this funding goes away.
Morgan says it will especially hurt small counties like hers, which struggle to bring in tourist traffic outside of a couple of major events. Tourists do generate plenty of revenue, state economists say. More than 15% of the state's sales tax take. Peter King, CBS News, Orlando.
His design became an international symbol of summer. Robert Douglas, who founded the Black Dog Tavern on Martha's Vineyards, died at the age of 93. Tavern's logo is printed on T-shirts, everything, everywhere. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live. Alex Steele and Paul Sweeney. We were with you. Alex is back. How was it in Oklahoma?
Really, really awesome. It's so fun to be on the ground reporting and get a good vibe as to what's happening out there.
Energy people feeling pretty good?
Funnily enough, even though oil's right at 62, the pivot really is now to deregulation and getting permitting fixed. And that's now, I think, the focus. Although, let's be honest, no one likes 62, but they may not say it as loudly.
Yep. All right. So we'll talk a lot of energy, I think, over the next couple of days, because Alex has got a lot of great stuff for us. Market Drivers today is brought to you by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.6% in April 2025? At IBKR Forecast Trader, the yes was recently at 26%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is May 12th. We got some economic data today. The University of Michigan sentiment data came out better than expected. Just looking at the headline number, 52.2 versus 50.5 was the consensus. Inflation, one-year inflation, which ticked up significantly last period, came in a little bit better than expected, 6.5% versus the expectation of 6.8%. So let's break all this down with Joanne Shu, Surveys of Consumers Director at the University of Michigan. Joanne, talk to us about this data here we got this morning.
Well, things came in a little bit better than what we might have expected based on what we saw 2 weeks ago. It's still a pretty negative read altogether. Consumers are not feeling confident at all about labor markets, about business conditions, or their personal finances. And that's something that definitely does not bode well for their spending going forward.
Why, though? Like, what are the biggest reasons for that? And even though it's still a not great reading, it's still a little bit better. So what accounts for that?
The number one thing on people's minds when it comes to the economy is tariffs. So consumers did see a little bit of relief after April 9th when a lot of the reciprocal tariff announcements were paused temporarily. And we saw inflation expectations come down just a touch after that happened. But overall, consumers are still expecting inflation to come surging back. They're expecting business conditions to weaken. And most critically, they have downgraded their own income growth. Again, this is in large part because of the volatility in tariff policy. Consumers seem pretty convinced they're going to be high, but on top of that, they see policy going left and right, and they're not really, and they're aware that businesses will struggle to plan, and so will consumers.
Do we have any sense as to spending at the consumer level, Joanne?
Consumers are telling us that they're really bracing for a downturn in the economy, and buying conditions for big ticket items are really poor. It's sort of a combination, though, of people who believe that if you were to buy something literally right now, you might be able to avoid the price hike that comes from tariffs, along with people who realize that it takes more than one day to make these big ticket purchases, and they're really concerned it's too late.
On the flip side, before I let you go, the inflation expectation numbers, though, came down. I appreciate they're still elevated, but at least with the 5 to 10 year, that stayed steady. How sticky do you think that inflation worry is?
I think as long as tariff policy remains unresolved, things will still be hairy with inflation expectations. Consumers are attuned and are highly aware of the major developments in tariff policy. They're not necessarily watching day by day, but the April 2nd announcement, the April 9th announcement, those were things that we clearly saw people reacting to in the data.
All right, Joanne, thanks so much. We really appreciate the instant breakdown, that instant analysis on the data. Joanne Shu joining us, University of Michigan Surveys of Consumers Director. All right, taking a look at where we are in the markets, want to get a reset here and update you on where we're trading. It's been a bit mixed on the day. Lisa Mateo is here with the Bloomberg Business Flash.
Yeah, it has been mixed. And we have this Bloomberg Business Flash brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. So yeah, it was a pretty solid week on Wall Street, ending kind of a softer tone. A big part of it, conflicting signals on trade talks, mixed tech earnings. Well, that didn't help either. Talking about Alphabet and Intel. So we'll start there. Alphabet shares, right now they're up about 3%. Google parent reported a beat on first quarter revenue and profit. That was thanks to strength in its search advertising business. Sources also saying Alphabet's profit boosted by $8 billion from an investment in Elon Musk's SpaceX. We go to Intel, the flip side, shares down 8%, weaker than expected outlook. Its new CEO said job cuts are on the way, and those who stay, well, they're going to be forced to come back to the office. We go to the NASDAQ, up 0.5%, 87 points. The S&P 500 up 0.1%, 10 points. The Dow down 0.2%, 114 points. The 2-year yield 3.81%, little change than the yield on the 10-year 4.29%. That's down 2 basis points. We have the Bloomberg Dollar Spot Index up about 0.2%. One final stock to watch, that would be T-Mobile. Its shares down 9%, reported fewer new mobile phone subscribers than expected. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, very nice. We appreciate that, Lisa Mateo. We have Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. You can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. As Lisa was just reporting, kind of got red and green on the screen. No real direction. But let's take a look at some stocks on the move. Today, we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at here this morning?
Well, I'm also looking at Alphabet, Paul. I mean, Lisa mentioned shares in the green there, but very interestingly, you know, that sales and profit beat expectations that we got from the results yesterday, that was really driven by advertising, which isn't the most exciting part of their business, shall we say, right? And even the cloud business operating profit, more than $2 billion, that beat estimates too, but it wasn't exactly the headline driver. And so, you know, my colleague Sebastian Boyd over at Markets Live pointing out that what we really want to know is whether the trade war is driving up costs in the chip supply chain, right? As it relates to Google's affected businesses or Alphabet's affected businesses, and to what extent those capacity constraints in the data centers are limiting expansion. We didn't really get a lot of steer from Alphabet on that.
Yeah, interesting, because Alphabet doesn't, I'm like, Alphabet, what's that company? Google doesn't really give outlook either, so it was hard to sort of understand what the future may be for that company, but not to sidestep the ad revenue. I mean, YouTube had $8.92 billion in revenue. That missed slightly, but that's a monster. And now they have a podcasting that's apparently outpacing both Spotify and Apple when it comes to people that are listening. Like, this is a monster beast on that.
At some point, I mean, if I were back in my banking days, I'd be there every quarter pitching spin-out.
Spin-off, yeah.
Yep, let's get some value there. I'm looking at BNP Paribas Exane. The note just hit my inbox. The analyst there maintained an outperformance on Google, raised the target price from $213 from $208 on higher EPS estimates. It looks like the street likes it as well. What else, Christine?
Looking at Apple today, Paul, you know, we did get a little bit of opening weakness there, but it's up now just 0.2% at the moment. And that is because we did get news earlier that Apple is seeking to import most of its iPhones that it sells in the U.S. from India, which really accelerates its shift beyond China. And they're aiming to do that by the end of next year, according to sources telling Bloomberg.
What's so interesting is that, go ahead.
I just didn't think that was possible.
Yeah.
So that's positive, surprising news to me, because I didn't think they could shift that much production from China to India.
I also wonder, though, if they're going to hit the Nike problem, which is Nike did that. And then all of a sudden there are tariffs on the places where they went to go build new factories. And there will be tariffs on India as well. So they're still not building it in the U.S. at the end of the day, Christine.
Yeah, absolutely. So they are still absolutely going to be exposed to all those trade tensions that are brewing at the moment. But, you know, it does seem like perhaps maybe Apple is banking on better relations between the U.S. and India as opposed to the U.S. and China. Though, you know, Paul, to your point, that shift actually began years ago because during the COVID lockdowns, obviously, Apple production of iPhones really was hampered by what was going on in China. And so they probably took a look at their supply chain and think maybe we should start diversifying. So what we're seeing now is just an acceleration of that.
Yeah, interesting. All right, let's wrap it up here with Skechers. That stock is down almost 3%. What happened?
Yeah, well, speaking of companies that are very exposed to trade tensions, it is definitely very much related to what we're seeing at the moment. Skechers, again, say that it missed its estimates for the first quarter in terms of sales, also withdrawing its full-year outlook, citing, quote, macroeconomic uncertainty stemming from global trade policies. So, you know, note that Skechers does make a significant portion of its shoes in China and Vietnam. So again, our supply chain problem very much rearing its head here. And Skechers Chief Financial Officer John Vandermoor also compared what we're seeing now in terms of the company's challenges to what they experienced during the COVID era in 2020.
Great. just what you need. I'm not a Skechers person per se.
Yes, of course.
I'm more of a Nike person, but that I don't care where you're getting any of your clothing. That's coming from that part of the world.
Yeah.
For the most part.
I don't wear sneakers, so that's probably...
What?
It's a whole foot thing. I can't wear flat shoes. That's why I have on my 5-inch platforms.
Yeah, we need to
Can you sort that out? This is important.
Show the 5-inch platforms somehow on our YouTube feed at some point.
It's definitely a thing. All right, Christine, thanks a lot. Really appreciate Christina Aquino joining us. She heads up MLive, our team over here at Bloomberg. So speaking of Apple and diversifying supply chains, here's something really interesting, Paul, and we're going to play some of this sound later, but Harold Hamm, obviously legendary oil investor, founder of Continental Resources, was talking to him yesterday in Oklahoma City, and he said that they had to look at their supply chains, and a lot of the parts were now being made overseas. When they originally booked the contracts, they were made in the U.S.
Really?
So he decided, because he can, it's a private company now, he decided that he was going to buy only American, and I said, would you pay a premium for that? He said, yes. I said, really? Would you wait, would you have a delay? Like if you couldn't get it for X amount of time because you had to wait for it to get made? He's like, yes. Because it's the right thing to do. We'll see what in practice that looks like. And again, if you're a private company, you have a lot more flexibility with which to do that. But I felt it was interesting. It was also interesting that the supply chain shifted without them knowing that happened. So anyway.
And if you're a public company, I mean, can you take that in your profit margin? A lot of folks will say, yeah, that's a tough pill to swallow here, you know, to the extent you want to bring some of that manufacturer back. But we'll see, and I'm sure that'll be industry by industry, company by company, public versus private. They'll figure out what's best for their business. And as Tom Keene likes to say, companies will adapt.
companies will adapt, but it is a margin story.
Yes.
Gina Martin Adams had a great piece out looking at margins for the S&P and how that margin growth's really been in tech. Take that away, margin growth for the S&P, not that great.
Yep.
So you can imagine what happens after that. Anyway, much more coming up. We're going to talk more about the companies on the move today. Plus, we'll hit trade again. Sean Donnan, Bloomberg News senior economics writer, will be joining us on the latest news. China may exempt some U.S. goods from tariffs as costs rise. Is that the first inch to a salvo at the end of the day? This is Bloomberg. Happy Friday.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Looks like the stock rally stalling a bit with mixed tariff signals between the world's two largest economies. We'll start with the NASDAQ up 0.2%, 40 points. The S&P 500 down 0.1%, 8 points. And the Dow off about 0.6%, 265 points. The two-year yield 3.78%. That's down 1 basis point. The yield on the 10-year 4.27%, and that's down 3 basis points. We go to commodities. We have COMEX gold down more than 1.5%, $3,200 $94 an ounce. We go to oil, Brent crude down about 0.4%, $66 a barrel. WTI crude at $62 a barrel. Over to currencies, the Bloomberg Dollar Spot Index up about 0.2%, and we have Bitcoin up nearly 1.5% at just above 95,000. Shares of Skechers this morning, they're down nearly 4%. The reason why? It withdrew its full-year outlook due to global trade policies. Skechers actually makes a big portion of its shoes in China and Vietnam. We go to Colgate-Palmolive, down about 0.6%, cut its growth outlook, growth and profit outlooks. Tariffs expected to add $200 million in cost this year. And finally, AbbVie, up about 0.5%. It raised its profit outlook for the year. Better than expected sales from newer autoimmune treatments. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. Man, these allergies are killing me. That's why I sound like I'm freaking out here. All right. The latest news from China is that China's government reportedly considering suspending its 125% tariff on some U.S. imports like medical equipment and industrial chemicals like ethane. So is this the first step towards actually coming up with some kind of deal? Sean Donnan is Bloomberg News senior economics writer, joins us now. Sean, is it?
I think what we're seeing here is some of the same things that we've seen from the Trump administration so far, and that is giving exceptions to the tariffs on imports for kind of key things that the economy needs, right? These are key inputs that Chinese people or Chinese companies rely on from overseas. I see this not so much as as an accommodation aimed at Trump or at the U.S. tariffs or at setting the stage for negotiations, more at kind of shoring up the domestic constituencies and kind of getting ready potentially for a more protracted trade war.
Sean, is this the type of news cycle we should get accustomed to, which is country by country by country, bilateral, back and forth, press conferences, tweets about what we might do, what we may not do? Is that how we're going to go? Or is there going to be something more, I don't know, unified, pronounced?
Look, I think for now we are really, in this kind of land of trying to figure out what's coming down the pike, right? And that is in terms of the impact of tariffs, and you see that in kind of corporate earnings, people talking about a future impact, right? As opposed to what has happened in quarters past. It's all about the outlook ahead. And I think the same applies to the economy now. We'll get next week the first take on U.S. GDP numbers. That'll give us some indication of what happened in the first quarter. But that really takes us, through the end of March, and that's before these worst tariffs or the higher tariffs that President Trump unveiled on April 2nd come into play, right? And we're only going to see those effects filtering through the economy in the months to come. So in the meantime, we get lots of kind of dueling narratives, if you will, on what's coming up and whether we're getting closer to a deal or not.
Here's a really basic question for you. Are China and U.S. administrators actually talking to each other about trade?
Well, look, I mean, that's the huge question, and we don't know the answer to that, right? Because it depends on which side you believe. The U.S. says they're talking, the Chinese say they're not. And meanwhile, we have these tariffs that remain in place with a few exceptions. We've also, heard from the president again this morning that, maybe a deal with Japan is close. We've heard more cautious noises out of the Japanese side. We had heard that perhaps a deal with India was close this week. Well, what we got instead was an announcement of a kind of framework for talks, right, for negotiations. I thought the most instructive comment of the week came from Scott Bessent, the Treasury Secretary at this closed-door J.P. Morgan meeting on Monday, which really caused the markets to pop when he started talking about the need for a de-escalation. But the other thing he said there was that it's going to be a long slog, and that's the word that he used, to a deal. It could take 2 to 3 years to reach a deal between the U.S. and China.
All right, Sean, let's say I'm China or Japan or France or whomever, and I want to strike a deal. Who do I call? Do I call Howard Lutnick, Secretary of Commerce? Do I call Mr. Bessent? Do I call the president? Who do I call?
Look, I think at this point you try to call everyone, but maybe the answer is you don't call anyone because you just wait. And I think we've seen this week really how the markets are affecting the decision making in Washington and inside the Trump administration, and how the U.S. in some ways may be negotiating with itself before it really sits down and negotiates with the rest of the world.
All right, thanks so much, Sean. We really appreciate it. Sean Donnan, he covers trade and economics right here on Bloomberg Television. So let's get the market angle here. Stocks are turning a little bit negative, but honestly, it feels very calm in comparison to recent days. The S&P is down just 0.4%. The NASDAQ pretty much flat. We're looking for the S&P for the best second week of the year.
Okay.
Despite the fact that nothing has actually really materially changed. So what do? Marvin Lowe is joining us now. He is Senior Global Macro Strategist at State Street. All right, Marvin, what's it going to take for investors to buy and hold at this point?
You know what? I think we need clarity. And unfortunately, we're in a situation where we're unlikely to get clarity. And, any tweak can upset the apple cart again, if you will. What we're seeing is that kind of this real money, the smart money, part of the world in the investment community is taking this opportunity to continue to reallocate across some of the broader themes that have come into the market. And, an overall kind of trend is to get neutral. Certainly live to fight another day, but not necessarily turn overly aggressive on the market. But it's hard to be really optimistic given the fact that we still are in this very large information vacuum.
Marvin, we saw a lot of reporting in this first quarter of 2025 about capital leaving the U.S., going to international markets, selling maybe U.S. dollars, selling maybe U.S. treasuries, going to international markets. Did you see that? Because, you're at State Street. You see everything. And is that a trade? Is that a longer-term investment theory?
We did see rebalancing. Certainly, dollar assets and the exposure to the U.S. got to extremes, no matter how you measure it. So there's a certain unwinding, a certain more reallocation to kind of get closer to longer-term benchmarks. One of the interesting things that we observed is that it was the fixed income asset class, treasuries in particular, if we're kind of worried about some of the price action, that saw a little bit more of that reallocation going back to these home markets where the debt markets themselves are looking at increasing their exposure and the amount of debt that might be coming out of those markets. So there are alternatives across a lot of these asset classes. And I think that during this period where we're really thinking about where we want to put our eggs in what basket, we take the approach of which assets are actually going to outperform from a U.S. exceptionalism perspective the way they had in the past.
Cool. I thought the whole U.S. exceptionalism theme had a big question mark next to it.
Yeah, certainly broadly saying that every asset in the U.S. is going to outperform everything else has been rocked to a certain degree, but you've still got some of the best companies, doing the best technology that will provide really the earnings growth and stability that you want as a more long-term investor.
So is that just a big tech play, though?
You know what? It's an easier play for sure. Valuations are always at the forefront of that discussion. But if you're really looking at stable cash flows and moats that can be defended, tech does fit that world in a very, very nice manner.
Marvin, how much, we're kind of getting into the thick of earnings season right now here. Yeah. What's your view on kind of S&P earnings? They're still, I'm looking at the street, still kind of has kind of 8% growth. Yeah, that's down from 13 or 14%. But a lot of folks are saying there's scenarios where there's no growth in earnings, maybe even decline in earnings this year. How do you think about earnings for this marketplace?
Yeah, I mean, the markets, if you will, approach to overlooking what's being reported in the first quarter is correct. It's all about guidance. It's all about where we wind up and kind of the lack of clarity that a lot of these CFOs and corporate CEOs are dealing with. I do think that any story in terms of where the second half might be is one where you have to make an assumption that is fragile at best. And I think that ultimately is the challenge. First quarter so far, is fine, but we really hadn't seen the bulk of a lot of this tariff tension, a lot of these tariff discussions make their way into those numbers yet. So looking at the second half of the year, which companies are more reliant on international trade and which companies have better moats that they could ultimately defend?
So to that point, How do you know if a company's earnings this quarter are good? I know that might seem like a super basic question, but they can beat all they want, right? But how do we know if that's going to be good enough going forward?
Yeah, I mean, you know, this is the blocking and tackling that you do when you do securities analysis. You're certainly looking at where those revenues are coming from. You're looking at where your cost of goods are, for the most part, being sourced from, and you can make a variety of assumptions around that. That's not necessarily my life now. It was in the past, but that's what good equity analysts and good analysts on any security wind up doing.
You're a senior global macro strategist for State Street up there in Boston. What's your best idea right these days?
You know what? I do continue to have concerns with the treasury market. So from an asset allocation perspective, really looking at the amount of duration that you have in your portfolio and the correlations associated with the hedges that you get from fixed income really came to a forefront when treasury yields were going higher while all of the risk assets were going lower. And that's just a relationship that doesn't, or it really shouldn't exist in that market. So this is the time to really think through that. So I do like the middle of the curve. You know, the Fed can certainly become more aggressive, but longer term, you really have to wonder where you're going to put that duration.
How quickly, I mean, talking about duration, how quickly do you think the curve can continue to steepen then?
Yeah, you know what? Once we get these tariff discussions again, and I think that's something that we're not talking about, even though it's probably occupying a massive amount of time in Washington, is the deficit and the budget itself. So those budget discussions, as they come to the forefront in the next couple of months, is, in my mind, the catalyst to getting a steepening again. Once we realize, hey, there's a lot of debt that still needs to get purchased at a time when we're wondering who's going to buy that debt.
Yeah, absolutely. We thought that was a never-ending open source of funding at that point, and now we don't know, I guess, is really the question. Yeah. Marvin, thank you so very much. Marvin Lowe, Senior Global Macro Strategist, joining us from State Street. All right, what do we have coming up? So we have a lot of earnings coming out. We'll talk to Dan Ives, Global Head of Technology Research at Wedbush Securities. We're going to recap some of the tech earnings, talk about Alphabet, what happened to Intel. I mean, obviously, it's a pretty bleak outlook, but are they doing enough to kind of help offset that at the end of the day? We'll break that down as well. And of course, he was one that called Tesla code red before earnings. So we'll see if he's reversed that. Now, this is Bloomberg Intelligence. Happy Friday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got the Dow leading the losses on Wall Street right now. The Dow down about 0.6%, 274 points. The S&P 500 down 0.1%, 8 points. We have the Nasdaq up 0.2%, 37 points. The two-year yield 3.78%. That's up down 1 basis point. The yield on the 10-year 4.27%. That's down 4 basis points. To commodities, we have COMEX gold down more than 1.5%, $3,291 an ounce. We go to oil, Brent crude down 0.6%, $66 a barrel. We have WTI crude $62 a barrel. We have the Bloomberg Dollar Spot Index up about 0.1%. A few companies making news this morning. Sources saying Apple plans to move beyond China, import most of the iPhones it sells in the U.S. from India by the end of next year. And Walmart, they unveiled a program to help Chinese exporters sell their goods at home. The AI race is heating up. Baidu upgraded its flagship AI models, slashed their prices. It's taken on rivals like Alibaba and DeepSeek. And finally, sources saying Meta laying off more than 100 workers in its Reality Labs division. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. I forgot about that Reality Labs headline. That's quite interesting. All right, this is Bloomberg Intelligence Radio. We broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. And staying on big tech, take a look at Google. That stock is up by about 2.5% off the highs of the overall trading session if we count pre-market trading. But the net here is that first quarter results beat expectations. You had continued strength in that search advertising business, plus YouTube also continued to crush it, despite estimates a teeny tiny bit light there. Dan Ives, Global Head of Technology Research at Wedbush Securities, joins us now. Dan, broad stroke, rate the quarter for Alphabet.
I'd rate it an A-. I mean, especially in terms of CapEx, what you saw in terms of cloud spend, I think advertising, relative to the uncertainty, I mean, this was, I think, a robust quarter across the board. There's still obviously antitrust and concerns and obviously tariff uncertainty, but I think it's actually a good sort of sign going into the rest of big tech next week.
Dan, how do you think about the threat to Google's core search business from AI?
No, look, there's definitely a threat, and ironically, that threat actually is actually a support for almost an anti-monopoly, right, in terms of some of the antitrust. But to me, it's a threat, but look at the advertising. I mean, the reality is, like, I'm not saying it's not a long-term headwind, but they're also going to benefit when it comes to AI significantly on the cloud. And Google, as we've seen again and again, they're going to be able to pivot. And that's, I just don't view it as a massive threat like maybe some others would view it.
Well, let's go to the cloud then. So it's AWS, Microsoft, and then Google. How quickly is Google catching up?
They're narrowing the gap. I mean, look, Microsoft, it's their backyard, right, when it comes to core enterprise, core cloud. So Microsoft continues to have just an ironclad grip. You've seen success from AWS, but look, Google, what Kurian's done there, it's been a massive success story in terms of as it's played out. And I think that's important because that, to me, is going to be a big part. When you think of some of the parts, I mean, that's how you get an increment. We have $200 price target, like $30, $40 upside. I think more and more as the cloud story plays out.
Hey, Dan, we saw that President Trump, he's kind of made some comments towards some of the European regulators about maybe stepping back some of the regulation of artificial intelligence, AI. How important is that?
Well, Paul, I mean, and we've talked about it before, right? I think it's all part of this broader negotiation because big tech has had a bullseye on their back from Brussels and EU for years, right? I mean, fines for big tech are almost like getting a cup of coffee when it comes to what's happened in Europe. When it comes to AI, look, this is a hard line stance. And I think it's actually all part of even the broader tariff negotiations in terms of them softening the stance. And that's something big tech has obviously been a huge advocate for because Europe's like almost off touch. Like you can't even go into that market right now.
Fair enough. Before we go to next week and what we're going to expect, let's just kiss on Tesla here. So your note earlier in the week before earnings, the code red note caused a flurry in selling in the stock. Do you still feel like it's a code red after earnings, or have you changed your color?
No, I mean, I think it was a code red because Musk had to make the choice. Clock struck midnight. Doge or Tesla? He chose Tesla. And I believe, despite, I'll say 1-2 days a week, it's the beginning of the end for Musk at Doge, I think in the Trump White House, at such an important time for Tesla. In terms of autonomous, in terms of the lower cost vehicle, in terms of robotics, Tesla needs its leader back. And that's why I think it's going to be viewed historically as probably the most important conference call Musk has ever had.
Talk to us about Apple. We're going to hear from them in just a few days here, Dan.
That's going to be so fun.
That is. What's the call on Apple? What are you going to be looking for? What's the street looking for?
Look, I think the quarter itself almost takes a back seat because, that's everyone's focused on just given the uncertainty, like how is Apple going to navigate this? And to some extent, like I'd be surprised if they actually gave guidance, or maybe they'd give guidance with a huge caveat, because the reality is, especially when it comes to like the 232 tariffs, in terms of that needing to come out, they're basically going through logistics nightmare in terms of chaos. The demand story, the longer term demand story, the reason to own Apple, that doesn't change. But in terms of I think many on the street, they're basically going to toss out the June quarter. I mean, the focus is basically June's the mulligan.
Yeah.
And now you look to see what happens ultimately come out of the White House from a negotiation perspective.
So 2 questions on that. One, will we hear about shifting supply chains quickly? There was an article out today about getting a lot of sourcing from India. And 2, do we get any insight potentially into how much a new iPhone with tariffs will cost?
No, they're going to keep that very, very close. And they're not going to discuss, because the reality right now, they got to be careful, right? Because they are in the eye of the storm, just like Jensen and NVIDIA. And that's why they're ultimately beholden to what happens in negotiations. But it's why it's so important. And we've talked about, despite all the articles, and the reality is it would take them years to even move 10% of the supply chain. So that's the reality that Cook and Apple are seeing. But that's why this call is going to be important to kind of lay out the scenarios, at least how they're going through it.
In your broader world of technology, Dan, are there any areas that are safer havens to be at given all this global uncertainty?
Yeah, I mean, we talked about it, in note, yes, like I think like the safety blanket area is software. And that's right, the hyperscalers, I think you saw from Google, I think that I say the same thing from Microsoft. You look at names like Oracle, I think IBM, despite that sell-off, is a safe haven. And then names like Palantir, like AI-driven names, that's some of the high priority. And I tell you, probably for the first time in 3 weeks, some positive smart checks just showing like rock solid CapEx not moving. No one wants to lose their place in line.
Okay, but to the solid CapEx, is it shifting within that? So you don't want to lose your place in line, I get that. But at the margin, are we seeing any money flow from, say, enterprise to AI, or out of AI into enterprise, or some shifting on the margin there?
Yeah, I think you are. I mean, I think from a priority perspective, like within IT departments, there's so much kind of freezing uncertainty. If you're AI, you're with the cool kids. If you're not, it's tough to get things approved. So I think if you're on an AI-focused project, that's a lot of the stuff that's getting greenlit, despite so much uncertainty.
Dan, thank you so much. Appreciate that. As always, Dan Ives. Oh, real quick, Dan. Good first round for your Penn State football players.
I'm wearing Abdul Carter. I think it's going to change the Giants along with Dart. You got 2 Penn Staters, right? Top 15. A huge day for Giants and Penn Staters.
Yep, absolutely. So we appreciate that, Dan. Huge Penn State fan, a Penn State grad there. So I want to give the heads up again, 2 Penn State football players taken in the first round of the draft. One to my New York Giants, so that's a good thing. Dan Ives, Global Head of Technology Research, Wedbush Securities. Let's be honest, he peaked at Penn State, but he's kind of doing the best he can.
He's doing all right. He's doing okay.
He's doing okay. S&P 500 absolutely unched on the day. I'll use that for Lisa Brahma. She hates that term. The Dow's down 200 points. The Nasdaq's up 55 points. So not a lot of direction out there. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody, to a long week. I don't know. It felt like this was 17 weeks all rolled into one. I'm Alex Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. So the last 2 days, I got the pleasure of going to Oklahoma City. I love going to Oklahoma City, first of all, because the airport's like 15 minutes from the actual city. Nice. And also because you get a real read on a lot of industry folks. I attended the Powering AI Global Leadership Summit at the Ham Institute for American Energy at Oklahoma State University. There were leaders from government and from industry and tech all gathered together to talk through how we actually power the AI revolution, what needs to be done, very actionable. On the sidelines of that conference, I spoke with the Energy Secretary, Chris Wright. We discussed everything from oil to taxes to tariffs and coal. But this time I started off talking to him about the administration's recommitment to coal and what that actually looks like. I wanted to start with coal this time. So I was on the panel and I was asking AI hyperscalers, would they use coal? People were reticent to commit. And I'm wondering what your take is on that, because the administration seems very committed to revitalizing coal.
Coal has politically fallen out of favor. And again, to me, it's part of too much politics and energy. Coal has been the largest source of global electricity for 100 years, and it will be for decades more. That's just reality. In the United States, coal has been outcompeted by natural gas, and it went from over 50% of electricity. Today, it's in the teens. But that's market forces and competition. Coal is still critical to the American electricity grid. If you shut down all the coal plants today, electricity prices would skyrocket, our grid would destabilize. With modern technology, with scrubbers and pollution control devices, coal is a great source of electricity, and you store it on location. Security and energy requires diversity.
So do you think that coal in the teens right now, that could grow in terms of the energy mix in the U.S., or is it not going to go away?
It's probably not going to grow market share because the economics aren't there to build new coal plants. But the critical thing is to stop closing our existing coal plants. You said the hyperscalers, they weren't sure they wanted to power their things with coal. Everything they do today is powered by coal.
What about
coal's a sixth of our electricity grid. Every time you turn on your lights, you run your server, they run their businesses. They're powered by coal today.
But the new stuff will come from different things, like maybe nuclear or gas or wind and solar rather than coal.
The demand for the whole grid is, I think that's what the marketplace is telling us today. The fastest growing source of electricity in the United States by far has been natural gas. Natural gas was not a meaningful part of the electricity sector before. It's well over 40% of U.S. electricity today and growing. Natural gas probably hits 50% of U.S. electricity in the next bunch of years. But that's not politics. That's just math. That's just economics.
We're here at the Harold Hamm Institute to really get a sense of energy independence plus AI and how the power we have here can really power the evolution of AI. Do tariffs and uncertainty that we see on the macro sense mess that up?
I think what you're seeing, the uncertainty around tariffs, that's a short-term issue. President Trump's got two agendas. One is we've been very welcoming to imports. He wants to get all the other countries to be very welcoming to exports from the United States and imports to their country. So he's pushing to try to get trade more in balance. It had just gotten so far out of balance, and he wants to reindustrialize our country, bring these energy-intensive industries that left the United States and went overseas. He wants to bring those back. And with AI, of course, we don't want to lose it in the first place. We want to keep it here. AI is just like steel or petrochemicals. It's just a very energy-intensive manufacturing industry, and most of that we shipped abroad over the last 25 years. President Trump is keen to bring back those industries. Tariffs will help with that, and fairer trade policies will help with that, and he wants to make sure AI stays here.
So you feel confident when talking to CEOs that they will continue their AI dominant search here versus elsewhere, despite the uncertainty?
The uncertainty is because we're in the middle of a negotiation. The uncertainty isn't going to last forever. That's a few more weeks.
Can I hold you to that, and then we get calm?
I think so. It won't be that long. It won't be that long.
The other part is parts of the IRA. Energy companies still want to hold on to because that does give them certainty, like the 45Q tax credit, for example, right? Can you tell CEOs today that carbon capture credits, tax credits will stay?
Oh, that's not up to me. That's up to the United States Congress. So you got to talk to the senators and congressmen.
But is the administration moving that to try and get it out or no?
I can only speak for myself in this. There's all different views, which is what's great about the Trump administration. Everybody's got a different position. We discuss them and we debate them and we make decisions. Myself, I think bringing politics and the hand of government into energy in general is a bad idea.
That was Energy Secretary Chris Wright speaking to me on the sidelines of the Empowering AI Global Leadership Summit at the Hamm Institute for American Energy at Oklahoma State University. We talked for a lot longer, and it was a really interesting conversation. I pushed him harder on those tax credits. So they're carbon capture credits. If you store it in the ground, you get a certain kind of credit. If you reuse it for oil production, you get a certain kind of credit. And Vicki Hollop, who's the CEO of Oxy, is like, we need that. That needs to stay. And he didn't like it. He was like, I don't like anything that's going to get tax credits, that's going to pick one technology or one form of energy over another. But he went on to also talk, the line was really, the uncertainty in the market was a negotiation tactic, and that it will be resolved within weeks. He also couched it with saying, well, maybe months, but like he really stand firm with weeks. So we will see if we do get that kind of calm and clarity.
Yeah, so but by and large, the energy industry still feels that Donald Trump and his administration would be positive for the U.S. energy industry?
Yes, the conversation is pivoting very quickly to deregulation.
Oh, okay.
And to using a lot of their product, and I mean product like energy product in general, not just like say ethane or something, but general product. acknowledging that they don't like $62 oil. It's not great,
right?
But admitting that, you know what, we could see mid-70s and that'll be fine. And we'll hear from that later on in the show in the next hour from Harold Hamm. He's the founder of Continental Resources, one of the biggest voices in the energy industry. Also close relationship with President Trump. We will run that for you. Happy Friday. We made it. Equity is pre-mixed. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. This is Bloomberg Intelligence Radio. I'm Alex Steele alongside Paul Sweeney. We bring you all the top news in business, economics, and finance, and we will do that over the next hour. Craig Trudell, I can talk today, Bloomberg Global Autos editor, will be joining us to recap BYD earnings. Huge EV player over in China. All right, Anurag Rana, Bloomberg Intelligence senior technology analyst, is joining us on Apple, maybe building some iPhones over in India. Plus, it's Friday. It's Munis. Woo! Munis in focus. Aaron Hudson will be joining us on the municipal bond market, and Michael McKee will be joining us from D.C. on the IMF meeting latest. And we'll wrap it up with Clark Gerneran, chief market strategist at CalBay Investments. And I promised you Harold Hamm will also be playing some of my conversation with him on the sidelines of a summit that I attended yesterday. But let's get you all set up here with the Bloomberg Business Flash. And for that, we go to Charlie Pellet.
All right, thank you very much. And here's what's going on this Friday. We have got the Dow, the S&P. They are both lower. NASDAQ, though, holding on to a gain. Let's begin there, up 35 points right now, up by about 0.2%. Keeping it in context, we have got the S&P 500 index down by about 0.1%, while the Dow is down 233, drop there of 0.6%. We are on track for a winning week for the S&P 500 index. Stocks churning after one of the worst ever consumer sentiment readings. That's adding to anxiety about the repercussions of President Trump's trade war. The 10-year, 4.28%, with the 2-year right now, 3.78%. Spot gold down $71 the ounce, down 2.1%. Spot gold, $32.77 the ounce. Crude oil, topic we were just talking about, WTI now at down 0.6%, 62.41 a barrel. And Bitcoin up 2.2%, 95,550 right now on Bitcoin. Consumer sentiment fell to one of the lowest readings on record. Long-term inflation expectations climbed to the highest since 1991 on fears of the economic fallout from tariffs. Joanne Shu is director of surveys at the University of Michigan. She was interviewed this morning right here on Bloomberg Intelligence.
While things came in a little bit better than what we might have expected based on what we saw 2 weeks ago, it's still a pretty negative read altogether. Consumers are not feeling confident at all about labor markets, about business conditions, or their personal finances, and that's something that definitely does not bode well for their spending going forward.
Joanne Shu of the University of Michigan, interviewed right here on Bloomberg Intelligence. Earnings, and we'll have a whole lot more coming up in just a moment with our Nora Melinda, but Alphabet shares higher after earnings, up now by 2%. Also reporting last night, Intel, that stock down now by about 6.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. And we are streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us, as Charlie was just reporting. We've got red and green out there on the street. Let's take a look at some of the stocks on the move today. For that, we're joined by Bloomberg's Norma Linda. Norma, what are you looking at?
Well, we do see the stock market that is really fluctuating back and forth. I've got a name in the green for you. Taking a look at Alphabet. Now, we see shares that are pairing their gains, but they earlier rose as much as 4%, and this is after it beat on estimates, and this is due to its Google search ad business. We are seeing Google Cloud. It brought in an operating profit of $2.18 billion. This beat estimates for Wall Street, and the company really remains heavily invested in AI. So this is some good news for the company, especially as we're we're thinking about a lot of these tech names, but in the broader scope, I am looking at shares of Alphabet that are down about 14% this year. But we do have Jefferies noting that this report came in better than feared.
Right. I feel like that's going to be a theme for some of these guys,
Better
right? We're
than feared.
expecting the worst and it's not as bad. And therefore, there you go. But speaking of, T-Mobile was a bit of a surprise because when Verizon disappointed, we were all like, ooh, maybe T-Mobile is stealing their customers, but maybe that's not true.
Exactly. I mean, that may not be the case. We are seeing T-Mobile being one of the worst performing, it is the worst performing stock right now in the S&P 500 by a percentage basis. Shares are down as much as 11% in trading. This is the worst intraday fall since the start of the pandemic. That was back in March 2020. Wow. So pretty brutal as we're looking at the pressure here that T-Mobile is seeing. But this is due to some rising competition. So their mobile phone subscribers fell short of expectations. And broker also are flagging that the customer turnover was higher than expected. Sure. And they're saying that this is likely as a result to T-Mobile's increased pricing. It's really interesting because I always wonder if people are, do they have a brand that they stick with? It doesn't matter if it's Verizon, you stick with Verizon, or when prices start going up, are you going to move?
Well, I'm a Verizon person. Haven't
Likewise.
moved since the beginning of the whole mobile thing back in the day.
Likewise.
Charlie Pellet sings the praises of T-Mobile.
I'm a T-Mus.
You're a T-Mus? Tom Keene is at AT&T. And have you changed?
I went from Verizon to T-Mus.
You did?
Okay. A few years ago. Hey, I got free Wi-Fi from T-Mus on American Airlines yesterday.
Okay.
And you guys have T-Mobile Tuesdays where you can get all these free food. Download the app. Huh? What? I might be coming your way.
Okay.
All right, so there we go. So everybody's got their brand there, but it's a competitive marketplace. AT&T did well with their subscribers. Verizon and T-Mobile not so well. So who knows? What else you got?
I mean, another name that's not doing well, I'm looking at Intel, down as much as 10% today. And of course, people are really looking at this company to see whether or not they can have this turnaround story that this new CEO is really putting out there and saying that he wants to do. He's saying that the company needs a cultural shakeup, plans to cut jobs, remove layers of management, and require employees to work in person 4 days a week. But I mean, this company is really one of the worst performing stocks as well in the S&P 500 this morning. It's saying that it plans to reduce operating costs to $17 billion this year and $16 billion next year. But this bleak outlook that they have given that's really making Wall Street a bit apprehensive.
All right, Nora, great stuff. Always appreciate having you here. Always appreciate the roundup that you give us. Norma Linda joining us from Bloomberg News equity reporter there. Okay, let's get more information here. Craig Trudell, Bloomberg Global Autos editor, is joining us to recap BYD earnings. First quarter profit soared here. What's really driving them, and how does that then compare to Tesla?
Yeah, I think the knock against BYD a month ago when they reported that they had passed Tesla in terms of annual revenue was, oh yeah, but this company doesn't out-earn Tesla. I think this is, of course, just one quarter, but we saw in the first quarter that the company handily also out-earned, Tesla. BYD, is a company that has, really been more so in the sort of value space where if you want to buy an electric vehicle in China and you want to buy a cheap one, you turn to BYD. Tesla has much more gone for, higher priced, consumers or consumers willing to pay higher prices for vehicles. But BYD, I think, is not only continuing to grow at this extremely impressive pace, but it's also moving up market. So we saw this also at the Shanghai Auto Show this week. The company has a line of vehicles that used to be part of a venture with Mercedes-Benz, where that brand had a new sports car to show. You have a really high-priced SUV that the company has released within the past year roughly. So this is a company that no longer the knock against them is just that they make cheap cars. They are a much more complete company at this point.
Yeah, I'm looking at the shares that trade in Hong Kong up 50%, 50% this year, up 95% over the trailing 12 months. So the market's certainly paying attention here. And, Craig, to me, as somebody who does not really follow the global auto business that closely, it just feels to me that BYD is going to take over the world in terms of electric vehicles and outside of the U.S. I mean, is there anything to stop these guys?
Tariffs.
I mean,
good point.
Yeah, you took the word right out of my mouth. I mean, I do think that there is a lot of concern, over here in Europe and in Brussels In Washington, of course, there's absolutely some walls being put up to try and slow this company's momentum, or at least insist that, if they're going to sell in these markets outside of China, build the vehicles they're going to sell in those markets. And the company, is doing that to some degree, but for the most part, it is, still predominantly based in China, selling in China. They are getting some momentum in certain places, outside of their home country, but until and unless they really are able to make more headway there, there is going to be at some point some ceiling for BYD of we can think about the Tesla effect, right? Where, once everyone on your block has the same car in the driveway, there tends to be a desire to want to sort of set yourself apart and look for something else.
How easy is it going to be to catch up to the cheapness of BYD's EVs?
I think, that's the key for me, is that, there has not been any sort of, sign or indication that international car makers or even, battery companies outside of China have an answer for BYD or, in the battery realm, CATL. You have just in the last few weeks, these companies, BYD and CATL, sort of, slugging it out over who can, bring a battery to market that charges in 5 minutes and just how much range they can get out of, just quick 5-minute charges. The rest of the industry, is nowhere near the capability that those two are bringing to the table. And, as long as that's the case, where the technology is so much better and importantly, the price is so much more competitive, it's going to be really difficult for the rest of the world to keep up with these companies.
Craig, what's the feeling in the industry these days about ultimate demand for electric vehicles? I just bought a new car, and I bought a, what was it called? It's kind of like a hybrid.
Was it a Hyundai?
Yeah, no, it was a Honda, but it was a hybrid.
It was a hybrid. It was a hybrid.
Yeah, it's a hybrid. Yeah. So that was pretty cool. So I'm getting there. But what's the overall call on demand out there for EVs these days, Craig?
I think a lot of consumers like you are opting for hybrids in the U.S. market. It's something that's more familiar, does get you in the direction of electrifying, saves you at the gas pump, but you're not concerned about being left in the lurch with a battery that is out of juice and desperately searching for a charging station where sometimes you may spend 30 minutes, an hour and a half either waiting for a charge or waiting for the charge to take place once you do find a plug available. And the infrastructure, I think there's been momentum. I think it's been overstated just how far along we still need to go. There's been I think real progress that should be acknowledged. But it's still not to where, the experience of going to a gas pump, being able to spend just a few minutes and being on your merry way.
All right, well, we really appreciate it, Craig. Thank you so much, Craig Trudell, joining us, Bloomberg Global Autos editor. All right, let's get to another stock on the move, and that's Apple. The reporting is that potentially it's going to move some iPhone manufacturing to India. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst, joins us now. How much stock should I put in this headline, Anurag?
I mean, it is a very big deal for them to double the production of Apple in India. This is mostly assembly, but frankly speaking, it's gone from nowhere to just about 20% by the end of this year. So I mean, last year it's just a big number, frankly, and it was surprising to us at this point.
I'll tell you what's surprising to me is you actually shaved. You found your razor, and he shaved off his beard. So I am all in favor of that.
Yeah, I was like, who's that guy?
Yeah. So. Anurag, so in reality, though, how do you and how does the street think about Apple's ability to, reduce to some degree its kind of reliance on China as a end market, as a source in its supply chain? How does the street get comfortable with that?
See, on the other hand, I do want them to stay in China because that is their biggest growth market. That's the market where they have the most, phones out there right now. I don't think people understand that they have more iPhones as an install base in China than they have anywhere else in the world. Really? And yet their market share in that area is only 20%. So for me, that's a very important end market. Decoupling is not going to help Apple's growth story.
But does it help? Okay, it doesn't help its growth story, but does it help it manage tariff and margin pressures over the next, say, few decades, though?
Yes, it does. But at the same time, Apple is a company where it has navigated the Chinese politics very well, probably better than anybody else out there. Now, if they decide to say, okay, we're going to take a lot of this capacity and move it outside, I do not know what kind of backlash there's going to be by the Chinese government or the Chinese consumer. Right. Now, we'll find out what that happens. But for me, it's an important piece of the growth story. Roughly 17 to 20% of their revenue comes from China. And as I said, it's a massively underpenetrated market for them. The US market, fairly saturated, frankly.
All right. So, Anurag, in a world that is kind of reeling from trade uncertainty, global trade uncertainty emanating from all the tariff talk, is there a place in technology to hide?
That's a very good question. When you look at the direct impact, Apple is the one with the highest direct impact. There are other companies that really have no major exposure to China. I'm going to bring up Microsoft as one of those names. And this is where I think they will show, I think, the street over the next 1 to 2 years that their growth rate will continue irrespective of what's happening to the macro because of all the investments that they are putting in Gen AI. I think that story is still not fully understood by the street just because all the investments they are making, people are only considering CapEx. But I think they're going to go ahead and take more market share in cloud just because of all these investments.
Before we let you go, we got Google this week. We got Texas Instruments. Next week, we do get Apple. What themes are emerging for you in some of these tech earnings?
I think the capital expenditure and what's going to happen in that is going to be one important thing. The second thing is, I think at least for now, things are not as bad as we expected them to be. When you look at results from SAP, ServiceNow, things are not that bad. But having said that, I think we have not seen the biggest brunt of the slowdown coming in. There probably more is a second half story. When Microsoft reports, the most important thing for us is what's going to happen to their capital expenditures. And I think that's the theme to follow.
All right, Anurag Rana, thank you so much. We appreciate that. Anurag Rana, he does a technology thing for Bloomberg Intelligence. He's based out there in Chicago, which is, most people don't know, is a burgeoning tech hub, and Anurag's blazing the trail out there in Chicago, certainly. So anyway, we're going to hear from Apple next week. That's going to be fascinating because you think about it, of all the companies out there that have exposure one way or the other to China, the one that jumps out at me is Apple because 20% of their revenue comes from Apple, and as Anurag noted, it is the growth market or the leading growth market for Apple, or one of them, and it's just an integral part of their supply chain. Yeah. I mean, you think China and making stuff, you think the iPhone and Foxconn and all that kind of stuff.
Well, I mean, but also what Anurag is saying, it's not just about making it, it's about selling it.
Yep.
And that is a huge question mark there as well. All right, coming up, we're going to continue all of these conversations. It's Friday, so we're going to break down munis. Aaron Hudson, Bloomberg Municipal Bond Reporter, will be joining us on what's happening in the muni bond market. And Michael McKee, Bloomberg International Economics and Policy Correspondent, will be joining us. He and I had very different experiences over the last 48 hours. He's in D.C. for the IMF meeting, and I was in Oklahoma City with oil tycoons and government officials. So it'll be really interesting to also talk about that contrast as well. Equities continued mixed. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index back in the green and on track for a winning week. Right now, the S&P higher by 5. That is a gain of 0.1%. The Dow, though, lower by 169, down by about 0.4%. NASDAQ up 79, up 0.5%. Solid week on Wall Street, ending on a softer note. Stocks churning after one of the worst ever consumer sentiment readings, added to anxiety about the repercussions of President Trump's trade war. The 10-year now at 4.27%, with a 2-year 3.77%. Spot gold down $77 the ounce, $32.71, down 2.3%. West Texas Intermediate crude eking out a gain of 0.1%, little change, $62.84 a barrel. And Bitcoin is up 2.1%, $95,469 on Bitcoin. As we have been reporting, Apple is seeking to import most of the iPhones it sells in the U.S. from India by the end of next year, accelerating a shift beyond China to mitigate risks relating to tariffs and geopolitical tensions. Right now, we have got Apple shares. They are trading lower. Apple is down by just about 0.5%. Ben Baldanza, who helped pioneer discount air travel as head of Spirit Airlines, became a target of passenger irritation over no-frills flights, has died. Ben Baldanza was 62 years old. He had been diagnosed in 2022 with ALS, or Lou Gehrig's disease. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, folks, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's talk about this municipal bond market. Lots of volatility out there in the marketplace. You look at the MOVE index, which is an indicator of volatility in the fixed income business. That has spiked, much like the equity of volatility. VIX is sitting here at 25. That's a little bit higher than people would like to see. So volatility is out there. But how's it impacting the municipal bond business? Aaron Hudson joins us here, municipal bond reporter for Bloomberg News, joining us here in our Bloomberg Interactive Broker studio. Aaron, how's the municipal bond market been performing over the last several months? Again, a lot of volatility out there, a lot of uncertainty about economic conditions.
Yeah, for sure. It's been a bumpy few weeks for munis, particularly given the tariff-fueled sell-off a few weeks ago. So I think there's honestly still some adjustment going on, and still a lot happening.
This is a silly question, but the tariff-fueled volatility just affects sentiment overall, but does it specifically affect states and counties and what they can issue against and stuff?
So yeah, depending who you ask, actually there's different answers to that question. In a big picture sense, in a way, no, because there would be longer term effects if tariffs do go into place around construction costs in particular. But in the immediate sense, it doesn't really call into question state and local governments' ability to really do anything short term. However, longer term, building new infrastructure, construction costs will go up. And that is actually something, it is popping up in some bond documents. So there were some deals we're starting to see that do signal that, a risk factor investors should be aware of is if new tariffs go into place. So there was one deal I wrote about this week about a new hotel that inspired The Shining by Stephen King. It does specifically signal that the cost of steel is a risk investors should consider because it's new construction. So any new tariffs would increase costs.
Where was that hotel, by the way?
That was in Colorado, tiny town outside
Really?
Boulder.
I always thought it was like, upstate New York or something, but that's kind of where I think the story is supposed to be set. But you actually went to, I see what you're saying. Okay, so what are we seeing in the new issue calendar? Is it slowing down, or is it because of some of the uncertainty out there, or is it still just cranking along?
So a lot of deals went, some deals were pulled and then went day to day. during that sell-off earlier this month. So now, the calendar's sort of popping back up, and I think issuers are getting more comfortable coming back to the market. But for sure, a lot of it definitely paused. There were still deals that did come, so the market didn't break down by any means. But it definitely, people took a pause to see how things landed.
Talk to us about what's happening with universities, and as universities are dealing with funding, et cetera, what is their ability to tap the muni market?
It really depends on the university, because that space is so, investors think so differently about a very small liberal arts college versus something like Harvard. So when the huge sell-off began earlier this month, Harvard actually did come to the market with a deal. So it kind of just speaks to, I guess, the caliber of issuer. Investors are really selective when they're looking at that space.
So what's happening with the funds flows into the municipal bond market these days?
So, yeah, that's an interesting question. I mean, when it comes to the volatility we saw, ETFs saw a huge amount of outflows, and that has really affected the market because the rise of ETFs, muni ETFs in the space, is starting to change how investors, position themselves.
Yep.
Because ETFs just bring a lot more volatility, and the muni market is not used to that speed of volatility.
Yeah, no,
a lot of people describe it as a sleepy market. And so that kind of speed means that everybody is having to react faster. Baird, for instance, we wrote about this week, they're increasing their cash positions just so they can be more flexible.
All right, well, we appreciate it. Thank you very much, Erin. Erin Hudson, Bloomberg Municipal Bond Reporter, joining us on Munis. All right, let's go to D.C. right now. Michael McKee, International Economics and Policy Correspondent, is joining us on the latest out of the IMF. It's been a multi-day meeting. Mike, has there been a general takeaway among economists there, among politicians there out of these IMF meetings?
If I could use a horror movie analogy, it's don't open that door.
So kind of like
what's behind the closet is a little scary, exactly. No, I mean, there's a very deep sense of gloom and worry here among policymakers who are afraid of what tariffs are going to do to the global economy and what that means going forward for America's participation in the global economy. Nobody really knows how this is going to play out, but all the scenarios, even the minor tariffs, are considered bad. So there is much concern. They put it this way: instead of looking at solving problems on a here and there basis that the IMF does, in the bond market or things like that, they're all talking about how they're going to survive this.
So, I mean, is there a sense that working with the U.S. government is the way to go, negotiating is the way to go, sending somebody to Washington, D.C. to meet with the administration, or is it to lay low? Is it to retaliate? Is there any strategy that's, kind of emanating here?
Yeah. There's not a universal strategy. Different countries are adopting different methods. Obviously, the Chinese are just sitting back and letting Trump crawl to them because they won't engage. But then you've got the British. Rachel Reeves, the Chancellor of the Exchequer, yesterday at the British ambassador's residence, giving a speech that was aimed at one man. And it was all about how tariffs can be useful, and we do need to make sure we manufacture more things in our home countries, etc. So they're doing the flattering thing. Others are also flattering, but some are just saying we're available for talks. The Japanese, the South Koreans have come to town and sat down with members of the Trump administration. So there's no universal strategy, and we'll see which one, if any, produce results.
Mike, we also got some economic data out just to help set the stage from University of Michigan. I mean, it's the final read, so let's appreciate that point. It was less bad than expected, but the numbers are still pretty icky overall. And that's sentiment across the board, independents, Democrats, and Republicans. What's the conversation on that feeding through to hard data at some point?
Well, that's the question. With these sentiment surveys, we don't always see consumers do what or reflect what their attitudes are. And that's what we're waiting to see. It'll take a month or so to see if consumers really pull back on spending. The University of Michigan numbers do show people are very down about the prospects going forward. And the question is, do they then pull back? Because that creates a demand problem in the economy that slows growth, where the tariffs will create a supply problem. So you end up with both the inflation from a supply problem and the slowing economy from a demand problem. And that's what officials are keeping an eye on. But as Chris Waller said yesterday, it probably won't be until July that we start to get reliable hard data on all of this.
Do you think folks at the Fed, Mike, from your discussions, are they taking up their recession, I guess, probabilities as we've seen some on Wall Street do?
I think they've ticked up their recession probabilities, but their view is we can't, predicting a recession isn't going to do us any good.
Yep.
We have to see what the actual path of the economy is, because it could be that we get a demand shock and the economy falls off some, but because it slows down, inflation doesn't go up as much as they thought it would. So there's not a clear-cut way of thinking about it. They just have to wait and see what the data will tell them.
Mike, what's the vibe there? So Mike and I were exchanging emails. I was in Oklahoma City. Mike was in D.C. The vibes are very different. Despite the fact that oil is in, the 60, 62 area, the vibe was just different. It was about deregulation. It was about more freedom to do stuff rather than constraints, and that really affecting sentiment. And we were exchanging notes on how different our vibes were. What's the vibe down there?
The vibe is uncertainty and unhappiness, not just because of what tariffs might do, but the whole idea that the Trump administration has ripped up the playbook for the global economy of the last 80 years or so, and is no longer a reliable partner to work with, and no longer does the country with the world's reserve currency set a tone of free markets and free trade and helping other countries and having your back and all that sort of thing. So there's the foreboding about what the tariffs might do in the short run, and then a sort of sadness about what this might mean in the longer run for sort of Western liberalism.
Yeah, and I guess the question I have is that kind of where we want to be? I mean, I don't know. I kind of grew up in a world where globalization was kind of a positive thing and resulted in some pretty high standards of living and strong economic growth. But I know there's downsides to it, certainly, as well. So maybe we're just dealing with that. Michael McKee, thank you so much for joining us. Michael McKee is the international economics and policy correspondent for Bloomberg News, and he will make the fateful travel decision to fly back to New York today, as opposed to take the Acela train back.
I know.
But
these are weird choices he makes.
These are the choices he makes. These are the choices he makes.
He's no longer even listening to us, so it doesn't really
No, he could care less. He's talking.
All right, well, coming up, we're going to break down how to position with these markets, particularly as next week is the biggest earnings season Okay, I'm going to try that one more time. Next week is the busiest earnings week of this season. Boom, I got it.
Yep.
$20 trillion worth of market cap of kind of what do you do in that environment. Clark Generan is chief market strategist at Calbay Investments. We'll talk to him about it. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. The Dow lower now by 243 points. We have got the S&P 500 index a little changed, but back in the red. Last update, we told you stocks were higher. Right now, the S&P down 2 points. The key takeaway, little movement there. We have got the Dow lower by 0.6%. NASDAQ is holding on to a gain of 58 points now, up by about 0.3%. The 10-year 4.27%, with the 2-year currently yielding 3.78%. Spot gold down $72 the ounce, 32.77, down 2.2%. And West Texas Intermediate crude oil up 0.2%, 62.89 a barrel. Bitcoin, meanwhile, now up 1.7%, 95,064 on Bitcoin. Economists are warning of rough seas for America's economy, slashing the outlook for 2025 and 2026. And with that story, here's Bloomberg's Vinny Del Giudice.
American families are in the crosshairs. Forecasters see the White House trade war zapping the economy and putting a dent in household spending. GDP is set to expand 1.4% this year and 1.5% next year, based on a monthly Bloomberg survey. That's below prior estimates. Meantime, financial chiefs at the International Monetary Fund's spring meetings are downplaying prospects for a financial crisis, but not ruling it out. Uncertainty reigns, not good news for Main Street. Vinny Del Giudice, Bloomberg Radio.
Skechers USA shares lower by 5% after the footwear company said it is not providing financial guidance and withdrawing its previous annual outlook due to macroeconomic uncertainty stemming from global trade policies. Again, Skechers now down by 5%. Consumer products maker Colgate-Palmolive is cutting its growth and profit outlooks as tariffs are expected to add $200 million in costs this year. Colgate-Palmolive trading higher now by 1.1%. Rival Procter & Gamble down 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio in New York City. And we are streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Looking at the Bloomberg Magnificent 7 Total Return Index. The bad news, it's down 20% from that beginning of the year high. The good news is it's up about 13% from the lows just a couple of weeks ago. The question is, what do you do with some of those Mag 7 names? Or what do you do with just technology and growth in general? Can that continue to be a leader for a market that's facing a lot of economic uncertainties out there? Our next guest might have some thoughts. Clark Garanon, he is the chief market strategist at Cal Bay Investments. I did a little Googling. Cal Bay Investments is in Danville, California, just a little bit east of Oakland, a beautiful part of the country. Clark, I guess just given who your neighbors are, you got to think about technology out there. How do you view the tech sector at this point, given some of the economic uncertainties that we do have?
We really like the large cap tech space. After we saw the pullback so far this year, we are really looking at it as a great opportunity. We haven't seen valuations like this in years. So we're really telling our clients, with any dry powder that they have, or potentially after a rebalance, that these are great names to look at as we're moving forward.
What are the worry parts, though? Like, they've re-rated for a reason, because they're exposed to tariffs, because they're worried about growth, et cetera, CapEx spend. So where does the discount actually, though, make sense?
So what we're thinking is a lot of these tariffs are going to be pulled back. And I know that the administration promised 90 deals in 90 days. We haven't seen one happen. But we think right now that a lot of this is baked into the markets, and we are going to see this continue to move forward. I mean, we were at a 24 times multiple at the end of the year, which is what prompted us to do a rebalance, knowing that we were going to see some of this uncertainty moving forward. And I think we're in a good position right now to move forward into the tech.
You know, we had one of the bellwethers report earnings yesterday at Google. What did you take away from the Google earnings as it relates to maybe just tech spending in general, digital advertising in general?
So while I can't speak to an individual company, I will say that a lot of the CapEx numbers have stayed the same. That being said, we also see a lot of companies now coming out and not providing guidance for 2025.
Yeah.
And I think really they're in the same boat that we are, where they're just trying to underpromise and hopefully over-deliver based on the current environment. We don't know what's going to happen, but we're all hopeful that we will get some deals done over the next 90 days.
What would give you confidence in terms of market calm? Would it be an actual deal, or would it just be like less negative headlines? What would sort of indicate that for you?
Sure. So although we don't like trading on tone, we have seen some positive data come out this week. Production numbers, manufacturing, and new home sales, which have all been a positive. So to the contrary of that, a lot of the soft data that we've been seeing, which has really been driving some of the fear and the tone in the markets, like consumer sentiment, that number improved today. And so we are liking to see that the soft data and the hard data are starting to move in the same direction.
What are the kind of conversations you're having with your clients here, Clark? Over the last, 2, 3, 4 months, when the volatility has kind of spiked, we've gotten a lot of uncertainty now into the economic outlook as it relates to tariffs. What are the conversations that you're having most commonly with your clients?
So a lot of them are concerned. For instance, we have a 60-year-old and an 80-year-old coming to us with the same concern. How am I ever going to make up these losses? And so for us, it's the best time to educate clients, reevaluate the risks that they're taking, and look at tax loss harvesting opportunities. Use those proceeds and try to put them into an opportunity, whether it be large cap tech or financials, which we're also bullish on.
And for financials, talk to me about that bullish thesis.
So what we've seen so far, our earnings have continued to be strong. And the other thing we look at is credit card delinquencies, which have also come out more positive than expected. And so we feel with the hard data that we're actually seeing from financials that moving forward, there's really a lot of upside because we have the possibility of more deregulation, corporate tax cuts for these companies, and we think that that'll lead to more deal making as well.
So, I mean, I guess what the administration is talking about a lot about their economic plans is maybe some near-term pain here as it relates to rejiggering trade policy, but again, with, as you mentioned, kind of maybe some deregulation, maybe some corporate tax cuts, maybe some longer-term gain. Is that kind of is that the backbone of kind of how you're framing it out?
That's exactly what we're hoping for. Really, we do need to see material progress, though, on the tariff policy in order to have a clear picture. Right now, we can't trade on the tone and we can't trade on leaked comments because we're investors, long-term investors, and we need to look for some actual hard data to come out and help support that.
All right, Clark, thanks so much for joining us. Really appreciate it. Clark Garanon, he's a chief market strategist at Cal Bay Investments. I think it's some offices all around kind of the Bay Area of San Francisco, Santa Clara as well. So a good part of the country out there. All right, Oklahoma. What was the vibe? Just Oklahoma State University, still really energy dependent?
They love the OSU people are like hardcore. I guess their color is orange.
Yes.
Did we know
yes.
that? Okay. So me, the non-sports person.
Right.
I get into one of the Ubers and the guy's wearing all orange. And he talks to me about OSU and being orange, and I'm like, cool. And I have like very little to participate in that, but it's still definitely apparently
and the energy
a really
folks,
big deal.
As you mentioned, I mean, notwithstanding the fact that WTI crude oil is at 62, they'd rather it at 76. Yes, I watch Landman. That's the number.
That's amazing. That was true.
Yeah,
75
exactly.
maybe, but yeah.
Okay, so
the vibe again is turning more to deregulation, and we'll get to this more in a second with Harold Hamm. But looking on the bright side of life, very Life of Brian kind of situation. But the idea is that you're going to have deregulation that's going to be huge, and that's going to be very helpful. It's also a factor of AI demand is going to be so prevalent that really is going to help support the sector. The problem is there's so many bottlenecks, from supply chain issues to permitting to part issues, that it's not an easy or quick line to fix.
But that's where perhaps this new administration, Trump administration, can help.
That is the hope, and that was the point of this summit at the Harold Hamm Institute, which we'll get more into. I also got to speak with him on the side of that conference. More on his take on the market coming up next. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As you know, Alex was in Oklahoma City over the past couple of days at a big industry conference for the energy folks. That's where I just feel like you see some of these big energy wildcatters walking around and all that kind of stuff. One of them is Harold Hamm. I've heard the name many, many, many times. I don't really know a lot about him. I'm reading the Wikipedia page as we speak, doing the Tom Keene thing. But Alex, tell us who Harold Hamm is.
Definitely. So Harold Hamm is chairman and co-founder of Continental Resources. So Continental Resources is one of the companies that was credited with starting the shale revolution. Continental had a lot of rock in the Bakken, and Harold was one of the pioneers that said, let's keep drilling, let's try this new cool technology in order to do it. He's labeled as one of the original wildcatters in the industry. That's guys that take a lot of risk in oil, and in this case, it paid off. He also grew up as a super poor kid, didn't go to school. He was basically a land guy who would go and try and get royalties and stuff like that, and turned it into a business, and then turned it into Continental.
It's like a landman guy.
He's a super straight up landman kind of guy,
cool.
without the weird
Now I
violence
got
and things
it.
like
Now I
that.
got
And also, he has become a big advocate of American energy, a big force behind oil exports. He's also often called the Trump whisperer when it comes to energy policy. He's not in the Trump administration, but he definitely has a phone line at points and at times to the president. And he raised a lot of money for him. And he also started the Ham Institute with Oklahoma State University, which is where this summit was held at. And it's basically a public institution that's trying to be a think tank for oil, and not just oil, I want to say broad energy policy and how to really help energy policy in the U.S. Take off. Did it help? Did that Alex explaining help? You got it? It's the landman reference. Once you do that, you're good to go.
Yes.
So this particular conference, and there have been a lot, is bringing together leaders from tech, policy from DC, and energy folks to be like, AI tech companies like Meta, what do you need? What can this energy community provide for you? It was called Powering AI Global Leadership Summit. I actually led one of those panels with some tech guys from NVIDIA, as well as AWS, and it was and Anthropic, and it was super interesting. And the gap between the knowledge of tech and energy is still really wide, and how to bridge that. On the sidelines of this conference, I got the pleasure of sitting down with Harold Hamm, talk through many different things. One of them had to do with how he's thinking about trade and supply chains for continental resources.
We recently did a supply chain check to see how much, it would cost us as far as tariffs. The surprising thing was not the cost, but it's the amount of material that had been offshore over the last 15, 20 years. And it kind of gone on, maybe unawares. I think we keep up with their business pretty good, but we found out that a lot of the stuff that's pretty common in usage, like wellheads and valves and different things, and big items, tubulars would pretty well control, but there's a lot of other items that pumping units and submersible pumps that have been made here in the U.S. forever and had been offshored. And
you didn't know it?
I didn't know. We wouldn't. It shocked me when I found out that had been offshored as well. And so we came to the conclusion that, wow, this is not right. And so we're going to have a preference to buy American again. We've always had that, but somehow we lost it. And so we're raising the flag and saying, we've got a preference to bring it back, buy American. If you can't get it, we won't do it for a while, but we're very committed to make that happen. And we'll be the first company to stand up and saying, it's important to us. It's important to us to support Americans. We always have, buying vehicles and everything else. And so that's where we're at again. And we think it's the right thing to do.
Would you be willing to pay more for those things?
Yes, yes. If we have to, we will. I understand that what competition is, and that's probably what drove it over there. The cheap, and I'm glad you brought that up, though. To take advantage of cheaper labor. But when it's all said and done, when we assess the entire spectrum, it's not cheaper. We're paying just as much due to the transportation and everything else to get it back here to use it. And so it's not cheaper. So we might as well onshore it again, and that's what we're committed to do.
And if it was more expensive here or it took longer, that's okay. Like, you're going to wait for it and you're going to take the cause because you believe in that.
Whatever it takes.
Very interesting commentary there. Willing to pay more, willing to wait in order to buy American. And this is coming, it helps that Continental's private, as we spoke about before, but nonetheless, clearly, what was very interesting, though, as we continue the conversation, is the potential for American energy to help AI, but how hard it will still be to get it done from a supply chain perspective and a permitting perspective. And there is a push to, you had Secretary Burgum talking about getting the permitting time down to 14 days from years.
Wow.
And 28 days if you factor in an environmental permit. People literally cheered in the room.
I can imagine. Because you think about the capital that these folks are putting in the ground, literally.
and the changes that then can happen. All right, well, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on SiriusXM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Balance of Power with Joe Matthew is up next after this global news update as we take a look at a very calm, eerily calm Friday market and a mixed market at that. The S&P is flat and the NASDAQ is up by about 0.4%. This is Bloomberg.
This is CBS News on the Hour, sponsored by Steel.
I'm Peter King. The latest immigration enforcement arrests now include a judge in Wisconsin. Here's correspondent Michael Wallace.
FBI Director Kash Patel posted on X that Hannah Dugan, a county judge in Milwaukee, is being charged with obstructing immigration enforcement. He says Dugan intentionally misdirected federal agents away from an undocumented immigrant who was going to be arrested in Dugan's courthouse. Agents caught the man after a foot chase.
Expelled New York Congressman George Santos is in court and due to be sentenced momentarily after pleading guilty to wire fraud and aggravated identity theft. The man accused of killing United Healthcare CEO Brian Thompson is due for arraignment in New York federal court shortly. CBS's Anna Schechter says prosecutors will ask for the death penalty for Luigi Mangione.
We are expecting a not guilty plea today, very likely. This is, of course, the highest charge that he's facing, the death penalty.
Russian officials say there's reason to believe Ukraine was behind the car bomb attack that killed its deputy director of military operations this morning. It's the second fatal attack on a high-ranking Russian officer in 4 months. Here's CBS's Holly Williams.
Russian officials say that Lieutenant General Yaroslav Moskalik was killed by an explosive device rigged with shrapnel and placed inside a car just outside of Moscow this morning. Moskalik was a senior figure in the general staff of Russia's military. Russian media is reporting that the device was detonated remotely as he walked past.
President Trump has been talking about a possible deal to end the fighting in Ukraine with his negotiator Steve Witkoff in Moscow right now.
Meeting with Putin right now as we speak, and we have a lot of things going on, and I think in the end we're going to end up with a lot of good deals, including tariff deals and trade deals. We're going to make our country rich, but we're going to try and get out of war so that we can save 5,000 people a week.
That was a couple of hours ago, and a Kremlin official has just called today's talks constructive and says direct talks between Russia and Ukraine are a possibility. The president and first lady are on their way to Rome for Pope Francis's funeral, and they'll be near the front but not in the front row tomorrow at the Vatican. Crux editor John Allen.
130 delegations from countries around the world are going to be represented here. We know that pride of place, so the first two positions in this sort of galaxy of potentates will be given to Italy, that's the Pope's adopted country, and Argentina, the Pope's native country.
Allen says hundreds of thousands of people are expected in the area for the outdoor service at St. Peter's Square. Wall Street, it's a mixed day with the Dow losing 141 points. The NASDAQ is up 69. This is CBS News. some New York high school students have had a big surprise, a big-name guest speaker.
Video posted to Instagram captures the delight of students at New York's LaGuardia High School when 2013 grad Timothy Chalamet was introduced as a guest speaker at a career management class. Hardly unknown anymore, the Dune star gave aspiring actors advice on how to make it to Hollywood, like he did. The 29-year-old actor also met with some of his former teachers and the principal. The school posted on social media, when Timothy Chalamet walks in the room, you know it's going to be a great day. Deborah Rodriguez, CBS News, New York.
Retailers say pre-orders for Nintendo Switch 2 have been overwhelming as gamers jumped online to try and get one. Some were successful, others ran into frustrating delays or saw listings quickly sell out at places like Target, Walmart, and Best Buy. The Nintendo system won't be available officially till next month. Peter King, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Friday edition. Welcome to the fastest show in politics as President Trump heads for Rome and his special envoy heads for Moscow. We'll have the latest on tariffs today, the prospect of peace in Ukraine, and conflicting messaging from this White House this week with Bloomberg's Wendy Benjaminson and with Tyler Kendall at the White House. Later this hour, we'll bring you to the IMF for a conversation about monetary policy in emerging markets, one you won't hear anywhere else, and it's all after a look at Wall Street. We start the fastest show in politics with a look at the markets and Charlie Pellet in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Do want to begin with a developing political story headline coming right now. We have got former Congressman George Santos sentenced to 87 months in prison. That according to the New York Times. But again, George Santos, the former congressman, sentenced to 87 months in prison. A story we will be following for you right here on Balance of Power. U.S. stocks right now looking at a down day for the Dow Jones Industrial Average, an up day for both the S&P and NASDAQ. S&P right now higher by 5 points, a little changed, has been swinging between gains and losses as we wrap up what looks like to be a winning trading week. S&P right now higher by about 0.1%. The Dow in the red by 138, down 0.4. NASDAQ right now up 58, higher by 0.3%. 10-year 4.25% with the 2-year 3.77%. Gold down $66 the ounce. Spot gold down 2% now, $32.82 the ounce on gold. West Texas Intermediate crude up 0.1%. WTI $62.87 a barrel, and Bitcoin up 1.7%, 95,044 on Bitcoin. Bottom line here, U.S. stocks looking at a mixed picture. Matt Hornback is global head of macro strategy at Morgan Stanley. He says the challenge on trade right now is navigating all the uncertainty.
Ultimately, our trading partners want to negotiate with us. They want to come to a deal that favors both sides, but ultimately figuring out what those goals are can be challenging sometimes, even for analysts on Wall Street like myself.
Earnings news, Alphabet shares up 1.5% after last night's report. Intel heading the other direction after earnings, down now by just about 7.5%. Again, recapping, U.S. stocks trading mixed with the S&P higher by 0.1%. And repeating our top story, George Santos, the former congressman, has been sentenced to 87 months in prison. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie Pellet with the headline, as always. Charlie, on the markets and the news, thank you so much. We'll get back with Charlie Pellet in just a few to keep tabs on the markets as we do every day around here. You made it to Friday. Welcome to the threshold of the weekend. White House Correspondents' Dinner weekend here inside the bubble, even though nobody wants to talk about it. I'm Joe Matthew, and it's great to have you with us on Bloomberg Radio, on the satellite radio channel 121, and on YouTube. Dial us up now, search Bloomberg Business News Live. We'll meet you in the studio. For the next 2 hours, we've got a lot to talk about, and I guess, look, Charlie just pointed us to it. George Santos. There was a time when we talked about Congressman George Santos every single day on this show. We had a stretch of panels with Rick Davis and Jeannie Shanzano that lasted weeks without changing the topic. videos of him running through halls, slamming doors, hiding in elevators, being chased by reporters. Then, of course, he became a social media sensation, and he is now going to prison. The quote in the New York Times, "I came to this world alone. I will deal with it alone. And I will go out alone." With 87 months sentenced, it's pretty bleak for the gentleman from New York, and it's where we start our conversation with Wendy Benjaminson. Bloomberg's senior editor had no idea she'd be talking about this, I'm sure, today, but Wendy, it's great to see you. We talked about George Santos a lot as well. What a political phenomenon, to the point where his destruction, his self-destruction in office became part of pop culture.
Absolutely.
As we now follow him down the trail to prison.
I mean, it is one of the shortest lived tenures from celebrity to convict that I can really think of
How about that?
in some time. I mean, yeah, he was, and still I want to say kudos to the local Long Island newspaper who first broke the story that not everything he was campaigning about was true. Right? Yeah. And sadly for them, it wasn't until the New York Times picked that up and did the story that everything about him became suspect. And then everything about him became suspect. I mean, everything from his name, his ethnic background, his religion, his, what he had done. There was a P.O. box in Florida that was supposedly in office. The guy was, but it's kind of, and that quote, we were talking just before we came on, it's really sort of sad. This guy clearly has some issues that need to be dealt with, and unfortunately he went down this road and now is spending 87 months in prison.
This is a big chunk of time, and he talked about that. Really, he was pretty open with the New York Times and said he would have sought a pardon from Donald Trump, but if it weren't for the shame he felt on his family, and you wonder if Donald Trump would have given him a pardon.
He might have. I mean, the only cynic in me is sort of like, nothing true has come out of George Santos's mouth, so maybe he tried and was told you're not getting one. But then he could use would bring shame on my family. Or, as I said, from the sad side, it may be that he really is ashamed of what he did, and we'll see. But he certainly was a fraudster incarnate.
Pretty remarkable to see the headline on the terminal: George Santos sentenced 87 months for stealing campaign funds. It is Friday, as I mentioned, and I have this familiar feeling today after being knocked around in the news cycle. Seemed like so much happened every day, and then you end up in this pool at the end of the week, this puddle, wondering what actually changed. And so frequently the answer, Wendy, is nothing.
Right.
So let's look back from Monday to today. We wanted to ask you to put some perspective on this, because we're all feeling the same jostle every day by the news. But it's pretty hard to make an argument that anything changed. Wall Street's acting like something really changed with the tariffs. I couldn't even tell you what day it was. Scott Bessent said de-escalate. Then Donald Trump says we're meeting every day with China. They say they haven't even called. What's real right now?
Who knows? Who knows
you
what
have
is
to
real?
Edit this material.
I do, and I have found myself editing a story on Monday and editing its mirror image on Monday. It's become this very, very... are we in, are we out, what side is up sort of life we're all living here. And yes, tomorrow night we'll all be able to have a drink and commiserate about it. But this, on the Chinese thing, Trump even said today, yes, we're going to have a talk. I had a talk. I won't say who with. No, I didn't have a talk. It was like in the same breath, he sort of said yes, no, yes. Yeah. Several times, and finally China's foreign ministry came out and said, stop creating confusion. There was no talk. Who to believe? I don't know. I just don't know. There are talks going on. Yeah. Trump did say that within a few weeks there will be deals. That may be what the market is responding to. I think right now they want to cling to any positive hope that the tariff regime will be reduced.
Yes, right.
The trouble is what Trump calls a deal and what is actually a signed agreement may be two very different things. It may be the way he's doing with Ukraine and Russia. He has presented a deal to them. Yeah. So he says that's a deal. But sometimes these go into dotting I's and crossing T's at a level of detail that can last absolutely years. The USMCA or the NAFTA lasted years both times. So, what is a deal? We just don't know.
He's on his way to Rome right now, President Trump, that is. He did speak before taking off for the Pope's funeral here, a little gaggle with reporters speaking to some of these smaller potential deals or frameworks for deals, including Japan. Here's what he said.
I'm getting along very well with Japan. We're very close to a deal. Meeting with Putin right now as we speak, and we have a lot of things going on, and I think in the end we're going to end up with a lot of good deals, including tariff deals and trade deals.
Okay, on his way to the chopper there coming out of the White House. First Lady by his side, which is actually an optic that we're not treated to very often.
We don't see very much, yeah.
With this president. But is that the idea? We get a sort of a patchwork of frameworks, some of which might become deals?
That would be the most logical conclusion to interpret from what he says.
Which brings us back to the idea that maybe not that much has changed.
Right. There may be positive talk. We have seen that China is considering relenting on some of their reciprocal tariffs on some goods because their economy has slowed. Remember that China's economy the state of their economy has bought them some time to run the clock a little bit and see what Donald Trump is doing. Others are very eager to do something about the tariffs. And again, it could just be that they showed up and therefore Trump believes there's a deal, or maybe there is a deal, but the transparency is not there for us to really know what's going on.
100 days next week.
100 days.
And this time the president himself is going to mark that. Usually it's something that we talk about
right.
first 100 days, and then we tell everyone that it doesn't matter. It's
and the president's
abstract.
supposed to go, it's
correct.
nothing.
Judge me in my first. But he's going to actually have a rally to mark the first 100 days, and I suspect he's going to Michigan. Interesting. Right. I wonder what you make of the venue. Is this a campaign-style rally? What does he actually get to take credit for?
Well, what he actually gets to take credit for and what he will take credit for are obviously two different things. But he will take credit, I'm sure, for fulfilling many of his campaign promises. Closing the border, which is doing well with voters. That is the one thing, despite all of the problems with due process and people being sent to this notorious Salvadoran prison, voters are still relatively happy, at least 50-50, and maybe a little more than 50-50, that he is deporting undocumented migrants. But on the economy, he is firmly underwater. I think the choice of Michigan was good because there, where there is still auto manufacturing and things like that, they are a little less afraid of tariffs than a lot of American consumers are. And so I think he thinks he's going to get a backdrop of auto workers cheering him, and he can say American manufacturing is back here in the cradle. I'm saving your industry. We'll see how he does that. But I think it will absolutely be a campaign-style rally.
We only have about a minute left. You get beyond 100 days. Everybody gets over the hangover maybe on Wednesday, Thursday. Is the second 100 days a similar cadence? Do we still do this flood the zone every day?
He may want to. I think the staff may be exhausted by this. I mean, he really bought into the whole media myth about the 100 days, which of course goes back to Roosevelt in 1932, right? So he was, as rarely for a president, didn't shy away from it. He really embraced it. And it could be that he now begins to slow down as these deals have to be negotiated and there's tricky, behind the scenes work, and the tariffs begin to set in. But Trump will never shy away from a camera or a microphone, and so...
You tend to think that a lower cadence might soothe the markets, even if the news flow itself isn't altogether different. Wendy Benjaminson, great to have you help us distill the week, as always. Bloomberg senior editor with us here in the nation's capital. I'm Joe Matthew. Of course, in Washington, where this program comes from every day, we'll have a lot more straight ahead on the fastest show in politics, IMF Week. We're joining Lisa Abramowitz for an important panel at the bottom of the hour, right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg, but repeating our top story, former New York Congressman George Santos, a one-time rising Republican star who falsely claimed to be a New York investment banker before running for Congress, has been ordered to serve 87 months in prison for stealing campaign funds. Here's Bloomberg's Wendy Benjaminson, interviewed moments ago right here on Balance of Power.
I mean, it is one of the shortest-lived tenures from celebrity to convict that I can really think of in some time. I mean, yeah, he was, and still I want to say kudos to the local Long Island newspaper who first broke the story that not everything he was campaigning about was true.
Bloomberg's Wendy Benjaminson, interviewed moments ago here on Balance of Power. The former lawmaker was in Congress for less than a year. He's been told to surrender to federal custody by July 25th. Looking at a down day for the Dow Jones Industrial Average, lower by 111 points right now. That is a decline of 0.3%. We've got the S&P up 11, up 0.2%. NASDAQ up 93, higher by 0.5%. 10-year 4.25% with the 2-year 3.77%. Spot gold now down $66 the ounce, down 2%, $32.82. West Texas Intermediate crude up 0.4%. WTI 63 even a barrel. Earnings news: T-Mobile down 11.4% after disappointing new subscriber numbers. Verizon shares down 3%, and AT&T shares right now. AT&T among the companies reporting earnings earlier in the week. Right now we got AT&T shares. They are trading a little change. So again, recapping here, U.S. stocks, they are trading mixed. S&P up 14, up 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet. I like your style, Charlie. We'll be back in just about 10 minutes, a little bit more to check on how the markets are doing. We do this every day, back and forth, from the nation's capital to Wall Street. Washington to Wall Street, inextricably connected right now as we cover politics here. In a series of headlines every day, they tend to drop right around noontime. It's funny how that works, and they move the markets one way or the other. So Charlie and I keep this volley going, which is actually required now to cover what's happening in American politics and finance. You have to have the Amtrak corridor covered on both ends. So thank you for being with us here on Bloomberg Radio, satellite radio channel 121, and on YouTube. In about 5 minutes, a little more than that, we're going to bring you to the IMF for an important panel on emerging markets, monetary policy. Bloomberg's Lisa Abramowitz will be holding forth with a lot of questions as we walk into the weekend here about what exactly has happened. We explored this a bit with Wendy in our first conversation here this hour. What really changed this week? We came into this week with the doom scroll and a stock market deep in the red over great concerns about the tariff policies coming out of the White House. Then Scott Bessent said something to a closed-door meeting with J.P. Morgan investors, and we're off to the races. De-escalate. We're going to be very nice to everybody, Donald Trump says. Talks are even underway. That idea has been challenged a bit, though. Was asked about this, the president in the Oval Office this week. Listen.
You said you spoke with President Xi. Have you spoken to him since the tariffs? When did you last
I don't want to comment on that, but I've spoken to him many times. Yeah, I'll let you know at the appropriate time. Let's see if we can make a deal.
All right, that's new, by the way. I thought this was the same one from the Oval when he suggested that they were already talking every day. So he's still keeping a positive spin on this, where we're getting a completely different message out of Beijing. And that's what we want to talk to Tyler Kendall about, who's with us right now at the desk in Washington. You know the president's out of town when Tyler's not on the North Lawn. Nice to see you in the studio here. So did anything actually change that we can call news this week when it comes to China and tariffs at large?
Well, there does appear to be this apparent disconnect between Beijing and Washington, at least when it comes to whether or not these talks really are underway. And that's what we've been trying to kind of parse through here to see, is there progress when it comes to this? And are they actually talking? Now, Joe, earlier today, Time Magazine released an interview. It actually had happened on Tuesday, but they released it today with President Trump. And he said in the affirmative that he has spoken to Xi Jinping. However, we have not heard any sort of confirmation from China's side that this has happened. And then you heard him there. Reporters followed up on that and said, well, when did you speak with him? Have you spoken to him since your tariff plans have been rolled out? And he said he didn't want to talk about it. He said maybe he'll reveal it at a later date, another time. So we're trying to piece together when these talks have happened, because we know, of course, the leaders have spoken before. The most recent example that we do know of was right before the inauguration. So whether or not they have spoken since then, we'll have to wait and see, because both sides have a very interesting view on this. One, the White House says that President Trump wants to speak with Xi directly and that they want him to pick up the phone and call him. Something actually in that interview, Trump said that he wouldn't be calling Xi Jinping first.
Yes, it's a game of chicken now.
But then the other side of this is that we had our own Bloomberg News reporting last week that there were some very important preconditions for negotiations to start, one of which is that Beijing wants to see someone else other than President Trump be appointed to lead the talks. So as we sort of try to piece through whether or not those talks are happening, we did get, as you mentioned, some positive reporting that, tensions could be de-escalating. A new one this morning, actually, from Bloomberg News reporting that China is potentially looking into exempting some U.S. goods from tariffs. These would be in sectors that are where China is a little bit more import reliant. We're talking about medical equipment, for example, like imaging machines, ultrasound machines, but also some industrial chemicals that go into plastics and cooling agents. Also in our reporting is potentially that plane leases could be exempted here as China tries to shore up its own bid to protect its own economy, but also potentially could be some sort of easing. Now, sources familiar do tell Bloomberg Joe that nothing's been decided yet. It is still very, very much in flux, but it does give us something that we could potentially see movement on.
Wow. Interesting. He's on his way to Rome for the Pope's funeral. He'll actually be sharing space with a lot of the leaders we're talking about here, at least European leaders who will be there. Everyone except maybe Putin and Xi are attending this, right? And you wonder if that generates any news here. We're talking about potential deals with South Korea, now Japan. When does the EU get involved?
Well, that's actually a very good question, particularly after the European Union trade chief left Washington 2 weeks ago now with very little clarity on what actually needs to get done for a deal when it comes to the European Union. We had last week the Italian Prime Minister Giorgia Meloni here. That was considered to be a positive step in the right direction, but that's a very important theme we're going to be watching, as our reporting indicates that China is starting to really start to reach out to the European Union. There's, of course, not major movement yet, but we know for electric vehicles, for example, they're starting talks about. So that's potentially one area that we could see a development with. Now, President Trump was asked when he was leaving towards Marine One whether or not he was going to take meetings while in Rome. He did say yes, also said potentially with Zelensky. He said that's yet to be decided, but didn't rule it out completely. Says this administration is trying to show progress. And we heard Scott Bessent, actually, I want you to take a listen here. He was in the Oval Office yesterday, and he said that South Korea in particular was moving much faster than he expected, and said that we could get some technical deals on a framework sometime next week.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week, as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
So still details on what a framework of an agreement means. I was actually talking about this with Kaylee Lines out by our desk before. I thought she had a good example. It's like a letter of intent, perhaps,
Sure, right. It's
an
not
agreement to have a deal, right. But we still do know some things potentially that could be in a deal. We know, the U.S. wants to see these countries boost their imports, particularly when it comes to U.S. LNG. They want to curb those non-tariff barriers that we hear a lot about. Take Japan, for example. President Trump saying a lot of progress has been made on Japan. He's feeling very positive about Japan. We know he wants to see them curb their standards when it comes to U.S. auto imports that he alleges is hurting U.S. automakers' market access to Japan. So things like that. So perhaps maybe we would get some sort of firmer commitments, but at the moment they're trying to show progress towards a broader deal to signal that these talks are indeed happening, particularly with those countries that are geographically close to China.
You're knee deep in this, though. Like when you back off, I mean, that was an amazing, granular, comprehensive update on all of the rhetoric we just heard in the last 5 days. when you pull up to 30,000 feet, not that much actually has changed. Maybe we get a couple of framework deals the next couple of weeks. Markets seem to be pricing that in, but you wonder when the real stuff starts. I mentioned the Pope's funeral. You cover the White House. What's the plan here? Because it looks like he's not going to be on the ground for very long.
No, it's going to be a very quick trip. Joe, he's going to land, attend with, of course, the First Lady, Melania Trump. She was with him today when they were heading out to Marine One, and then he's turning right back around and coming back to the White House. It's going to be a very quick trip. There is a lot of speculation that potentially there could be a meeting with Zelensky. That's really the one that we are more watching closely, besides for the trade front. Of course, as you well know, Norway's prime minister was at the White House that yesterday now, I think.
Can you imagine?
So much news has happened between then and now, but of course we had seen our own Bloomberg reporting that the U.S. is getting ready to demand that Russia make some concessions here, including recognizing Ukraine's right to build up its military, its defense industry, considering we know Russia really wants to see Ukraine disarm, see a halt of Western military flows into the country. So that's potentially one theme that we could be seeing as he moves abroad. But of course, he'll be in Italy, and there will be many European leaders who are going to be trying to vie for some time in front of him.
And if we want to see this, 4 o'clock in the morning, it looks like, right? You're getting up early to watch this process. Third-tier seats, the words that I'm hearing for the Trumps. He's going to deal with this? Remember, he made fun of Joe Biden at Queen Elizabeth's funeral because of the way the protocol works here. Catholic royals are seated in the front row, followed by non-Catholic royals, including Prince William. World leaders, heads of states, other foreign dignitaries then sit behind them. So Donald Trump is going to find himself with Melania in the third row. I wonder how that's going to go.
I mean, if that is what the protocol is. President Trump was asked if he had any words while he was going towards Marine One, and he had some very nice things to say. Originally, we saw a very short statement from him. He did lower the flags to half-mast at the White House and all federal buildings in honor of the late Pope. So we'll have to see what the optics look like there.
I'm just putting you in an uncomfortable situation now. Here's what I want to know with a minute left with Tyler Kendall. You heard the news about George Santos, the former congressman, 87 months. You spent months of your lives running through the halls of Congress, chasing him with a gaggle of reporters trying to get him in front of a camera and on a microphone. And you saw him running into his office. He took great lengths to hide from you guys. As you look back on this whole escapade, what is the lasting memory of running around the world trying to find George Santos in the throes of his controversy?
And he was on Capitol Hill for less than a year, yet we have so much tape of him. There is one lasting memory, I will say. It was a viral moment when he was running out the front steps of the Capitol straight into a car, slammed the door in us reporters' faces because he did not want to answer the questions. At the time, he was just under some allegations. He had not been found guilty. He did plead guilty in August to 2 counts of wire fraud and identity theft just weeks before his trial. I mean, keep in mind, he was considered to be a rising Republican star.
Absolutely. At
one point.
A fleeting moment. So your enduring memory is a door slam when it comes to George Santos.
It's not necessarily unique to him. We run after a lot of lawmakers on Capitol Hill.
Seems pretty appropriate for him, too, though. Tyler, thank you. Reporting for Bloomberg here in Washington, D.C. We'll catch up with Tyler a little bit later on at the White House. I'm Joe Matthew in Washington. We'll bring you to the IMF when our panel with Lisa Abramowitz gets underway. Stay with us right here on Bloomberg.